The Secretary of the Department of Financial Services, the DFS Secretary, as we know, M. Nagaraju, had told CNBC TV18 the IRDAI, or the insurance regulator, is set to come out with draft regulations on insurance commissions. Remember, the big surprise in the insurance amendment bill, which was cleared earlier this month, and CNBC TV18 has been on top of that, was an enabling provision for the regulator to be able to regulate commissions that insurance companies pay. Let's listen in to what the DFS Secretary had to say.
The government is very keen to have to empower IRDA to have the oversight and also the authority to implement on the distribution costs, and also the power to regulate so that nobody is paying too much commissions. Because the complaint has been that some of the insurance companies too high costs, the agent commissions, and consequently the premiums are either premiums goes up or the ICR, increment capital ratio, is very low. So in both cases, the consumers will they actually suffer. So we wanted to give oversight legal power to the IRDA, so the government has given to that.
So there will be certain rules and regulations that the regulator will be coming up on this front particularly?
IRDA is expected to come out with draft regulations.
I think that's a senior most official, government official, talking about insurance commissions, very much squarely on the government's radar in that sense. And it's a story that, we at CNBC TV18, our colleague Yash, who looks at insurance, has been covering for many months now. And now very much part of the bill, and the DFS Secretary himself confirming that the regulator IRDAI is going to come up with draft regulations soon. Nilesh Sathi is former member IRDAI, and Thomas Devarsia is former member non-life at IRDAI. Gentlemen, welcome back. Good to have both of you back on the program. We've discussed this topic before. First up, season's greetings to both of you. And let me at the outset wish you, a happy, prosperous 2026. Mrs. Sathe, what did you make of the DFS Secretary and what he said, sir?
The first thing is there was no reason for now empowering IRDA. IRDA is already empowered because in the past there were commission regulations. If they had no authority, how did they release the commission regulations in the past? So it was already there. Now I do not know why it is being repeated again, but they were repealed in 2021 when they were subsumed in expense of management regulations. That is, in my opinion, a big mistake that IRDA has made. Let us candidly admit it.
You mean the repeal was a mistake?
Yes, of course, because now again they want
because for our viewers, essentially, so far basically they're saying that you got to break up the expenses of management. Overall cap will not do. We want to see what constitutes the expense of management and maybe have a cap on.
I understand.
Yeah, individual thing. Go on, sir. Sorry. Yeah.
That is precisely what was there. There were commission regulations which ensured a cap on commission and rewards. And there were expense of management regulations in the past, I'm saying. But in 2021, the commission regulations were withdrawn and they were subsumed in expense of management regulations with a hope that, like mutual fund, which has got only one ceiling of expense of management, the companies will be in a position to pay proper rate of commission. But it was observed that companies actually, when the commission regulations are not there, they started paying much more commission than what it was stipulated in the regulations. So again, it was necessary that it should be reintroduced. I will not say IRDA had no power or authority. But they had already. So it will be reintroduced, for which a draft regulation will be drafted. It will be made open for public for comments, and the due process will be followed within, in my opinion, at least 3 months take for a regulation to be in place. So within 3-4 months, the commission regulation should be in place.
Which is why, sir, I think this is such a good time to have this conversation. And I'm sure there'll be many versions of this because it'll be open to public consultation. Industry will give its view and feedback. But I think most agree that this is an opportune time because financial markets are moving towards more and more transparency. So are products. And again, I'll draw that parallel with mutual funds. And they've gone through that process as well, mutual funds, right? Where from the commission model moved from upfront to trail. Of course, MFs are a different product. But I think with evolution, we need more clarity and transparency, even with insurance commissions. So let me ask both of you for your recommendations or your recipe. Mr. Devasia, if you could come in as well. What should be considered at a policy level now to make insurance commissions more rational and transparent?
Well, see, one of the underlying concepts of paying a commission is to reward the effort of procuring a contract, arranging it. It has to be reasonable. Now, reasonable is a very broad basket test. And that is where the whole game happens, because there's a rush for the top line. So I would believe that even conceptually, and as Nilesh already said, IRDA was always having the power to look, oversee, and even understand line of business-wise commissions. There are even reports, standard reports that are there in the 2024 version of the reform regulations. What has been awaited was actually the intermediaries regulations, which I believe will now be much more refined with the support of the government, with the new leadership at the helm of IRDA, and it will be far more objective. But conceptually, if insurance, any particular product is a push product, obviously you pay a higher commission. If it is a pull product, you might even wonder whether commissions are required or mandated. I'll give you a classical example, motor third-party liability. That's compulsory. Health insurance, it's a necessity. So these are two issues where commissions need to be monitored or have to be actually, rationalized. But there are certain distribution models that are actually, negotiating and pulling out far higher commissions and rewards, and by whatever other method of, distribution.
So let's put some numbers, sir. Let's put some numbers to this.
See,
that's the crux of the debate, right? Defining what is reasonable and rational in today's environment, in a fair, transparent marketplace where you have, digital platforms as well, selling products across the board.
Yes, they do sell, but the thing is, no one person can actually ascribe a number to it. It is actually a financial structuring. It's something to do with distribution strategy. It is a cost to the capital. It's a ratio of premium.
But do you
cannot actually just mandate a commission?
Mr.
Put a cap as it used to exist earlier. But even then, those caps were quite liberal at times, and for some, those caps were very low. There was no incentive for the agent.
So do you think, Mr.
What I'm saying is that one has to actually look at certain other distribution models that have been pulling out commissions, like bank assurance, like motor insurance providers, MISPs.
Okay.
So these are
fair enough. I get that. We're running into market opens. Apologies. Mr. Sathe, if I can ask you, what they come out from where we are, I mean, markets are bothered about the incremental change. Do you expect this to be a step change from how commissions are distributed, the quantum and how they're done? You think it'll be a big step change?
Yes, because earlier there was some ambiguity because commission regulations had commission plus rewards. I am of a view that whatever you are paying to a distributor, maybe under any name, should be considered as commission.
Got it.
And if you fix that and give a limit to it, that no payout to a distributor can exceed X percentage, it is very easy to identify who is paying more and also to have a check on if at all they are paying more.
Okay,
in the past we had commission regulations.
Correct.
Commission plus rewards.
But I think
that was ambiguous.
But I think this is what Mr. Devasia was saying, that it's not the number, but basically how you structure it. But I think here now with these regulations, IRDA will step into all of that. So everything. I mean, you can't, a commission by any other name is still a commission.
Maybe that is how the 2024 regulation actually defines commission as commission by every name.
Yeah. Okay.
So that has been already addressed.
So, but it's not being obviously implemented, right? As Mr. Sathi's
enforcement, and I believe IRDA has got the necessary clarity and the backing, on a legal platform to now actually enforce, the management of commissions.
Okay.
And effectively the management of oversight of all distribution models.
Okay, so let's look at the other side of it then. Now that we've understood that commissions do need to go down, the implementation needs to be tighter, the definition of what commission is has to become a lot more, precise as to this is what commission is, and it can't be under any other name. But there are businesses which have been built around this, and some of them also listed on the exchanges with investors. And insurance as a product, we're still a low penetration in the country. There is belief that we need to increase the penetration, increase the distribution of insurance. And this is something that the government has been speaking about as well. So do we run the risk of distribution being threatened with further tightening in commissions? I mean, is there a counter to this?
No, is it a tightening? I would see it as a rationalization of the entire structure or the approach to structuring commissions. And please appreciate, the insurers are even today left with the freedom to determine their commission levels based on the overall expense of management cap. But the logic here is, if the expense of management, let us say for a general insurance company is 30%, logically you should not expect any product or any line of business to go above 30, because that would mean that the company is printing money. So I think there's a lot of rationale that has to be built in. Yeah. And effectively, IRDA expects that every insurer acts like a self-regulatory organization. Yeah. So that supervision loads are less and commissions are fair and customers are seeing a better pricing, and effectively there are more customers onboarding.
Mr. Devasia, all of us have more questions, but we are running into market open, so we'll leave it there. Mrs. Sathe and Mr. Devasia, once again, thank you very much for joining us. Wishing both of you a very happy new year. Enjoy yourselves, and we'll speak in the new year. This is not an issue which I think is going away. So those draft regulations will come, and we'll need your expertise to decipher them as and when they come. Thank you. Well, 9-10 calls. Sudarshan is with us, and so is Mitesh. Sudarshan, what do you have?
Chola Finance, buy Chola Finance with a stop under 1670.
Chola Finance. And Mitesh, what about you?
Buy on Bajaj Auto for targets of 95.
Okay, Bajaj Auto from Mitesh. So Chola and Bajaj are the two calls. Well, MCX has seen an upgrade, and a meaningful upgrade, some 15% bump up to earnings expectations for 26 and beyond. Sudarshan is here with exactly that. I mean, you just saw this flash, right? I mean, silver going all over the place. I mean, on MCX, volumes, of course, commodity volumes, really crazy last 6 months. But go on, Sud.
It's an interesting note. Do you know, this is the first time that Morgan Stanley's target price is higher than MCX's current market price. When MCX CMP used to be around 3,000 rupees, MS target was around 1,500. When CMP had gone to 5,000, its target had increased to 3,000. And when its CMP was 10,000, its target used to be around 6,000. So this is the first time that they have given the target, which is higher than CMP. Now they have upgraded to equal weight and target. They have raised to 11,135 per share from earlier target of around 6,700. A main reason of increasing or upgrading to equal weight is the sharp surge in average daily transaction revenue that company has seen over the last 3 months. And because of that, they have raised EPS forecast by 15% for FY26, 20% for FY27, and 24% for FY28. Also, at current ADTR over FY27-28, it believes that stock may trade at 35 times PE, and that will be 5% premium to long-term average.
Okay, all right, so it got that. I think we're just a couple of seconds away from opening. By the way, Mitesh called it spot on. Today's trade is really Ferris all the way. Thanks to that safeguard duty, all your big steel stocks, JSW Steel, SAIL, Tata Steel, all of them up between 2 to 4%. So that's a clear morning trade. Let's see if it has enough volumes, but the price action surely is there.
Absolutely. Well, I think we've got market open coming up in a couple of seconds, and we'll stay with prices. And pick it up from there. So insurance in focus, but I mean, I think individually MCX, as Sudarshan pointed out, and a bunch more. So opening rates about 0.25% higher, so much better start compared to yesterday, 26,025. The Nifty Bank is up about 0.2, I think, or so. The Sensex up 0.25. Small cap index is up 1/3, and I think the mid-cap index will come up on your screen with price changes. But about 1/3% higher on the mid-cap index coming through. So that's the opening rates. We are above 26,000, and I think, of course, we are, after breaching the 40-day exponential, we are holding above it, and I think we should be closer to the little closer to the 20-day as well for the Nifty and for the Nifty Bank as well. Steel stocks up there, so JSW Steel and Tata Steel, but you got 40 out of the 50 names higher. TCS is on the other side, Mahindra and Indigo come up as well. So it's a 70-point start, higher start for the Nifty. Surabhi.
Yeah, indeed, we are above both the 50-day and the 20-day now at 26,000. Nifty's managed to climb back. And steel is the big morning trade, like I pointed out earlier. So JSW Steel, after the races, 3% up. Tata Steel, up about 2%. Remember, the safeguard duty has come back at the original level, at least for the next 1 odd year, or next couple of months at least, and then it gradually tapers down. But that's a sigh of relief for the domestic steel manufacturers. BEL is the other one that's up and about. Actually, speaking of BEL, let's pull up Bharat Forge because they won an order for these carbines yesterday, over 1,600 crores of an order. There's some green on Bharat Forge as well. Adani Ports, Jio Financial, Adani Enterprises, Bajaj Finserv. So it's pretty mixed. Some of the large cap banks are doing okay. Axis and Kotak, for instance, both have gains of about 0.5% each. Reliance is a nice support for the bulls, 0.5% up. Lever is supporting, 0.5% higher. So all in all, it's a pretty decent looking screen. 75 up on the Nifty. So getting ready to welcome in 2026 in style, it would seem. On the downside, actually, you just have a couple of auto stocks. Eicher Motor, M&M losing some ground. There's also Bharti Airtel, which is lower by about 0.5%. Other than that, it's all looking good. And we've got 3/4 of a century on the board for the Nifty. Mangalam.
Well, 3/4 of a century on the board for Nifty, doing extremely well. The broader market is doing well too. As one would imagine, global spirits on the last day of the year, a lot of these spirit names are doing well. So global spirits is up around 5%. We've also seen, as it is the wont of the start of a new year, Zydus Wellness is up 2.5%. There has been a Motilal Oswal initiating coverage on the company. Remember, this company offers a lot of no sugar substitutes or low fat, high functional products. Typically, people make New Year's resolutions to that extent as well. So the stock doing fairly well this morning. Though we've seen some bit of a decline in Hindustan Copper, though I believe that, at lower levels, Hindustan Copper has seen purchase and recovers from the low. So I'll be interested in seeing how that pans out as we move forward. HFCL is up around 3.5%. SAIL continues to do well. We've seen some decline in, PB Fintech. It's not been a good week for them, down 3.5% for that stock. Federal Bank is the other one, which is lower today at the open. And 361 WAM is another stock which is down by about 1%. All in all, more stocks advancing than the number of stocks which are declining.
Okay, I think 1670 stocks are higher and about 650 stocks are lower. This is still, early days, but that is what's coming through. What else, right? And the KPI Green, maybe a few other names, is coming up with large volumes. It's up 5% right now, KPI Green. Orient Tech was a big mover yesterday. I think it was circuit up yesterday, Orient Tech. It's up another 7%. There is BSC, which is coming up with about a 2% pop, so 2630. I'm just not looking at price change, but price along with volume. Samman Capital is coming up with about a 2.5% bump, so 144. There is Deepak Fertilizer. Yesterday, a few of these fertilizer companies were bouncing around 4% on Deepak Fertilizer. HEG is up about 2%. There is, I think you can go down the list, but volumes will start to fade. Viatech Vabag, I thought there was a brokerage call on this one, 2.5% higher, but volumes are not very large or anything. Shakti Pumps has fallen quite a bit from the highs, 2% on this one. Solar Industries is up about 2% or so as well. So that's the sort of overall picture, overall perspective. And I think you guys mentioned the Privy Specialty name, right?
Trade, yeah.
13% lower. Of course, that block's gone through. Hindustan Copper is down. Hindustan Zinc is down. That's, and of course, all these silver ETFs are down about 1.5%, 2% as well. But that's basically just, swinging around with respect to what's happening to the underlying commodity.
I'm very curious to know if, there are users of steel which get impacted by the higher price of steel. We are looking at some of these metal stocks do extremely well. So there's JSW Steel, Tata Steel. But on the opposite side, we do have, Eicher Motors, which is lower, M&M, which is lower, auto stocks. So I don't know whether, some of these auto stocks which are consumers of flat steel could get impacted on the negative side.
By the way, Mangalam, tomorrow we'll have to do some, pull this up and we'll do it. There's EU has this green steel regulation.
Yeah.
So steel which is made by,
in a greener
manner, not renewables completely.
Yeah.
That goes into effect tomorrow. So there is, I remember reading that we don't export too much steel. Most of the steel is consumed here in India. But for those like Tata Steel, etc., which have operations overseas, exports into the EU region, perhaps we'll have to see. We'll get some perspective on this because this is, of course, a broader issue. A lot of steel factories in China have been converting this, going into in preparation because they're large exporters into the EU, etc. as well. So that's the other thing.
By virtue of my conversations with Sonal, who tracks the climate space very closely, she's been saying that this will be a bit of a concern from an industrial standpoint as well. Yeah.
I just want to point out that one of the reasons why you're seeing these big outsized moves on steel counters here today is one that there seems to be an immediate shift. So from the non-ferrous trade, people are quickly hopping onto the ferrous trade. And the other is that the safeguard duties that have been announced, it's not only for 2-3 months. Now there's a very clear roadmap. So the duty stays at 12% up until the end of the current fiscal, that's 31st of March, 2026. The next entire year, it stays at 11.5%, so tapers down from 12% to 11.5%. And then the following fiscal, FY28, it comes down to 11%. So there's a lot of clarity now in terms of how the duties are going to play out. Of course, the government could come out with tweaks as and when it feels necessary. But for the time being, this seems to be the indication. So fair amount of clarity on steel names. But I think we have our next guest now joining in.
Yeah, Vineet Sambre is head of equities at DSP Mutual Fund. Vineet, season's greetings and let me say this at the outset instead of the end. Happy New Year 2026.
Wish you the same, Prashant and the team.
Vineet, 25 was not a great year here in India, but it's been a great year for many other markets around the world. Hope is that things will turn for the better here. While we wait for triggers and things to happen, do you think time correction wise and price correction wise, valuations are now reasonable, or you think that still is the number one headwind in that sense? What's your sense overall, Vineet?
So I think, Prashant, this is I think you've hit the most important aspect, which is the market's valuation. And I feel that, the headwinds which we faced last year, 2025, was very unusual. In a way, we had all the global uncertainties. We had, we ourselves going through a bit of a slowdown where corporate earnings actually did hit a low patch. But despite that, we've not seen, if we just look at the aggregate valuation at the Nifty level, we've not seen as much correction as we faced the headwinds as far as the macroeconomy is concerned. And while the macroeconomic economy now looks okay with whatever the government has done in terms of the reforms, the interest rate coming down, maybe the corporate earnings also should start gradually limping up. But in terms of the valuations, I don't see that there is a great margin of safety to start maybe looking at in a big way. There are two ways to think. Either the valuations become really reasonable for one to start looking at from absolute investments perspective, or maybe there is a clarity in terms of the earnings catching up momentum. So I think these two need to get sorted before we see clear directions for the market, at least for the 2026 is what I feel.
What are appearing as attractive bets right now for the next year?
So, I think the bets doesn't change. The year has changed, but I think from the overall, if I just take the top-down perspective, interest rate beneficiaries are the ones which comes to the top of my mind. And from that perspective, the lending institutions and more prominently the NBFCs is something which will see the benefits of the interest cost, and that's where one pocket which I think should do well. Beyond that, I would imagine that one has to look at some cycle recovery. I was hoping for a consumer-oriented beneficiaries as well because of the reforms, the disposable income going up. But consumer sector as such is actually going through a lot of disruptions. So one has to be very, very selective and careful because what used to be very dominant franchisees across the board, I think they are facing a lot of threats, both in terms of competition or in terms of the online presence. So I think there one has to be more selective. In terms of the cycle recovery, I would say power sector went through unusual slowdown because of the extended monsoon. So there, I believe one can see a turnaround. And one more space which I am actually positive on is the agrochemical space, because that's one space which has again got affected because of the unusual season. And the stocks are actually trading quite cheap in a way as compared to the history. So I think that's one space to sort of focus on.
Vineet, hi. Great to be speaking with you, and season's greetings to you and your team and all at home. Now, you're someone who's been a specialist in picking stocks in a debate which rages in this market between whether there is alpha or no alpha. Is it the time to go passive? You're someone who's excelled at picking those hidden gems and those opportunities, right? So therefore, my first question to you is this. Whether 2026 will see a pivot back to the mid and small cap market or not, because if I was looking at the fund positioning at your end, so if you look at the DSP Flexi Cap, where the fund manager has full freedom to move on whichever side, you guys are still more large cap oriented. 60% of that fund is large cap, 40% is mid and small. So therefore, are you entering 26 with the same sense of caution that it's going to be a large cap driven market?
See, actually, while these are the debates which keeps happening, but at the time of building portfolios, it all finally boils down to what companies are eventually going to deliver outperformance. And from that perspective, the differentiation between the large, mid, and small doesn't remain as much as we think from the top-down perspective. But broadly, if I have to think, 1 or 2 years can be really differentiating in terms of whether large caps outperforms or mid caps, small caps outperforms. But if one actually just pulls the period for a longer term, I believe the small and mid caps in India, they have good potential to keep outperforming the large caps. Now, while I say that, last year was not great relatively for the small caps as compared to the large caps. Maybe this year also it could underperform, but I'm saying that I see a lot of opportunities, like you said, by looking at the companies bottom up, that the companies will do really well over the course of next few years, and that's where the confidence of the small and mid caps doing well. So I think one has to maybe be rational around how to balance, because the timelines is something which is very difficult to predict.
Let me also ask you a slightly more academic conversation this morning, but let me just pick your brain on this. The other trend that at least I've noticed as someone reporting on the market for so many years is that mid and small cap investing has also become very trend oriented. When the trend is in your favor and when that particular theme or sector is the flavor of the market, stock prices can go through the roof. I mean, multiples can expand to 100 PE at the blink of an eye, right? And then when the sector starts derating in a matter of sometimes months, if even not even years, then the drawdowns are equally sharp. I mean, EMS is one example of it. We've had so many other renewables as a theme. When the theme is right, stocks will run, then they'll crash. Same for these platform companies. So is this the nature of the beast? Is this the kind of high volatility that you just have to live with? You have to trade the trends and time them right if you want to invest in mid caps and small caps.
So I think I still believe that in the end, long-term fundamentals will matter. But I think you're right. We are also observing that the last few years has been very different. And there are two components to it out here. So one is that the classification, especially as far as the mid caps are concerned, you have those 150 stocks to sort of work with. Now there are the diversified funds which are also looking at the mid caps as a universe. Mid caps themselves are looking at the mid cap as a universe, and at the same time we had this new set of investors who are still, this financialization of saving which is taking place is pumping in so much money into the funds. So I think there's a chase for the near-term momentum, and wherever the earnings are seems like inflecting upwards or downwards at both sides. That's where we are seeing the flows also actually moving up and down. And I think you can maybe do some small research whenever the stocks move out of the mid cap and gets into large cap. That's where the the rally halts in a way, despite maybe the earnings performance being there. So which is also a factor where the fund flow also matters a lot. So I think these momentum bit is actually going to be part and parcel of the short-term trades maybe, and the markets are more right now aligned to those moves. But I think in the long term, eventually what will matter is that durable earnings and the competitive business are going to sort of outperform is still the belief I have.
Yeah, and forget mid and small caps. That's happened in the large cap space as well, right? Trent would be an example of when the market loves you, it really loves you. When it wants to forget you, well, it just moves on. But I guess that's the nature of the beast, and that's
that's life.
Yeah, at least in the Indian context, I think because of the demand-supply mismatch, like Vineet is also saying, it's something that we just have to learn to live with.
Yeah, and it's also a function. There's no direct correlation here, but there's perhaps could also be a function of the way hype is generated on social media, or all forms of conversations that people have, because every aspect of conversation is magnified because of more people speaking about it, and then timelines are narrowed as well. But let's go back to the basics. Vineet, you've liked the IT spaces. It's a contra buy for you, so to say. You've been a contra positive here. Some of the mid-cap names, and then very recently we had that big deal with Coforge as well. What is your thesis on the IT space, and if you can, say something like a deal that Coforge did?
See, first of all, I continue with my sort of positive view, and it's more also linked to where the valuations are for the sector. As compared to most parts of the market, we've seen that, the sector is actually pricing in some of the big risks which we are talking about. Risk being the uncertain environment, risk being the poor deal flow, risk being the AI trade which is happening globally. So now I believe that these risks are well priced in the stocks. Last year 2025 the IT sector has underperformed. From that perspective, any change in the outlook globally can lead to a turn in the sentiments, and also the outcomes could be good. As far as the likes of Coforge is concerned, I think broadly for the IT sector, companies will have to go for investing into new technologies. They will have to adopt. Otherwise, I think I see a risk of companies also actually shrinking in terms of their overall outlook going forward. So I think companies which are actually taking that call, I would want to sort of give them the benefit of doubt. Only thing is that they have to be rational in terms of their pricing, what they are paying. They have to also, if somebody is paying a higher price like what Coforge did, I think they have to justify by way of showing high growth going forward, and which I think the management there has demonstrated in the past, which is where we still want to give them the benefit of doubt. Now, acquisitions generally have not been great. If you look at the history, 70% of the acquisitions fail. So that is there, and hence I think the companies will have to be extremely careful in terms of their due diligence and go for it. But I think there's no escape. They will have to invest. Just giving money out as dividend will not serve the purpose in the long term, is what I feel.
Again, Vineet, just going back and looking at the portfolios, obviously you love banks and financials. That forms a large chunk of many of the DSP funds. There's IT that we've discussed. And actually, at least in the flexi cap, I see less exposure to capital markets. So let's actually talk about financials, Vineet. How much of the good news and the excitement, pickup in credit growth, improvement in margins, how much of that is already priced in? Because financial stocks have rallied 15% to 50% in some cases this year.
By the way, if you just look at the 2025 returns, ICICI Bank has not given any return. It has been flat. So I think all what we speak about the credit environment changing, I think the large banks have really not outperformed as much, and maybe there's space out there to see not very high growth, but at least linked to the credit growth in the system this year, and maybe the asset quality benefit should also be there for the banks. But I think beyond that, I feel that the banks which are, or the NBFCs which are actually trading at let's say slightly higher valuations, it's on the back of high growth. Now, as I see the environment, I believe the lower cost of funds should benefit the NBFCs more. We had the current event where the foreign investors have also invested in the NBFCs. I believe that they will continue to show high growth. They will be beneficiary of low cost of funds, and hence the premium valuation should sustain out there. So I think a combination of maybe a large bank, a couple of NBFCs, sectors where one could see inflection going forward. And NBFCs focusing on those. I think it's a good way to look at the financials in that format.
All right, it will be very interesting to see if there is any change in the competitive dynamic out there with the kind of FII flow that has come in the large NBFCs as well. One of them which has been surging right now is Shriram Finance, up now 71% in this year itself. Vineet, hang in there. We'll ask you your views on some of the commodities space as well, if you have a thought here. Sudarshan joins in on steel safeguard duty, because that's the big story of this morning. JSW Steel now around 4.5% higher. We've seen a big move across the steel space. Sudarshan, it's definitely a positive, and a big one at that.
It's come as a booster for the sector which was already in the focus over the last few days. tracking global metal prices, and that have been moving higher. If you remember, in the April of 2025, DGTR, that is Director General of Trade Remedies, had announced temporary safeguard duty, and that was applicable for 200 days. And it expired in the early part of November. Now, finally, government has come out and imposed safeguard duty to protect the domestic industry, which was facing basically from the imports, higher imports from China, Vietnam, and other countries. Now, this safeguard duty would be applicable for next 3 years, and it would be effective from 21st of April 2025. So in the first year, from April 2025 to April 2026, the duty is of 12%. After April 2026 to April 2027, that duty comes down to 11.5%, and from 2027 to 2028, that comes down to 11%. So overall, after the temporary safeguard duty for 200 days, now this duty is being imposed over 3 years. That's the reason you are seeing a big move in all the metal names, especially steel companies. Top Nifty gainers, JSW Steel, Tata Steel, JSW Steel up more than 4%. Similar move is being seen even in the mid-cap names.
All right, Sudarshan, thanks a lot for that. So big moves on all the steel names. I'm not sure, Vineet, you actively invest in commodity cycles because that's not your typical style. But do you think because of higher input prices, some of the users, you've been liking autos, auto ancillaries, etc., do they stand to get impacted negatively?
Yes, surely I think they will be impacted because both the ferrous, non-ferrous commodity prices have been going up. But I would continue with my positive view around the auto anchs because I believe the changes which are taking place in the auto sector is significant, and I think that auto anchs are the best way to play that. And auto anchs are just not a way to play what's happening in the auto sector, but if you look at a few of the companies, they've also started getting into the adjacent categories, and that is linked to their engineering skills. So, some of the companies are now, tied up with Apple to be supplying to the Apple ecosystem, and that can be a very big opportunity going forward. So, I believe overall auto anchs, the next course of 3-4 years should be a good proposition. And given the fact that even within the auto sector, this whole transition from ICE to EV, if that actually catches up, a lot of companies have also aligned themselves to serve both the categories in a way. So I see a lot of change in the sector, and these companies to be beneficiary out of that. Now, this commodity pricing could be near-term headwinds for a while, but given the opportunity and the growth prospects, I would continue to have a positive outlook there.
Okay. All right, Vineet, we'll wind up the conversation on that note. Thank you so much for joining in. And once again, wish you and your team, everybody at home, a very, very happy New Year. Thank you for joining. Well, with that, let's move on and put the spotlight on Blue Star. That's the next company on our radar. Now, it's been a tough year for the room air conditioning business, overall for the air conditioning business, because of unseasonal rain for the better part of 2025. In fact, this is something that Blue Star has already acknowledged during its several quarterly calls, saying that in all probability, FY26 is going to be a flat year, but this is not a structural issue. It's a cyclical factor that's played out this year. So let's understand what the latest trends are like. We have with us Mr. B. Thiagarajan, MD of Blue Star, joining in. Mr. Thiagarajan, thanks so much for being with us. Season's greetings to you. When I say season's greetings, I don't know how it sounds. I mean, when I talk to a company in the business of air conditioning, right? Because the season was really not in your favor this time around. We have a couple of points. I'll just put that on the board for our viewers as well to define the conversation. Obviously, we want to figure out where the whole air conditioning cycle is going. Is there hope of a better 2026? So we want to understand what the inventory position is like. And really, in terms of the various segments of the company beyond unitary cooling products, how the other segments are likely to fare. So, Mr. Thiagarajan, I come back to the season's greetings and hopefully wishing for better seasons ahead for the air conditioning industry as well. But really tell us, let's pick up from our last conversation where you told us, and you're always as candid, that it's very difficult for the second half to make up for the losses that we've seen in the first half. So are you still at that same level of guidance at best case in terms of top line, this will be a flat year? Or has there been some growth post the GST cuts?
Good morning, Shilpi. It is always a pleasure interacting with you. Season's greetings to you, your audience, your colleagues in CNBC TV18. Never in the past 5 years, it was a COVID year. One wanted the year to end faster. So I am looking forward to this 2025 ending as early as possible, a few hours away. It was a bad year. It was the poor summer season. There was a GST blackout and inventory pileup. And the good news is November, December has been good. You could see the movement of goods both in primary and secondary sales. And one look forward to the summer season, which should set in end of February. So that's about the room air conditioner market. And even if it is going to be flat or, let's say minus 5% compared with the previous year, we are comparing with a year which was an exceptional year, FY 25. But CAGR, if you look at it, even if it is FY 20 to 25, FY 23 to 25, it is above 19%. So I am not worried about the demand that is going to be there and the prospects for the industry.
Yeah.
It is that it was a bad year.
So actually, what you're saying, and I don't know if you meant that for Blue Star or for the industry, if you're saying that the room AC business will end 5% lower, that's actually better than what you had said earlier. Earlier you said it could be as low as 15% this year. That's for Blue Star, right?
No, I'm talking about the industry growth. I'm talking again end March 2026. There is a possibility that it ends with -5 or flat. It all depends on how the summer demand is going to be. But equally, as I mentioned, that it can be even -10%. We don't know. But the important point I'm saying is that it is compared with the FY 25, which was an exceptional year. Unprecedented growth was there, over 35% for the full year. Summer season alone was over 55%.
Yeah.
So therefore, the CAGR is maintained. And given that never in the past two summer seasons were washout, I think it will go on well. So I look forward to FY 27 in a big way, or the summer season 2026 to be a good season.
Yeah. Mr. Tyagarajan, good morning and season's greetings. I'm going to talk about something which is like forecasting the market, forecasting the weather, which is our colleague Manisha, who has a close eye on all things weather and commodities, tells us that this is a La Nina phase. Now, I'm no expert, but broadly what it suggests is that it's basically cooler temperatures, cooler winter, and maybe extending all the way into April, June of next year. Slightly more cooler temperatures. Isn't that the sort of peak season with regards to build out of for the AC industry to meet that summer demand? So would you expect these conditions to affect FY 27 numbers as well? I mean, if this were to persist, what's your sense?
I have talked about this. It's not the real temperature that matters. It is the humidity, and even if it is above 35 degrees centigrade, one would like to be in an air-conditioned environment. And you are used to air conditioning in a metro railway or a bus or a car or in the office or in the shopping mall, cinema theater, restaurant. So this category has to grow. We are talking about a 35,000 to 40,000 rupee product, and the penetration levels are lower. So I don't think it has to be a long summer of 45 degree plus, etc. We have seen in the past, all that it requires is 2 to 3 weeks of discomfort.
High humidity. So just to understand that from an inventory perspective as well, you said that inventory has started getting cleared up in this November-December period. So typically, what is a normal inventory cycle or a normal inventory level for you? And as opposed to that, where is the situation now? What is the situation now?
From a manufacturer point of view, 45 days would be an ideal inventory, given that it is an Indian manufacturing ecosystem and the component ecosystem is good now compared with what it was 4 or 5 years ago. That in Blue Star's case, it was crossing 60 days. And I think by end of December, we should get there to 45-day kind of inventory. In any case, there is a energy label change which will come into effect midnight today, which means you have to either relabel the product or you have to liquidate that. But in the market, my estimate is that till around end of February, there will be enough inventory available.
Right.
If the summer sets in, then the new energy label products should begin to move.
Mr. Tyagarajan, we've spoken a lot about air conditioners and how this year has been terrible for them. But one category, which was the category of this year in the consumer durable space, was air purifiers, because we saw a big jump in air purifier sales, as we saw a big jump in deterioration in the quality of air as well. How much does that account for in your overall pie this year, and how do you expect the dynamics of that category to change over the next, say, 3 to 5 years? How big is the opportunity?
Good morning, Mangalam. It is negligible. The total market size is less than 500 crores. And it's basically two cities, Delhi followed by Mumbai. And there is all kinds of products exist there. There is no certification of a product that how do you know this air purifier is going to be doing what it is supposed to do. Starting from some 6,000 rupee onwards till 50,000 rupees air purifiers are getting sold. It's not going to make a big difference at all. The room air conditioner is the largest in a complete air conditioner. It is much larger than even commercial air conditioner.
Right. And finally, in terms of competition and market share, well, the industry was under pressure all of this year. Have you held on to your market share? And what is it that you're targeting for the next year?
We have improved our market share. While the growth has not been there, we have improved our market share. And I think as the market begins to grow again, you will see intense competition, and I think that is inevitable. You need to compete. You have to deliver growth. You have to deliver the margins. And it is going to be intense competition. There is no doubt about it at all.
Can you give us an FY27 outlook in terms of revenue, margins and market share that you're targeting before we let you go?
So if I'm talking again about room air conditioner. If you compare with the FY26, it will be exceptional, but that is not the way to compare. Internally, we would like to compare with the FY25. And over FY25, if a 15% growth one delivers, it will be exceptional. And the margin should get back to margin outlook of 8 to 8.5% in room air conditioner. That should happen. And as you are aware, the B2B products, whether it is projects or commercial air conditioning, it was again a bad year. The order inflows were not that great. Only the factories and data center segments supported us. The large projects, there have been inordinate delay in closing causing concern. So therefore, FY26 should be good for that business also. That's what I'm hoping.
All right, FY27, 15% growth over FY25 with margins between 8 to 8.5% for the room air conditioner business would be something that you are targeting. Let's see whether the weather supports or not. You are holding on to your market share.
One thing, Mangalam, is absolutely clear. And I just want to say that, Mr. Tyagarajan, I think if you look at long-range forecast, right, number one demand for energy is cooling.
Yes.
I mean, there's no doubt. I mean, in India, globally, I mean, I think air conditioners play an important role. But since we are doing this and having this conversation, slightly near-term focus with regards to hotter, cooler summer, etc. matter. But that's in the very near term. Thank you very much, Mr. Tyagarajan. Really appreciate your time and wishing you a very happy and prosperous 26, sir.
Same to you, Prasad. All the best. Thank you.
Okay, we'll take a quick commercial break here and we'll come back and we've got an interesting discussion lined up on the jewelry space, and the rise of the lab-grown diamond industry. One of the largest jewelry organized jewelry player in the country now, stepping up their game there. So it's an interesting discussion with two players in the space coming up on the other side. Stay tuned.
Well, it's been a good start to this ultimate session of 2025. The consumer stocks actually doing well. We have HUL, which has moved higher, Asian Paints is higher, and none higher than Titan, which has actually moved to the highest point of trade after it's announced. In this month itself, the stock's done well. It's closer to its record high than ever before. It's over 4,000 rupees. It's announced its foray into lab-grown diamond after a very long time. Here on CNBC TV18, we've been asking the management for many years, and they've said that they're looking at this market very closely, but they didn't make any plans public until December 29th, where they launched their first store, Beyond, in Mumbai. Managing Director Ajay Chawla told CNBC TV18 exclusively that he expects to close this financial year with a few more Beyond stores. And how will this impact other players in the industry? How will this impact the industry itself? We're joined by Ishwar Iyer, who's the CFO at International Gemological Institute. Basically, this is a company that certifies lab-grown diamonds, the leader out there. And Prajay Maganlal, who's the CEO at Elevate Lab Diamonds as well. Prajay, let's ask you, up until now, lab-grown diamonds were looked at as a child which wasn't loved as much by the parents, but loved a lot by their friends. So consumers loved lab-grown diamonds, but the large players were still looking at it with some sort of skepticism or something that may eat into their own overall business as well. Now with Titan actually finally shaking its hands with that child and saying that we're part of this, we're in this together. They've opened this, and the largest player, the most trustworthy player enters this space. Do you think it gives it a little more legitimacy than what it earlier had? And what does this do to the industry according to you?
Well, Titan entering the industry, right, provides institutional validity. It tells us that the market has now reached the stage of maturity where big players are getting involved. And Titan has actually been giving signs that they're looking at this industry pretty closely over the last 1 year. Malabar is doing the same. Number of other big players are doing the same. So I see this moving forward as a market of segmentation and choice, not really of disruption. There's absolutely going to be space for both natural and lab-grown, and Titan getting into it just proves that.
All right. And what does that mean for your volumes? Ishwar, I have to ask you that in terms of tests. Have you, will you be participating in testing some of these LGDs for Titan, or will they buy LGDs from people who you've tested for already? What does that do to a business like yours?
Well, good morning and thanks for having me on the show. So of course, we've been talking about this over the last 3-4 quarters in our analyst call, etc. I think we continue to maintain that IGI will be certifying diamonds. So we are a neutral body. we are a third-party independent grading body. So, and we've also mentioned this in the past that the lab-grown segment is the new entrant for the industry. And the lab-grown jewelry segment is starting to see some serious growth in India. I think in line with those industry trends, I think there are a lot of larger players now coming into the field. As we've spoken in the past, I think the lab-grown segment was first adopted by the US consumers. And as the Indian consumers also come into the fray, I think we just at the start of a very, very big cycle as far as lab-grown jewelry demand is concerned, as far as the Indian market is concerned. So obviously, IGI is well positioned today to manage this diverse portfolio of grading services that we provide.
Right. So, just go back to what we were speaking with Prajay. Prajay, what is the total sales of LGDs in India right now as per you? And with Titan entering it, the mature market, do you think it can accelerate the demand? And what does that do to prices of natural diamonds?
Sure. So just a few numbers, right? Today, diamond jewelry makes up about 10% of the Indian jewelry market. LGDs within that space, till just a few years back, were about just 1% of that market. Today, LGDs have moved to about 3%. So they're roughly around $300 to $400 million is the lab-grown diamond jewelry industry here. With Titan entering the market and with other larger players entering the market, we are going to see about a 25% CAGR over the next 10 years. Easily moving to, say, about 3 to 10 billion in lab-grown diamonds itself, because we see lab-grown diamonds moving to about 10% of the market in about 10 years. If you just take the trends from the US, right, in 2018, just 2% of engagement rings had lab-grown diamonds, whereas today it's well over 50%. And the US market is structurally different, where they have a hero product in engagement rings. About 50% of the US jewelry market is just made up of engagement rings. And when you say there's a larger chunk of lab-grown diamonds taking place, that's a huge cultural shift. We see India getting trends about 2-3 years later. And the Indian lab-grown market is already booming. We're seeing it in terms of customer choice. We're seeing it in terms of design philosophy. And with big players entering the market, that just proves that lab-grown is just here to grow now.
But do you think that lab-grown in India will be different in consumer behavior than what it is in the US? Because jewelry purchase in India itself is different versus what we've seen in the US, etc. We buy more for value reasons than adornment.
Absolutely. If you look at the two reasons why natural diamonds were so popular, at least in the past, one is it was a social and financial flex. If you wore a 2-3 carat natural diamond, that proved that you were someone in society. It also was a pretty good hedge against inflation, which consistently outpaced or even beat inflation in many years. Both those things don't hold today. With the larger share of Gen Z moving into the market, with their philosophies changing, towards more responsibly sourced, sustainably and ethically sourced diamonds, they also want to adorn themselves with a far wider range of diamonds and gemstones. We're not just talking about lab-grown diamonds here. We get lab-grown gemstones, colored gemstones. India has such a rich history of colored gemstones, but today it's just 2% of the jewelry market. Whereas in America, that's actually moved to 10 to 15%. We are seeing a kind of explosion in terms of design philosophies, in terms of product outcomes that just weren't possible with natural diamonds because of the high cost. So it's completely turning the market on its head. And I just see it growing from here because of all these changes.
Have the prices of natural solitaires moved over the last year or two?
I'm sorry, I didn't get that.
How have the prices of natural solitaires moved over the last year or two?
Oh, natural solitaire prices have plummeted about 30-40%. I think Ishwar may be able to correct, but I think it's about at that number.
All right, Ishwar, I'll ask you a little about natural as well. And this could, I don't know how this impacts you, because Titans, apart from announcing this lab-grown foray, they've also gone all out in natural diamonds, saying that, the new Tanishq stores have a natural diamond purity meter, quite similar to what they had done with the carat meter when they had first launched. That was an industry disruption. And now everyone's looking at the carat meter as a necessity before they go ahead and buy gold. So do you think this could be something like that? And if Titan were to do it, why would anyone come to IGI?
I think there's an important aspect that we all need to consider in terms of an independent certifier. I think IGI plays that role because there's obviously a need for segregation of duty or, as you say, avoid of conflict in terms of the certification of diamond goes. So as an independent body, I think the need for an independent body to continue to grade diamonds is an important aspect of the entire industry, the way it functions today, in terms of providing that sort of sanctity to the final consumer who's buying this product. So from that context, I think the need for an independent certification will continue to exist well into the future. But having said, just to add to some of the points that was mentioned earlier, I think there's also an aspect of prices of gold and silver, which have really moved up over the last 6-8 months. Lab-grown with their pricing at the moment provides that a balance from a budgetary standpoint for consumers to therefore participate on a larger scale as far as purchasing lab-grown jewelry is concerned. I think there are a lot of dynamics that is currently at play in this industry in terms of the way prices of gold, silver have moved, etc. And therefore, the lab-grown segment therefore has the potential to really leapfrog over natural diamonds in the future.
All right, we'll take that and also see how that impacts your overall business, because realization is lower in lab-grown for your testing, while the volumes are a lot higher. Will that offset each other for your business to sustainably grow, basis your guidance? Something that the street will keep watching out for going forward. Prajay, last word. With Titan entering, how does that change the supply side dynamics? Yes, demand, we understand, can grow about 20-25%. Earlier in the past, there were reports of oversupply in the lab-grown business. Do you think with a larger player entering here, that gets mitigated a little bit?
I think there is a tremendous supply, and especially with the high tariffs being put up by the US, that actually reduced prices quite a bit in the last, say, 2-3 months, because a lot of the supply that was going to the US today is now being flooded in India. So I absolutely don't see Titan entering the market putting upward pressure on prices. There's plenty of supply to go around.
Okay, all right. Mangalam, so you're buying a diamond or no?
Natural lab-grown, anything.
Lab-grown.
I'm sure people at home wouldn't mind.
It's of no use to me, to be very honest.
I'll tell you, tomorrow is the first, right? So come in with some bling.
Yeah.
Come in with bling.
Buy with one of those chains with some.
Look like a rap singer, maybe, I guess.
Gentlemen, thank you very much for joining us. Good speaking with both of you. Very interesting and fascinating discussion. Wishing you the best for 26. Appreciate it.
Yeah, best wishes for the
Sparkling
year.
2026.
Thanks for having us on, guys.
All right. Well, Nagaraj Sethi is with us for HDFC Securities with a quick word on the market before we go any further. 55 points up, so 25,990. Nagaraj, what would you recommend? Indices, stocks, both?
Yes, good morning, Prashant. Yes, Nifty found some support around 25,800 levels. The higher tops and higher bottoms on the daily chart is indicating there is a possibility of buying emerging at the lower levels. And the overall near-term chart remains intact. We are moving in a range at the higher, though Nifty facing stiff resistance around 26,200. 26,300 odd levels. At the lower levels, consistent buying is coming, which is indicative of higher tops and bottoms on the daily and weekly charts. So market is preparing for a base, and we could see Nifty sailing towards 26,300, 250, 300 levels in the near term. And I have two stocks to discuss. First one is from the PSU banking side, Indian Bank. Chartically, Indian Bank has been moving in a range-bound action over the last couple of weeks, and since yesterday it has broken out the range. The overall chart pattern is looking positive, currently trading around 824, 825 levels. One can look to buy at this point of time. 875 is going to be the immediate target. One can place a stop loss at 790. And the second one is Industover. Industover has been in a constant uprun over the last many months. The larger degree chart pattern is indicating a strong bullish bias for the stock price. Currently showing a consolidation moment at the highs and expected to break above the consolidation moment. Currently trading around 425, 50, 426. One can look to buy at this point of time. Initial upside target would be around 450, 455 levels, and one can place a stop loss at 415.
Okay, all right, Nagaraj, we'll leave it on that note. Thank you very much for all the trading ideas for now. By the way, the Midcap market is doing really well. The Midcap index is up 0.5%. outperforming the Nifty quite nicely. So it's so far so good on the last day of 2025. Let's do one thing. We'll take a break, come back with the commodities on the other side. We'll ask Manisha about all that sparkle and all that volatility in the precious metals market.
Fly Emirates, fly better.
Well, it's the end of the year and we are finishing it off in style and sparkle. You just heard that discussion on lab-grown diamonds. Now, whether they're lab-grown or natural, you need to embed them in some precious metal. And those metals have been driving everybody really up and down all over the place. Let's go to Manisha now. Manisha, my goodness, again, 7% down, 5% lower, then 7% higher. What's the latest now?
This is not looking like an year-end at all, the way the markets are moving. But just because you were talking about the diamonds there, if you look at the natural diamonds, the smaller category, that prices have declined by 10% in this year. And the lab-grown prices have declined by 22% in this year. Is the reason people are not buying so much gold and silver, but they are buying studded jewelry, which has, diamonds of whichever kind into that. But we'll talk about commodities that are actually traded. And I want to start with crude oil prices because this is the only one that has seen a very sharp decline. It's the biggest annual decline since 2020 coming in for the crude oil prices. And we are down by 18% in 2025. 2025 actually is the third straight year that you have seen a negative return come in for the crude oil prices. Well, it is supply glut, which seems to be overweighing the geopolitical tensions in the global markets, and that has kept the prices in check and in the negative there. Now, let's talk about the positives. And yes, today, even as it is 31st of December, you have seen big moves come in for many of these commodities. I'll start with copper, and we are trading at near all-time highs in US, on London Metal Exchange, in Shanghai, and in the Indian markets as well. So when you look at the copper prices, we are up by 45% in 2025, and this is the best annual gain that you have seen since 2009 come in for copper. Take a look at aluminum, and that one is trading at a 3-year highs. We have seen 17% of gains come in for aluminum in this year. Zinc is up at a 1-year highs, and 5% of gains is what it's given you in 2025. Let's talk about the precious metal prices now. And well, yes, the CME margin hikes do kick in today after business hours, so that they come in force from 1st of January. So it's not really going to be a holiday because you will see big price moves continuing there. Silver is up 162% in this year, best annual gain since 1979. Gold is up 66% in this year, 53 record highs in this year, and the best year that we've seen since 1979 as well. Take a look at palladium prices. We're trading at a 3-year highs onto this one and 73% gains here. Platinum prices have hit all-time highs in this year, and we are trading with 123% gains in sense of platinum as well. I mean, show me in equity markets and other asset classes, and you haven't seen that kind of a move come in the way we've seen in precious metals there. I also want to talk to you about soft commodities, and they haven't done well, and it's the reason that you weren't worried about the inflation part of it, because rice is trading near 8-year lows in the international markets. It's a 32% of a decline. Cotton is trading at a 2-month highs, but with the kind the year has gone by with higher surpluses in major producing countries, it's down by 6%. You have rubber, which is trading at an 8-month highs currently, but that also has seen a 7% decline in this year till time. And then the declines just about continue, because when you look at the sugar prices, well, that is trading at 2021 lows, and we have seen 23% of a decline come in for the sugar prices. Soybean is the only one trading on the higher side there. But when you look at the coffee prices, we also have seen a very erratic year, but 10% of gains in coffee is how we're closing this year. So that perhaps is what your leeway is from 31st December to 1st Jan.
That's not bad. In diamonds down 10%, coffee up 10%. I think we can deal with it. But yes, the precious metals rally has been the one that's absolutely breathtaking. Thank you for that, Manisha. Well, with that, we will take a very quick break. But on the other side, we get to discussing one of the biggest themes of 2025, data centers. The boom is well and truly underway here in India. Whom does it benefit? What is the kind of build-out we're talking about? And where is the investment opportunity? We'll discuss this with Amit Sareen of Anantraj and Darshan Hiranandani of Yota Data Services.
You want to talk business? Meet me in the Onboard Lounge.
Okay, welcome back. India's data center capacity is set for a massive surge, projected to expand nearly tenfold by the end of 2030. What's driving this explosive growth? Who stands to benefit the most? Winnie is here with some perspective, and we dive straight in after that into a very interesting discussion. Winnie, take it away.
Right, thanks for that. So India's data center sector has marked 2025 as the breakout year. Capacity expanded from 0.5 gigawatt in 2020 to 1.6 gigawatt in 2025. Fueled by 30 times the data traffic rise since 2017. 900 million internet users also came into India, and AI usage started increasing. And what was interesting that made OpenAI, India market, OpenAI's second largest market. Now, in 2025, what more did we see? We saw mega investments that came in. Reliance Industries unveiled world's largest Jamnagar data center plus 1 gigawatt AI facility with NVIDIA. TCS launched its Hypervault for 1 to 1.2 gigawatt AI-graded capacity over the period of 5 years. OpenAI committed to 1 gigawatt amid DPDP Act mandates. Now, the total announcement that came in for 2025 hit $63 billion. $43 billion was ex of Reliance. So, yes, $20 billion approximately was Reliance. Now, with hyperscalers leasing 97.9 megawatt in first half itself, 48% increase over there is what we're seeing on a year-on-year basis. Occupancy at 97%. Mumbai dominating 50% share as well. Now, India added a record 30 gigawatt renewables in FY 24-25, making it third globally, enabled by cheap solar power, supportive government as well. For renewables versus other countries, how do we stand for AI data centers, which needs 5 to 6 times more energy? Now, power demand from data centers globally is estimated to grow at a CAGR of 17% till 2030. For India, it's expected at 33%. And with the US and EU power queues that are increasing there, execution timelines are increasing, there is permitting delays across the globe because of all these issues. The focus now shifts to India. India's data center capacity is projected to increase rapidly in the coming years, and obviously because of the factors I mentioned. Now, it's interesting to note that when data centers are created, 45% of it is capex cost is non-IT equipments, capex, whether you look at it like a cooling system, electricals, construction, etc., which accounts to most of the costs. IT costs come in at 55%. And India has no dearth of players in terms for equipment play, whether you look at an L&T for EPC, Cummins for backup power, there is infrastructure that is required, there are cooling systems that is required, so we have Voltas for that. Wiring, Polycab could benefit from that as well. So this will boost what? L&T, Cummins, Voltas, a dearth of companies that we have that will benefit from this as well. Now, in US, when you look at it, utilities present in the right region or even in companies which have access to electricity have seen a bigger success in the US versus other companies. In India, currently, most data centers are present, located in Mumbai region. 50% capacity is in the Mumbai region. Why? This is due to network access that is there via undersea cables. Further, when you look at it and break down India versus US, unlike US, India is one nation, one grid. Although transmission is becoming a big bottleneck similar to US, but India's data center capacity is maybe set to rise almost 5 times to 8 gigawatts by 2030. And this is according to Jefferies. Setting up 1 megawatt of data center in India requires a capex of $4 to $5 million, and hence setting up incremental data center capacity of 6.4 gigawatt by 2030 will need a capex of around $30 billion. Should create many opportunities for real estate players, electrical power systems, fit-out players, cooling systems, and network infrastructure players as well, which are among the top beneficiaries for the data center boom. And Indian telecom players, EPC players, power players, IT players, all these are set to benefit going forward with this data center boom.
Vinny, thanks very much. That's very, very useful context for our discussion now. Amit Sareen is with us, Managing Director at Anantraj. Amit, good to have you with us here. We also have Darshan Hiranandani, Chairman and Co-founder at Yota Data Services. Darshan, good morning. Great to have you with us here. As always. First up, season's greetings to both of you. And I think, for much of the industry and markets overall, I don't think we can say 25 has been great. But I think for your industry, I think it's been pivotal, at least in terms of what we are seeing globally and maybe what we are seeing here in India as well. Vinny put out some of those numbers, and Darshan, I want to start with you. There is this demand for AI compute, which needs data centers, which in turn requires power. I think every 3 months, forecasts for how much incremental spend will go into data centers has kept getting bumped up. This is what we've seen through the course of 2025. And it's a moving number, but it's always higher. So just give us your perspective. Where do we stand at this point in the industry, in the build-out in that sense? Give us a brief global perspective, and then bulk of the discussion I want to focus on India. Go on, Darshan.
Okay. So basically, India was playing 2 types of catch-up. One, we were playing catch-up on conventional cloud, which is just the shortage of data center capacity that we had for our regular compute that was stored overseas. And the market predicted that by 2030, that itself needed to go from our present 1.5 gigawatts to 3 gigawatts. Now, just to let you guys know, moving from 1.5 gigawatts to 3 gigawatts, everybody only talks about data center capex. But the point is, you can't have a data center unless you don't have computers and servers in those data centers. So just at a very high level, if 1 gigawatt or let's say 1 gigawatt, or we want to add 1.5 gigawatts of conventional cloud, that will cost 6 million of capex per megawatt. So you're talking about $9 billion of capex just needed in making the buildings with MEP. This is if we are going to 3. I'm not even talking about 6 and 9 and 10. I'm just talking about 3. Second is you need 20 million per megawatt of cloud capacity. So that we are talking about another 30 billion in capex just in your regular conventional cloud capex of regular CPUs, servers, networking, storage, some amount of software systems to enable that. So just to do our regular CPU catch up, we need around $40 billion just there in the next 5. This is without AI.
Okay, Darshan, sorry, let's just take it slowly. Lots of numbers there. What's the capacity now?
About 1.5 gigawatts.
Okay, you're saying to go to
1.6, doesn't matter.
Okay, so to go to 3,
yeah,
which is to add about 1.5 gigawatt, you're saying what's the total, everything included, MEP, cost of land and building and the servers, computers, everything? It's how much, what's the investment required?
Minimum we require around 40 billion.
Vinny put some of those numbers out, and that some of the commitments have been made in that sense, right, Darshan?
Yeah. So now let's look at what those commitments entail, right? So, for example, in some cases it is a full cloud commit. In some cases, it is just a data center commit. If it is an AI commit, then the megawattage is lower. So, for example, there's a big announcement in one of the eastern states in Andhra about a big data center complex coming there and a big hyperscaler location coming there. Now, if that is going to be used for AI, then the cost is almost 40-50 million a megawatt, right? And then if you say, oh, they've announced 15 billion of capex or announcements over the next 7-10 years to be deployed, that actually is only 300 megawatts. So when we are talking about getting to 3, 4, 5 gigawatts, we genuinely have to build these data centers, connect them, get customers, put it up, deploy the cloud, and make it all happen.
Yeah, Darshan. Sorry.
Let's look at it at minimum.
Yeah.
At minimum, we are saying that we will go to 3. We are likely going to go to 5 gigawatts by 2030. So somewhere between 3 and 5.
And the cost, I mean, data center.
The capex for that. Yeah. The capex for that will be somewhere in the order of $70 to $80 billion in getting there.
So
this estimates are, because you said per megawatt cost for conventional cloud and AI is vastly different. Is almost double.
That's only for this compute. So I would say it's around 6. Let's say. Yeah, okay, almost double, 70% more.
So the number, Darshan, that you gave us, which is roughly speaking investments of up to 60 to 70 billion dollars to build this capacity of 3 gigawatts plus by 2030. This is for, we're not talking AI enabled data centers, or does it? These are just the cloud enabled or the one step below AI data centers. Got that? So that kind of gives us a broad framework to work with. Now here's the thing. I'm going to ask the question that all investors have on their mind. This is a multi-year opportunity that I think there's no debate around. The question is, how can investors play it until the time that we have scale, and a lot of these data centers are put and packaged, say, in InvITs. Now you have REITs, so you can play real estate through that. Till we have the whole InvITization happen, people are trying to sort of move ahead of the curve. So Amit, come in over here. So construction, land and development, just creating the housing structure is one part of it on which some capex is going. But I don't know if that is the most interesting way of playing the data center opportunity. From a real estate standpoint, what's in it for you, and where do you see the value add coming in?
Usually, this is where we start. The first thing, like Darshan rightly pointed out, the first thing which we need for a data center is the land in the building.
Yeah.
But that is just the starting point, and then it starts from there. We've been working in the data center space now at Anantraj for almost about 7 years now. We started this in 2019 when our founder chairman, decided that we are going to go into this. Today at Anantraj, we have 157 megawatts of buildings which are now ready and which are now getting converted. And we have 28 megawatts of co-location already there. So the way we are approaching it, we've kept it very simple. We feel that the data center business in India is going to grow in two segments, basically. And then, of course, there is AI and there is a whole new world to it. But these two things are going to be required by everybody who wants to come into data centers. The first is co-location. When you go up to the rack and you provide the complete infrastructure, which is what Anantraj started with. And once we delivered that product, we got very good demand for it. And, based on the product which we delivered in the market, we also got demand for cloud, which is infrastructure as a service. Cloud in itself is a huge horizon. It comes, AI is one part, and then there are several other parts. But the way we looked at it, Anantraj, was we initially started with infrastructure as a service on the basis of cloud, where, of course, the investment is almost 4 times more than what you do in co-location. We did that, and today we, last year in October, we started Ashok Cloud, and we got phenomenal response for it.
So Amit, help us understand. I'm sort of going into level 2 now. From a business standpoint, basically a margin perspective, you're making investments. So what is the kind of ROI? What is the kind of margin that this business is going to fetch you? Like you said, there's the base model, which is this co-location, taking a spot on the server. And then the other model, which is more high-end, infrastructure as a service. Give us the business dynamics, the margin profile, and the ROI on both of these.
Surabhi, the ROI when you start with co-location is almost 60 to 70%. And when you move from co-location to the cloud services, which is like we just told you initially, infrastructure as a service, which is like basic cloud, there the ROI even touches almost 80 to 85%. So as of now, this is a very lucrative thing to look at. And in spite of the ROIs we are telling you, India is amongst the cheapest, both in terms of CapEx and in terms of OpEx in the world. So that is a big advantage. As of now, we are all talking about only the Indian data getting localized. As you know that how this whole data center started, the story started in our country was our Honorable Prime Minister was the first leader in the world who spoke about data localization. And today, India wants to localize its data. So as of now, we are focusing on this. But the advantages we have in India, both in terms of CapEx and OpEx, maybe after 2032, we can look at even importing data and keeping it here.
Okay. Got that. Darshan, this dire, if this build out has to happen, and globally we're actually talking about hundreds and hundreds of billions of dollars. I mean, if some of the numbers have to be believed, it's mind-boggling. And people will go through bouts of skepticism once in a while about whether this is all going to happen, etc., etc. And there is always this concern about too much commitment, overbuild. We've had, lots of these episodes earlier as well. Something changes, you realize that, well, productivity, the ROI, the realized ROI is not what you thought it was, or something like DeepSeek happens and everybody then, the cost of compute goes down significantly and you're already committed to all this investment. So things can change and these are all questions. But in India, Darshan, do you think we are, like in most other sectors, so low in terms of actual capacity that even if all of this were to play out through 2026, the industry is set for, some of these things have been locked in at least for the next 2 years, 26 and 27?
No, I certainly think things have been locked in for till 2030 because the market has just woken up. They've hit the hammer into the ground. Today, it's going to take time to deliver results. Infrastructure can't be built overnight. Servers can't be delivered overnight. Cloud systems can't be connected overnight. So that's not going to happen anyways in a hurry. I think right now, the reality is we're looking in certainly next, I'd say 3 to 4 years, we are looking in at a very good run because even global capacities today are not really coming online in a large enough scale. So there's still a lot of announcements, still a lot of contracts, but large enough capacities haven't come online. But in an India perspective, very far behind even on our conventional cloud. So there is less risk of this over build out, whereas America had reached a point where they had satiated and stabilized conventional cloud. And then the AI boom came and then they said, we want to create AI for the world. So that's what they're doing. In India, even if we just focus on the compute capacities for India itself, at the current rate of rollout, we've still got 5, 7, 10 years of it. Just in terms of ROI, I think the point that was asked, my view is maybe a little different. We are looking at typically co-location paybacks are around 7 years, 6 to 7 years is your payback on co-location. So if you consider an ROI, it's like between 13 and 14% typically. If you look at cloud sort of investments, those are much quicker because of course the servers also depreciate much quicker. So you have much quicker paybacks, much better returns, but you have a higher depreciation cycle. So you can only invest in those when you've got visibility and throughput of customers in place.
So what is the ROI, Darshan, in that case, and what's the return period?
So typically, let's say you're looking at a cloud compute sort of period. Typically, you get a full payback of the entire infrastructure anywhere in 3 to 4 years. So that's fully paid back, and the life of these servers is, some cases 6 years, some cases 8 years, but depends on what the compute is.
You know that there is a flash going, some 1 gigawatt, $6 million. That is wrong. We should take it off and correct that.
It's only of co-location.
So, sorry, what is that, Darshan?
It's $6 million is co-location cost to build out. So if you do MEP, if you do just the fit out, that's $6 million per megawatt.
Oh, megawatt. Yeah, no. It was growing as gigawatt. So no. Darshan, if you were a private investor with the knowledge that you have running Yota, where would you look to invest? Which part of the value chain?
I think currently the biggest I think the part of the value chain that's key is where you can get sector-specific data centers and you can get Indian cloud providers who are moving in scale. I think those would be two that would go really well. I think as an offshoot, on the listed side, you can create another basket of portfolio of a lot of the MEP and other players who are going to be providers to this space. I think it's going to be net positive to all of them, generator sets, MEP fit-outs, electricals. But people who have a large enough focus into this vertical would be key. I wouldn't generally say all electricals will do well, but people who are focused on data center electricals will certainly do well. That CapEx is going to be big.
Got it. Okay. Amit, from my last question from my side, are you sort of putting Anantraj out as one of those companies? Which
I'll tell you one thing I just want to point out, like one of you just mentioned about DeepSeek. I tell you, if AI becomes cheaper, our only aim is that the requirement for data will further go up.
Yeah.
Just imagine when AI becomes cheaper, there are more and more users who are going to be using it. So the requirement for data will further go up. So that is something we at Anantraj are betting on. And the ROIs I spoke about are basically of Anantraj. Because, in our case, like we told you in the beginning, 157, the buildings are now ready. So the additional costs which are increasing, that is exactly the ROIs we are earning right now. So we are fully on track, whether it's the co-location and the cloud. In the cloud, we have today no botheration about AI getting cheaper or not getting cheaper because we are simply storing data right now.
Cheaper it is, the more the data consumption. Take your point, Amit, and good to have that clarity. But every investment thesis does go with a disclaimer, the downside scenario or the risk. So, to this, what sounds like a fantastic multi-year, thesis, what could be that downside risk? Very quickly, 10 seconds each. Amit?
I'll tell you, Surabhi, right now, for the next 3 to 4 years, we don't see a lot of downside in this business at all. Okay. After 4 years, maybe let's see how much competition comes in and what all comes in. But in the next 4 to 5 years, we don't see downside, number one. And number two, the capacities we are creating and with the ROIs we are talking about, we are actually ready for competition if it comes after 4 or 5 years. But I think we still feel that the demand will still keep on increasing.
I think Darshan echoed the same thing. In India, Yeah. Sorry, I'm sorry we're interrupting both of you. Amit, my question was, so give us a sense, next 3 years, what kind of numbers should investors expect from Anantraj? Just growth rates, what you presented to investors. I think you've done roadshows, etc. as well.
Yeah, of course. See, we are already at 28. By next year, we'll be 63. And the next year after that, we'll be 117. So for this, everything is on track. 25% of what we create will go towards Ashok Cloud, where as of now, we are providing infrastructure as a service, which is the basic level of cloud, where we don't see a lot of competition coming. And it's pretty simple. We just keep the data. And the balance 75% is co-location, where we are dependent on hyperscalers, for which we already have the tie-ups in place. So things for the next 3 to 4 years in Anantraj are the roadmap is very clear.
Those numbers that you mentioned what is the 115? All that is?
Megawatt. It is the megawatt.
It is a megawatt. Okay. You'll go up to 115 megawatt by?
By 32, we get to 307, for which we have everything.
I see. Okay, got that. Gentlemen, thank you very much, both of you, for joining us. And it's a discussion which we will sort of keep inviting you for through 2026, because I think if there is one area where there is large amounts of investments going in globally and in India, it is data center capex. Amit and Darshan, great to have both of you here. And once again, wishing each of you a very happy 2026.
Thank you, everyone. Thank you.
Thank you. Thank you so much. Thank you, everyone.
Okay, I think, well, that gets us, guys, to the last bazaar of 2025. I want to say 2026, 2025.
No, 25.
Don't worry, we'll be back with the first bazaar of 2026 just tomorrow.
And Surabhi, for you, last bazaar for now.
Last bazaar for now. I won't be there for the first bazaar of 26, but I think this discussion was a very sort of good one to end on for me, because it's all about digital, it's all about disruption. So going forward, I think I'm going to go back to some experimentation with what I call the OG digital business news brand that this country has seen, and that's money control. So more experimentation, more disruption, figure out newer digital formats on the other side, but right around the corner.
Right around the corner. So what we'll do is we'll wrap up on this edition of Bazaar on that news, and stay with us because a lot more updates on your way. Market above 26,000 in the first half hour of the last session of 2025.
India imposes a 3-year safeguard duty on 11 to 12% on select steel products in an effort to curb cheap shipments from China. Steel counters like Tata Steel, JSW Steel, JSPL and SAIL perk up.
Zydus Wellness skyrockets on the Motilal Oswal note, a buy rating with a target of 575 rupees based on what the brokerage calls the best risk-reward profile in the industry.
And bullish brokerage views gets stocks revving. Motilal Oswal issues a buy rating on Viatech Wabag with a target of 1,900 rupees a share, while Morgan Stanley upgrades MCX to an equal weight, hiking the target to 11,135 rupees versus 6,710 rupees a share earlier.
Order win leads gains on rides. Company secures a 3.6 million locomotive order from Zimbabwe.
38.8 lakh shares of or 9.9% equity change of hands in Privi Specialty Chemicals promoter group. Vivera Investments is the likely seller in the block deal. Stock tanks over 10% in early trade. Hello, good morning. You're tuned into Chartbusters, coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Ekta Batra as well. Ekta, good morning. Last day of 2025, markets at least some bit of a green today versus what we saw yesterday. But again, yesterday also we started in the green and then went to the red. Let's hope that today it continues about 26,000. We start 2026 at 26,000. I don't think anyone would complain then.
Hi, Vinny. Yes, absolutely. Well, hopefully we will be maintaining those levels. But nonetheless, the real volume picture, the real cues will come only next week, considering that this is going to be a holiday light week. But nonetheless, as of now, we do have the markets which are holding up. So we have the Nifty, which is up around 0.4%. We have the broader markets, which are doing better in today's trading session. So hopefully that could be an indication going into the next year. So currently the Midcap index is up around 0.8%, and we have an advanced decline ratio which has been holding on the positive side. So we have around 3 stocks, or maybe a little more than 2 stocks, advancing to around 1 stock declining on the Bombay Stock Exchange. So let's kick off the show with a technical check. We have Chandan Taparia from Motilal Oswal Financial Services joining in to discuss what he's tracking on the technicals this morning. Chandan, hi, morning. Well, it's turning out to be a good session for us. You know, it's debatable in terms of the volume picture at this point in time, considering that it is the 31st. But what's your sense in terms of stocks as well as the Nifty?
Good morning, Ekta and Vinny. Thanks for having me. So market has been consolidating, but today it negated its lower top, lower bottom of last 4 trading session. It exactly took support near 50-day EMA and turned higher. And I believe positive to range bound bias could continue in the broader market. As of now, the broader range for the index is 25,700 to 26,300, but now the range is getting narrowed. And with immediate support of 25,850, we are looking for an up move towards 26,200 to 26,250 Nifty index. And overall, those who are looking for positional point of view, I believe with support of 25,700, market can head towards 26,500 to 27,000 in next 1.5 months. Looking at the rollover data, rollover cues were mixed, slightly lower rollover, but Bank Nifty open interest shaded, which indicate that now some support-based buying and recovery could be seen. Talking about Bank Nifty index, it has been consolidating in a broader range from last almost 25 trading session. On last trading session, it took support at the lower band of the trading range, and now all set to give a small consolidation breakout led by buying in selective PSU and the private bank. So with support of 59,000, one can buy Bank Nifty for an upside target towards 60,000, 60,114, which is all-time high for this index. Now talking about stock specific, yes, first it is buy on Titan. The consumption and the momentum of the gold and silver is likely to have the buzz in selective name. So Titan is one of the strongest counter which has been making higher tops, higher bottom on the weekly chart, has been respecting its rising support trend line. Rollers are in line and better with roll course. One can buy with support of 39.80 for an upside target towards 42.30. Second trading area that is from PSU banks. Most of the PSU banking counter has bottomed out, and Canara Bank has seen momentum after a consolidative move of 28 days. On last trading session, we have seen short covering. Roll costs are inching with put call ratio on higher side. One can buy with support of 152 for a target till 164 and beyond. And last but not least, that is buy on Tata Steel. We have seen a major and massive momentum in most of the metal name. And after the momentum in Hindustan Copper, Hindustan Zinc, Nelco, now it's time for selective steel counter to do well. So Tata Steel could see momentum led by unwinding in 180 cone. One can buy with support of 176, and metals are likely to sign more for an upside target towards 119 Tata Steel.
Okay, Chandan, thank you so much for talking to us about the markets as well as individual stock names as well. Happy New Year to you as well as the team and your family. Hope you have a great one. But on that note, let's shift focus. And Chandan, thank you so much for joining in today as well. We're shifting focus now to a special segment where we will get you a few ideas for profit from Money Control Pro. Bharat is joining us from moneycontrol.com to talk to us about the stock that he's been tracking closely. Bharat?
Today's ideas will be Sky Gold and Diamonds Limited. Despite the record gold prices, the jewelry demand continues to remain strong. Jewelry players witnessed strong sales in the festive month of Deepavali. With the ongoing wedding season, the jewelry demand is expected to remain strong. We expect the company to deliver strong Q3 FY26 performance. The company is gaining market share with the existing customers with launch of new products such as chains, Mangal Sutras, Italian bangles. Apart from this, the company is also onboarding new clients. It recently onboarded 2 large pan-India players, Reliance Jewelry as well as Tanishq. With the organized players gaining market share, it is positive for the company as it is a prominent supplier to the organized jewelry chains. Apart from the domestic market, the company is also ramping up exports. It recently set up an office in Dubai to boost the export sales. We expect the margins to improve owing to better product mix, increasing share of low-cost gold metal loan, as well as operating leverage. The company is reducing the working capital and expects to be operating cash flow positive from FY28. At the current market price, the stock is trading at a PE of 15 times FY27 earnings projections. The current valuations are attractive, and hence we recommend investors to add this stock.
Okay, well, on that note, we're going to take a short break. But up next, we're going to be talking about the Nifty, which has delivered its 10th straight year of positive returns, and it's been a record-setting year for certain stocks in the benchmark indices. We'll get you more details once we're back. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back to Chartbusters on CNBC TV18. Now, the Nifty is set to end the year with returns of 9%. While the figure may seem subdued, the story under the surface paints a different picture. At the end of last year, we told you about 10 index constituents who were set to make some or the other record, good or bad, by the end of the year. Hormaz is here. What are these stocks on your radar, Hormaz?
Well, it's been a very engaging year for the Nifty, if you would like to call it that, because even if the index has given single-digit returns in the positive, there have been enough and more stocks that have made noise all through the year. Let's start off with one big name that has been Trent. And if you look at this chart, after years of delivering stellar returns, some even doubling in 23, doubling in 24. It is the first time after 2013 that Trent will be delivering negative returns. The stock is down 41% this year. There have been downgrades, yet the street continues to remain on the positive. 17 analysts still have a buy rating on the stock, 6650 being the highest target, 4300 being the lowest. In fact, Trent is now trading below its lowest price target as we end this year. We spoke about Reliance Industries breaking one record, but then you can't keep the big boy away for far too long, and after that minor blip in 2024, the stock is back to winning ways. A 27% return in 2025. It's turned out to be the best year that the stock has had since 2020. The street continues to remain near consensus bullish towards the stock. 35 analysts still have a buy rating, 1890 being the highest target, 1350 being the lowest among the few that still have a cautious stance on the stock. Consistency is the key, as they say, and HDFC Bank justifies that tag. Last year, we were talking about the fact that despite being positive returns, 3 out of the 4 years have seen single-digit returns for HDFC Bank. It has defied that norm this year, 11% higher on the Nifty Big Boy, India's largest private sector lender, and continues to deliver positive returns ever since the start of 2015. Here too, the street remains a near consensus bullish recommendations, with 46 analysts still saying a buy, 1460 being the highest target, just around 1050 being the lowest. A stock that has had a wonderful year has been Eicher Motors, and after just one single negative year or two in 2018 and 2019, the stock is up 51% this year, and it is turning out to be the best year the stock has had since 2014, when the stock had tripled in value, and it is still among the best performers on the Nifty this time around. The street here, well, it's a slightly mixed opinion here. 22 analysts still say a buy rating, highest target being around 8,000 rupees, the lowest being around 4,700. 6 analysts still believe that valuations are expensive and continue to remain cautious on the stock. Tata Group in general has had a very disappointing year, and leading the pack is TCS, the largest group company, of course. It's turning out to be the worst year that TCS has had since 2008. That year, the stock was down around 60%. This year, the stock is down 20%, in line with all of the fall that you have seen in the IT names, but it has been one of the major reasons why the Nifty upside was capped this year. Yet, analysts are still seeing that the tide is turning for TCS, 4,810 being the highest target, 2,800 being the lowest. 36 analysts still say a buy rating. As we mentioned, consistency, one stock that has also justified this parameter is Bharat Electronics, or BEL, and barring 2018 when the stock had halved, it has been a positive journey for the stock. In the last 5 years, the stock has delivered double-digit returns, and healthy ones at that. There's been a 33% return this year as well for Bharat Electronics. Is the top gainer on the PSU index, and 27 analysts still believe that the stock still has more upside left, highest target being in excess of 680 rupees. Possibly the stock of December, and among the best NBFCs, Shriram Finance is one such name. After 3 negative years, the stock has had its 5th positive year, 70% higher this year. It has turned out to be the best year that the stock has had since 2017. And here too, the street continues to remain bullish. 35 buy recommendations, no sell recommendations, 1225 being the highest target for the stock. We don't necessarily talk about Grasim when we talk of Nifty names, but here too, the stock has continued to deliver steady returns, if not stellar, and 4 out of the last 5 years, the stock has delivered double-digit returns. In fact, barring 2018 and 2019, every time the stock has gained, the stock has delivered positive double-digit returns with the exception of 2022. Here too, the street continues to remain bullish. 8 analysts have a buy rating with targets going up to as high as 3,700 rupees. For Adani Enterprises, it's turning out to be the third straight year of negative returns for the stock, and this time it's been a double-digit fall for it. And here too, and it does not have any much analyst coverage, does Adani Enterprises, so a third straight year of negative returns. And the last one here is HUL, Hindustan Unilever, and I'm talking about the stock being on the edge. Why? Because as of now, the year-to-date returns on the stock is 0. But why is this important? Is because never in the last 30 years has Hindustan Unilever delivered 2 back-to-back years of negative returns. The last time it delivered negative returns was in 2021, then that 13% fall in 2024. It remains to be seen whether that streak gets broken by close of trade today, but the street continues to remain bullish on HUL as well, with almost 32 analysts still saying a buy, targets going up to as high as 3150. Now that was the Nifty for you this year. The returns may be quiet, but there have been stocks that have made noise, some for the good, some not so.
Absolutely.
All right.
Urmas, thanks so much for that. On that note, we're going to sip into a very short break. We'll come back with more stock-specific action after the break.
Fly Emirates, fly better.
Welcome back. You're still tuned into Chartbusters on CNBC TV18. Well, it's turning out to be a session which is quite steady for us on the last day of the year. So currently we have the Nifty, which is up around 100 odd points. Obviously, the metal stock are really dominating in terms of sentiment at this point in time because of the safeguard duty. So as you can see, we have JSW Steel, Tata Steel, both these stocks which are really ruling the roost in terms of the Nifty, up anywhere between 2.5% to 5% for a couple of these counters. Otherwise, in terms of key gainers, we do have Trent, which is showing a little bit of a comeback. If you see it, it's been a dismal year for Trent. So that stock has lost around 39% of its market cap on a year-to-date basis. But today, it's seeing some amount of traction on the upside, so up around 1.6% for that one. A couple of other stocks on the downside today, which are seeing profit booking, is TCS, which is going into the year close with a little bit of profit booking and red on the screen. So TCS down around 1% and TechM, which is down around 1% as well. Well, on that note, we need to wrap up on the last edition of Chartbusters for this year. Stay tuned. Trading Hour up next.
Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormaz Fatakia and Ritu Singh. And it's the 31st of December, the last trading day of 2025 in what has been an interesting year. The Nifty manages to hold on to that 10% sort of gain this year, but has been an underperformer, has, withstood a lot of challenges this year. So we look at, as we do at the end of every year, look at the year gone by with a lot of fond memories, reminisce the good and also wish away the bad with a lot of hope that we're looking at in the next year, which obviously begins tomorrow. We'll be here, the Nifty above 26,000. So trying to end the year with a bang.
Trying to end the year with a bang. That's the intention of the bulls, looking to end 31st on a high and, of course, begin the new year on a positive note. Ritu, what are your plans for the evening?
Well, I'll be right here this evening, but of course, looking to start the new year on a high. The markets are making merry finally, gaining in trade, and we hope that continues into 2026. Lots of, it's a news-heavy day. It's the last day of the year, but lots to look out for. Of course, the January series starts. That's one. Changes for traders, 4 new companies, stocks available for F&O trading. Then, of course, you have specific cues when it comes to steel stocks. Watch out for those. The safeguard duty being imposed for 3 years. That's a positive. There's a cabinet meeting. We're expecting to hear something on Vodafone. If that materializes, also something to keep on your radar. Individual names like Privy, Specialty Chemicals, etc. All very much, center of our focus today. But Hormaz, tell us what is buzzing in trade.
Buzzing are a lot of these names that have exited the F&O space, not the ones that have entered. And 2 names stand out in that list. HFCL is one of them. That's up 9%. And NCC is the other one. That's up 5.5%. And both of them are gaining on very, very strong volumes in today's session. HFCL has already seen more than 5.5 crore shares that have been traded, which is 5x of its 20-day average. NCC 2 has seen over 30 lakh shares being traded, which is 3x of its 20-day average. RITES won an order yesterday, and that stock has moved higher, and it has taken the other railway stocks along with it as well after a bit of profit booking that we saw in yesterday's trade. Of course, all of them are off the highs of the day, but still holding on to gains of 3.5 to 4%. And volumes too. RITES has seen almost 70 lakh shares traded. The 20-day average is just 4 lakh, and IRCON has seen close to 1 crore shares traded. The 20-day average being around 23 lakh shares. The last one on the list today is Dynacon Solutions, and this is also on the back of an order win. The stock has snapped a 5-day losing streak today. This is the biggest single-day gain the stock has seen since April of 2024. And so far, we have had more than 10 lakh shares that have been traded on the stock. The 20-day average is just around about 1 lakh. And as a result of this move, the stock has gone above all of its key moving averages. But the stock has had a bit of a forgettable year, down around 25% so far this year. But you can call that law of averages, because excluding this year, if you take a look at the returns of the last 5 years, 4 of them have seen the stock gain more than 100%. The stock was up around 170 in 2020, 150 in 21, and 22 and 24 as well, as the stock more than doubled in value. So after such stellar moves, some bit of profit booking coming in on Dynacon Solutions.
Right, some bit of profit booking coming in on Dynacon Solution, but it's the metal stocks which are doing well. So if there was music which was to be played to bring in the new year, would it be heavy metal? Well, we don't know. We leave that to Ritu and her banned choices. But for now, steel stocks, they're surging in trade. The government has announced a 3-year safeguard duty of up to 12% on select steel imports. Sudarshan joins in on what this implies, what the safeguard duty is, and on what specific stocks, how do they benefit?
So steel sector has got the New Year gift. If you remember, this month only in the first weekend, Steel Secretary had come on the channel. We had asked him about this safeguard duty, and he had told us that this would be announced very soon. If you remember, April 2025, that was the time when DGTR, Director General of Trade Remedies, had announced temporary safeguard duty, and that was applicable for 200 days. And it expired in the early part of November. After that, we were expecting that it's going to be announced very soon, and finally it came, and government has now announced safeguard duty that would be applicable for next 3 years, that is till 2028. So first year from April 21, 2025 to April 2026, the duty is of 12%. After that, it comes down to 11.5% for the second year. Then it comes down to 11% for the third year. And this is applicable to all the imports that we do from China, Vietnam, and some of the other countries. and it's being taken very positively for steel companies, because normally this is the period when prices come down. So it's going to support the domestic industry, and that's the reason you are seeing a big move in all the major names: Tata Steel, JSW Steel, top Nifty gainers amongst Midcap, JSP, and all the other names are also higher in the trade.
Indeed, and steel stocks doing well, and Tata Steel, JSW Steel, JSPL, all of them among the top gainers in today's session. But Sudarshan, stay on, because another one that you track very closely is MCX, and that one comes on the back of a very sharp price target raised by Morgan Stanley as well as an upgrade. Tell us more on that.
So it's an interesting note. Normally, historically, if you take a look at the Morgan Stanley's call on MCX, their target price has always been below current market price. So when MCX current market price used to be around 3,000, MS target used to be around 1,500. When CMP increased to 6,000, their target used to be around 3,000. When CMP increased to 10,000, their target used to be around somewhere 6,000. And they had maintained their target in the range of 6,000 to 6,700. Finally, they have gone ahead and upgraded the stock to equal weight, and target they have increased to more than 11,000. That is 11,135 per share versus earlier target price of around rupees 6,700 per share. And the main reason of upgrading the stock is the increase or surge in the ADTR, that is average daily transaction revenue, that company has seen over the last few months consecutively. Over the last 3 months, if you take a look at the data, there has been a sharp surge. And on the back of this factor, they have also raised EPS estimates. For FY26, they have increased by 15%. For FY27, they have increased by 24%. And for FY28 also, FY27, they had increased by 20%. And FY28, they increased by 24%. That's the reason you are seeing a big move in MCX today as well.
All right, Sudarshan, thanks very much for taking us through that. As we speak, markets at day's high, but we have to slip into a short break. Don't go anywhere. When we come back, we'll focus on the year gone by for the commodity market.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. And even as the market saw volatility, it was no different for commodities as well, as they saw some wild swings in 2025, particularly precious metals like gold and silver. Manisha gets us a roundup of the year gone by for these commodities.
2025 wasn't just about outperformance in metals versus other asset classes. It was about record highs where themes like renewables, tariffs, rare earth, financialization, and policies from China and US led the market to dizzying heights. Well, a year which gave record gains in gold, silver, platinum, and copper. 160% gains in silver and platinum and 70% in gold, followed by 43% in copper, is what 2025 doled out. In 2025, gold hit record highs 52 times in a year. The year started with nearly $2,650 an ounce. It crossed $3,000 in March, $3,500 in September, $4,000 by the time it was October, and it went to newer highs above $4,550 by the time it's December 2025. The Indian prices also factored in rupee depreciation. It started the year at rupees 79,700 and was last seen trading at rupees 1,40,000 rupees per 10 grams. Posting strongest annual gains since 1979 on the back of US Fed rate cuts, strong central bank buying, and record investment purchases. Silver, in the meanwhile, outperformed gold. It's a smaller and a more volatile commodity compared to gold. Started the year with nearly $29 an ounce. It was $45 an ounce in September, was at a 14-year highs. It crossed $50 an ounce in month of October to hit record highs, and then has seen strings of record highs with nearly $25 an ounce of a gain just in the month of December. If you look at the Indian silver prices, well, they saw huge premium, frenzied investment buying, and the prices have gained from an 87,000 rupees to 2,54,000 rupees in this year itself. Not too far behind is platinum, taking out its previous record highs of $2,380 an ounce to make a new all-time high at $2,500 an ounce for this one. Platinum is headed to close 2025 as its biggest annual gain, supported by third year of deficit and a very strong automotive and investment demand for this one as well. We have seen strong gains continue in case of copper, or also called as Dr. Copper, making record highs in US, China, London, and India. This is on the back of US tariff concerns. It also has to do with very strong demand that we have seen. Output slowdown in major producing countries like Chile, Peru, Indonesia. Strong demand also from various industrial sectors like AI, electric vehicles, data centers, keeping it bullish also for 2026 in the year to come.
All right, Manisha, thanks very much for taking us through that. We have to slip into another short break, but when we return, we'll discuss market technicals with Siddharth Raimangla of Stockbox Technologies.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. The stock from this morning has been Privy Specialty, reading under pressure. Equity worth nearly 1,100 crores, or nearly 10% of their, overall equity changed hands in a block deal today. We understand from sources that promoter entity has offloaded about 6.5%. Let's go across to Sonal Bhutra, who joins in to make sense of this deal, but more importantly, what the company does, the financials, the expansion plans, and the shareholding patterns of the company. Sonal.
Thank you so much for that. As you rightly pointed out, there's been a block deal in Privy Specialty Chemicals. 1,100 crore worth of equity has changed hands, where there's an exchange of 10% worth of equity. Sources were earlier suggesting that the promoter group entity is likely to sell 6.3% stake via a block deal. The seller would be Vivera Investment and Trading Private Limited. Of course, there was an option to upsize this deal size as well. So we'll watch out for details in the block deal data that comes after market hours today, who has sold, and most importantly, who has bought stock after such a huge chunk has been sold. Now, our current promoter shareholding stands at 69.89%. And if the promoters have actually sold, as per our sources, this would be the second time in this year that the promoters would be selling a massive stake. Remember, in June, the promoters sold 4.09% stake at 330 crore rupees, because earlier the stake was around 74.05%, which has now come down to levels of around 70%. There have been a lot of, changes in terms of owners, in terms of Privy Specialty Chemicals. In calendar year 17, Fairfax invested around 370 crore rupees in the company for a 51% stake. And then the company was merged with Adi Finechem. But there were some internal issues with the promoters and with Adi Finechem as well. And there was a demerger yet again in 2021. Post this major transaction, there was another major transaction where promoters bought 48.8% stake in April 2021 itself, taking it to the levels of 74%. So a lot has already happened in company's history, and now again a promoter stake sale. Now, about the company, it is India's largest aroma chemical manufacturer and exports 75 products. There was a recent initiating coverage by Motilal Oswal as well, with a buy rating, target price at 3,960. They expect the company to deliver 27% revenue CAGR, 34% EBITDA CAGR, and 46% profit, 46% CAGR over the next 3 fiscal. And this will be driven by capacity expansion, the increase in total addressable market for their new products, and improving relationships with existing customers as well. Remember, the company has been planning capacity expansion because of strong demand of its products. One is planned in FY27. The next is doubling of capacity in FY29 itself. They expect that the new products which will come on stream, which will have margins of more than 40%, and the total revenue coming in from new products will increase from 6% in FY27 to 27% in FY29. In terms of major shareholders in the DII or the mutual fund side, we have SBI Large and Midcap Fund, which holds 1.58% stake. So it will be interesting to see if they buy in the block deal today as well. So that will be an important data to track for Privy.
All right, Sonal, thanks very much for bringing us those details. That's a stock to keep on your radar. And of course, we'll watch out for that block deal as and when it transpires. But let's shift focus to the latest trends from the FNO space. Mangalam joins in. Mangalam, the January series begins. Historically, Nifty seen negative returns for January, but could this time be any different?
Well, the last 4 Jan series have been more consolidatory on the negative side, but before that, the 5 Januaries that were there were big up moves that we saw. Let's see where that goes. Series day 1, typically, the high of that day is extremely crucial to cross. Today, the Nifty has managed to do well. Day 1 Jan series starts fairly well with the Nifty, the Midcap Index, the Nifty Bank, all of them doing well. The Nifty has actually gone ahead and conquered the 20-day moving average as well, with strong advanced decline ratio, something that was missing over the last few trading sessions. All these factors doing well, and today, which is also the last trading day of calendar 2025, is pretty similar to what the entire year was. Why do I say that? Look at the gaining indices. The metals, the PSU banks, and the auto. The 3 top gaining indices today are also, incidentally, the top gaining indices of 2025. And the underperformer, which is Nifty IT, which is in red today, the only sectoral index which is in the red today, is also among the only few sectoral indices which has been in the red in 2025. But the important part, with the market starting well, the FIIs at the start of the series are just 9% long, which means that 91% of their positions are on the short side. Does that mean it's a bad thing? Perhaps not, because if you look at history, April 2023, November 2023, Feb 25, and as recent as September 2025 as well, the FI started the series with anywhere between 8 to 11% long positions, roughly 90% short positions. But on each of those occasions, over the next 2 to 5 series, we saw an average move of 1,500 to 2,900 points on the Nifty. So does that mean Jan series with the FI starting at 8% long positions, between Jan, Feb and March, we do see about a 2,000 point move? Well, all of that depends on, how a lot of the triggers that are planned out for 2026 play out. But for now, the 26,000 mark has been conquered and put writers are active on that one. So the 26,000 put comes up for you and the 26,100 call comes up for you as well. So the range over the next few trading sessions, at least as volumes come back to full steam, would be between 25,950 to around 26,200 thereabouts on the frontline index. Just watch out for on day one, Samman Capital. All of December series, it was in F&O ban, got out of the F&O ban yesterday, and the open interest surge today indicates that it's very close to the threshold, so may enter F&O ban, if not today, then over the next couple of days.
Usual suspect to enter the FNO ban, isn't it? Samman Capital. Mangalam, thank you for sharing those updates there from the FNO desk. And as Mangalam was highlighting, the top 3 sectoral gainers, the PSU Bank Index is up 31% this year, the Metals Index is up 30 and the Auto Index is up 22. So good going for these indices so far in 2025 as they close down the year on a high. Good time to get in a quick chart check as well. Siddharth Rai Mangala from Stockbox Technologies is joining in. Siddharth, good morning. Thank you for joining in. You're finally back above the mark of 26,000, but that 26,200, 26,250 has proven to be a bit of a hurdle. Do we cross that in the immediate term, considering today's price action, or would you wait for a more decisive move and then take a call?
Hi, Hormuz. Good morning, and thank you for having me on the show, first of all. See, Hormuz, if we talk about Nifty, the last 6-7 sessions in December's expiry were especially very, very dull, because of which, despite all that weakness in the index, we did not see any big attempt of a bounce back in the index. So now that just when we are starting this new, series, Nifty going back about 26,000 and sustaining is a very good signal. For me, I won't be waiting for the 26,200 mark to be taken out. I'm very bullish on the index for now. And I'm also completely in agreement with all that Mangalam just mentioned. The data in the index looks very positive. The FII shorts are very high. Plus, Nifty has the structure in all the heavyweights related to the index are also looking very good. So I would say any fresh long position in Nifty can be taken from here. With stop losses around 25,950, 25,900, those levels. And very quickly, we will be seeing this move extending probably first towards 26,250 and then very quickly towards 26,400 also in the next in the January series itself. So the structure in Nifty is looking very good for now.
Okay, Siddharth, let's quickly get in your top stock picks as well. Specifically from some of the packs we were talking about, auto, PSU, banks, metals, that have been some of the strongest performers recently, and also from the laggards like the IT pack.
Yeah, sure. See, 2 stocks for today. One from the auto space and the other from the from one of the heavyweights and Nifty. The first one is M&M. See, we have seen a very good turnaround attempt in this counter in the last couple of sessions. Today, the move is not very big, but I definitely think the momentum has started, and in the next few sessions, we will probably seeing this counter moving towards 3,800 mark. So M&M can be bought. Right now, the spot is around 3,664-ish. We can buy it here. The stop loss will be at 3,620, and our targets being, just like I said, the first target 3780 and the second target 3820. The second stock is Titan. See, Titan has consistently shown us very good momentum, and it has contributed very well in the index as well. Now, right now, one good thing today which has happened is that Titan has managed to go above the 4,000 mark. So a fresh momentum is starting. Titan can be bought here. Right now, the spot is around 4,058, 4,060-ish. It can be bought here. The stop loss will be at 4,030, and our targets being the first target 4150 and the second target 4190.
Titan, a new momentum starting. Siddharth, one final question from my end. A lot of these metal stocks have seen a very, very sharp run up in the month of December in particular, be it Hindustan Copper, Hindustan Zinc. Nalco has made a quiet move towards record high levels. Do you believe at these levels it is ideal to book a bit of profit and head into the new year and then take a call once the stocks cool off a little?
See, Hormuz, it's a very stock-specific approach, especially in the stocks which you mentioned. Hindustan Copper is a completely different case because there has been a structural change in the fundamentals of that company, because which is why I do think that the move in this counter can definitely stay for a bit. It can a fresh long position in in Hindustan Copper can also be taken at these levels because this move seems to be sustainable. But the other stocks which you mentioned have somewhat of a pullback can be seen, especially if we talk about Hindustan Zinc. We can wait for a while. If we get the stock in some dips around 590, 580, those levels, then again, we can start accumulating the Hindustan Zinc again. But for now, I do think that the momentum has been disrupted a bit in the last couple of sessions because that sharp fall on the higher levels. So Hindustan Zinc is an avoid for now. Hindustan Copper can definitely be bought even at these levels.
All right, Siddharth, thank you so much for that. Wish you good luck for this year and the next year as well. Have a good evening, and we'll get back to you, conversation with you in 2026 as well. All right, let's take a short break. Come back. Market fundamentals with Chakri Lokapriya of LGT Wealth India.
Fly Emirates, fly better.
A lot of the broader market names are doing extremely well, specifically in the consumption space. So you look at Dabur, you look at something like an NHPC, not from the consumer space, but definitely doing well. Tata Chemical as well, up around 2.5%. But among all the other stocks which are doing well, the one which is seeing a bigger move is Zydus Wellness, and this on the back of a Motilal Oswal note that has come in this morning. The stock is up nearly in double digits, closer to high single digits. Zydus Wellness, Motilal Oswal has initiated coverage on the stock with a buy rating. They have a target price of 575 rupees, which as compared to previous close is a near 35% upside. Why is it that Motilal Oswal likes this stock? They believe that the company, which is a diversified health and nutrition company, has leadership in several consumer categories where penetration is low. And the company's own portfolio, think of sugar-free, think of max protein, think of all the other Neutralite butters, etc. It's aligned with consumption mega trends, which is low, no sugar. Think of high preventive wellness, high protein, and high energy on the go functional nutrition, the likes of glucose dehydration, etc. They believe that Zydus can leverage their portfolio to keep expanding its user base, particularly for the youth and affluent customers. And it has one of the best risk-reward profiles as compared to the other peers in a similar market cap. They're modeling around 14% EBITDA CAGR for the standalone business. And after the Comfort Click's acquisition, they believe that the consolidated EPS can actually compound at around 36% over the next 3 years. The stock trading at 22 times FY28 price to earnings is a near 30 to 35% discount to its other FMCG peers, and which is why they like it. Remember, 6-7 months ago, we had a large trade on this counter, and Parag Parikh Mutual Fund also went ahead and bought the stock. It's been a big mover. We here on CNBC TV18 have been periodically speaking with the management, Tarun, who joins in to tell us about the growth path of the company and the acquisitions that they've made as well. The last 3 months have been consolidatory, but typically the stock has been a big mover.
Extending its gains for the year now, 17% higher in this year is Zydus Wellness. So all's well that ends well, I guess, is what Motilal Oswal also says. 35% upside potential in the base case and 80% upside potential on the bull case scenario that Motilal Oswal has highlighted for Zydus Wellness. Now, Chakri Lokpriya from LGT Wealth India joins in to talk more on the markets and his preferred ideas as well. Chakri, good morning. Thank you for joining in. Season's greetings to you, your team, your family. Wishing you as well a very happy new year. Where do you head into 2026? We are on course for yet another earnings season. What are your anticipations for this time around, considering the fact that we'll be on a lower base? And do we believe that a double-digit earnings growth is a realistic possibility now?
Good morning. Thanks for having me, and a happy new year to you and to your viewers. It's been a roller coaster ride in 2025 with the amount of uncertainty of global events and tariffs and its impact on India's corporate earnings. And therefore, the earnings fell to single digit, about 7-8%. And now the expectation is, as we go into the next year, there will be some kind of a resolution, hopefully, of the tariff deal. Now, as and when, if that happens, we expect a fairly significant earnings upgrade from single digit to well into double digit, maybe 13-14%. And that will lead to a market re-rating as well, and the corresponding FI influence. So I think, that is the biggest catalyst that we're looking out for as we step into 2026.
Okay, well, Chakri, IT has been a bit of a laggard in 2025. Do you see a bit of a tactical trade linked to some of the rupee weakness we've seen recently, or in your enduring growth basket, does it deserve a place?
I think IT is actually well positioned as we go into 2026 because, if you look at all the hyperscalers in the US have spent about $100 billion almost every quarter for the last few years now. And all those applications now need to be integrated, AI infrastructure applications, and those AI infrastructure applications need an underlying IT services model. And that's where the Indian IT services companies come in. They have lagged. We've seen this before in the cloud rollout a few years ago. IT services dipped and then took off. The same way we expect an acceleration of earnings going into next year.
The consumption space. A lot of people believe that with the kind of measures that the government has taken over the last 6 to 8 months, the pivot has been towards reviving consumption. Do you think any of the listed large staples players benefit from this? Or would you believe that, they're mature and growth is not one of those things that they will lead from when it comes to increase in consumption, and that will go to other forms of consumption?
That's a good question because, a couple of things have happened. One with the GST cut, it affords higher spending power to enhance the consumer. And that spend seems to be going towards the durable spends, buying a bike, buying a car, or buying durable goods like, ACs, or even wellness that you're talking about. Whereas on the other hand, the pure FMCG companies, the levers of the world, have not been able to improve their pricing power or margins. So I would focus on more the durable bit, as well as specific plays like wellness in the FMCG part of the business. In the staples part of the business.
You know, Chakri, the sector of this month possibly has been metals, without a doubt. And with the kind of volatility seen in gold, in silver, does that as a haven asset or a hedge still deserve a mention or still deserves presence, considering the very sharp up move and now the equally sharp down move that you are seeing today in silver prices? And corresponding to that, in a lot of these metal names as well, they've gone up 50, 60, 70% this year, some even 100. Does metals still remain a cyclical, tactical play, or are we in a proper commodity super cycle and this is here to stay?
You know, I think if you make a distinction between gold and silver on one hand and the non-gold ferrous and non-ferrous on the other, gold and silver clearly, have gone through the roof, up about 70%, gold and silver much more, 120, 130%. Against that backdrop, the shortages in silver production exist. So therefore, I think there is that structural move upwards because demand is greater than supply. On the other hand, the regular metals, which are the companies that we invest in, those companies will benefit and they will continue to do well because both the globe, US is cutting interest rates, Europe is trying to revive, India has also cut interest rates. So all these things help cyclical companies. And as we see a greater emphasis of manufacturing come back, capex come back, these companies will benefit.
Well, Chakri, in your note, you say financials will drive nearly half of the incremental index earnings over FY26 to 28. Some of the cues that we're getting, it's a bit mixed on credit growth. Some of the margin pressure may remain, given the low interest rate regime. Mixed cues and asset quality now nearing decadal improvement, but some stress perhaps still remains on the MFI side. Where do you see the better risk-reward play, particularly in the financial space?
That's a good question. If you look at financials as a space, both banks, NBFCs, across board, all kinds of companies, these are the first beneficiaries as the economy revives. The economy clearly and corporate India as earnings has been only about 7-8%. And as we go into next year, that cyclical improvement, the first credit growth from whether it's a government or a consumer or a corporate spending comes to financial services companies. And they are a large sector, and therefore we think that they will represent nearly 50% of the incremental earnings of the overall index going into next year. And the growth will be led by PSUs, NBFCs, and the big private banks.
All right, Chakri, thank you so much for joining in. PSUs, NBFCs, and some of the private banks are the earnings-based stocks that you believe will drive earnings. As we speak, a bunch of stocks buzzing around as well. SBI Card, for one, has moved to the high point of trade. We have Whirlpool, which is spiked. Whirlpool obviously has been a serious underperformer in all of 2025. We take your leave on that and wish you a very happy new year as well. Take a short break, come back. The year is over, but business is not. We'll tell you auto sales for the month of December. They'll be released starting tomorrow. What is it that the street is working with this time around? Stay with us.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back to Trading Hour. Market still in the green. Market breadth very much in favor of advances. About 2,000 stocks advancing for every 783 stocks that are declining on the NSE. Now, one of the top sectoral performers this year, apart from metals, of course, and PSUs, has been the auto. Auto sort of pack, Nifty Auto, delivering good returns, about 20 to 30% is what we've seen in 2025. The auto sales numbers for the month of January are also going to be released tomorrow. That's an important cue to watch out for. Sudarshan is back with us with a preview of what to expect. Sudarshan, you gave us some good news for the steel pack for MCX. Now tell us if we should expect the same on the autos.
So highway run for the auto segment started in the month of September, may continue even the month of December, and all these auto companies are likely to end 2025 on a very high note. We are expecting a strong set of numbers across the segment. All the companies are expected to report a double-digit growth as far as wholesales are concerned. If we talk about the commercial vehicle, that's basically being aided by or supported by rising freight rates. And as far as passenger vehicle and two-wheelers are concerned, the higher conversion that we had started seeing post GST rate cut is likely continuing even in the month of December. Even the ongoing wedding season is aiding to the demand. So now talking about the sector-wise, two-wheeler is expected to see a growth of 30%. Passenger vehicle is expected to see a growth of 22%. Commercial vehicle growth maybe 12%, and even tractor segment is expected to see a growth of 18%. These expectations are from Nomura. If you talk about the company-wise in two-wheeler segment, all the companies are expected to report a double-digit growth, with Bajaj Auto's growth rising by 15%, Hero Moto 26%, TVS Motor 23%, and Royal Enfield 2 may see a growth of more than 20%. Coming to the passenger vehicle segment, again, here also double-digit growth, with Maruti seeing a growth of 19%, Hyundai may see a growth of 14%, even Tata Motors passenger vehicle may see a growth in the double digit, and that can be 17%, and M&M Auto continues to outperform, and their growth can be up to 22%. Talking about the commercial vehicle segment, Tata Motors commercial vehicle may see a growth of 14%, Ashok Leyland growth may come at 17%, and in the tractor segment, Mahindra & Mahindra tractor may see a growth of 15%. So all in all, it's a double-digit growth across the sector, and strong month, basically strong December, we are expecting from auto companies.
Promises to be a strong month. Sudarshan, thank you for that update there. While the index has also moved to the highest point of the day, a lot of these broader market names are buzzing. And how? Look at HEG and look at Graphite India. HEG is now up 11% and Graphite India is up 9%. Both of them now are the top gainers on the Nifty 500. HEG has also surged to the highest point of the day, as has Graphite. Gujarat Gas has moved to the highest point of the day as well, 7.5% higher on that stock. So a lot of these broader market names seeing a one-way move upwards, and in line with Gujarat Gas, a lot of these other oil and gas names as well. HPCL is up 4.5%, and as is MRPL, which is up 5.5%. So a lot of these oil marketing companies too at the highest point of the day, HPCL as well as MRPL. But what is leading the index to the day's high is Reliance Industries, almost 1.5% higher now as we speak, the top contributor to the index upside, and 1560 now on Reliance Industries. Now, earlier we had spoken to Vineet Sambre from DSP Mutual Fund on his top sectoral bets and what you should be expecting from the market going forward. Listen in.
Consumer sector as such is actually going through a lot of disruptions. One has to be very, very selective and careful because what used to be very dominant franchisees across the board, I think they are facing a lot of threats, both in terms of competition or in terms of the online presence. So I think there one has to be more selective. In terms of the cycle recovery, I would say power sector went through unusual slowdown because of the extended monsoon. So there, I believe one can see a turnaround. And one more space which I am actually positive on is the agrochemical space, because that's one space which has again got affected because of the unusual season. The stocks are actually trading quite cheap in a way as compared to the history. So I think that's one space to sort of focus on. First of all, I continue with my sort of positive view, and it's more also linked to where the valuations are for the sector. As compared to most parts of the market, we've seen that the sector is actually pricing in some of the big risks which we are talking about. risk being the uncertain environment, risk being the poor deal flow, risk being the AI trade which is happening globally. So now I believe that these risks are well priced in the stocks. I mean, last year 2025 the IT sector has underperformed. From that perspective, any change in the outlook globally can lead to a turn in the sentiments, and also the outcomes could be good. I believe the small and mid caps in India, they have good potential to keep outperforming the large caps. Now, while I say that, last year was not great relatively for the small caps as compared to the large caps. Maybe this year also it could underperform, but I'm saying that I see a lot of opportunities by looking at the companies bottom up, that the companies will do really well over the course of next few years, and that's where the confidence of the small and mid caps doing well.
All right, that was some sane advice coming in from Vineet Sambre. We take a short break, come back, more news and updates follow on the other side.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
$140 points higher now on the index, and at the highest point of the day as we speak, nearing to the 26,100 mark now, and ably contributing to Reliance Industries, which is now almost 2% higher as we speak, are JSW Steel, which has now extended its gains to 5%, and Titan, which is also now moving towards the day's high, along with names like SBI and Axis Bank, which feature among the list of top gainers. Now, the Fed minutes that were released last night, they were showcasing the fact that it was a very, very close call for that 25 basis point rate cut that the FOMC eventually went on to announce with a 9-3 vote, which saw the most dissenters since 2019. Steve Leisman is here with more on what the Fed minutes had to say.
That the Fed, the 25 basis point rate cut was maybe a closer call than it appeared from the vote, which was 9 in favor of the cut, 2 dissenting against it, and 1 for a 50 basis point cut. The minutes show that a few of those who voted for the cut said they could have supported no change at all, and some wanted to wait for more data. Remember, the government was still they were still getting data from the closed government period there. Inflation risk was seen tilted to the upside, labor market risk to the downside, and what you're going to hear now is a debate between those two sides. Some care more about inflation, others more about employment. Those supporting the cut said it was in line with forecasts for future lower inflation. Now, the committee did appear to agree on the need for future cuts. The debate was about the timing of future cuts. Most judged further rate cuts appropriate if inflation declined over time as expected. Some, however, wanted to keep rates unchanged, quote, for some time to assess the impact of recent cuts they'd already done. Others argued a move to a more neutral policy would help forestall what they were concerned about, a, quote, major deterioration in labor market conditions. To forestall that, many saw a low probability that tariffs would lead to persistent inflation. That concern about tariffs was diminishing there. Several were concerned, however, that higher inflation would become entrenched. If it feels like I'm going back and forth, it's because that's the way the minutes read. Many expected tariff inflation to wane, but debated when and by how much. Some saw persistent price pressures, however, unrelated to tariffs. The majority of participants noted that inflation is above target for some time and had not moved closer, and some were concerned that the idea of the Fed not being at target would become entrenched and the commitment to the 2% target would be undermined by that. The labor market was seen continuing to soften, but stabilizing next year with appropriate policy. Now, this is a couple interesting facts that we keep talking about on CNBC. When you read the minutes, you see that the Fed itself is seeing this K-shaped economy with strong spending by higher income households, while lower income households are making, quote, adjustments for inflation. And a number were hopeful that higher productivity, possibly reflecting AI, could boost growth without inflation, however, also dampen job creation. So, Brian, I wish I could be more concise about how the committee felt, but the committee's feelings were literally all over the place.
Well, the Fed minutes may point to perhaps the possibility of one more rate cut in the next year. But keep in mind, Fed Chief Jay Powell's term is ending in May. And as Donald Trump appoints a new chief, perhaps the markets may pencil in the possibility of more than one rate cut. So we have to watch out for that one. But back home in India, data center capacity is set for a massive surge. It is projected to nearly tenfold by the end of 2030. But what's driving this explosive growth and who stands to benefit the most? Vinny Motiwala is standing by to decode India's booming data center sector and the key beneficiaries.
Right, thanks for that. So India's data center sector has marked 2025 as the breakout year. Capacity expanded from 0.5 gigawatt in 2020 to 1.6 gigawatt in 2025, fueled by 30 times the data traffic rise since 2017. 900 million internet users also came into India and AI usage started increasing. And what was interesting that made OpenAI India market, OpenAI's second largest market. Now, in 2025, what more did we see? We saw mega investments that came in. Reliance Industries unveiled world's largest Jamnagar data center plus 1 gigawatt AI facility with NVIDIA. TCS launched its Hypervault for 1 to 1.2 gigawatt AI-graded capacity over the period of 5 years. OpenAI committed to 1 gigawatt amid DPDP Act mandates. Now, the total announcement that came in for 2025 hit $63 billion. $43 billion was ex of Reliance. So, yes, $20 billion approximately was Reliance. Now, with hyperscalers leasing 97.9 megawatt in first half itself, 48% increase over there is what we're seeing on a year-on-year basis. Occupancy at 97%. Mumbai dominating 50% share as well. Now, India added a record 30 gigawatt renewables in FY24-25, making it third globally, enabled by cheap solar power, supportive government as well. For renewables versus other countries, how do we stand for AI data centers, which need 5 to 6 times more energy? Now, power demand from data centers globally is estimated to grow at a CAGR of 17% till 2030. For India, it's expected at 33%. And with the US and EU power queues that are increasing there, execution timelines are increasing, there is permitting delays across the globe because of all these issues. The focus now shifts to India. India's data center capacity is projected to increase rapidly in the coming years, and obviously because of the factors I mentioned. Now, it's interesting to note that when data centers are created, 45% of it is capex cost, is non-IT equipments capex, whether you look at it like a cooling system, electricals, construction, etc., which accounts to most of the costs. IT costs come in at 55%. And India has no dearth of players in terms for equipment play, whether you look at an L&T for EPC, Cummins for backup power. There is infrastructure that is required. There are cooling systems that is required. So we have Voltas for that. Wiring, Polycab could benefit from that as well. So this will boost what? L&T, Cummins, Voltas, a dearth of companies that we have that will benefit from this as well. Now, in US, when you look at it, utilities present in the right region or even in companies which have access to electricity have seen a bigger success in the US versus other companies. In India, currently most data centers are present located in Mumbai region. 50% capacity is in the Mumbai region. Why? This is due to network access that is there via undersea cables. Further, when you look at it and break down India versus US, unlike US, India is one nation, one grid. Although transmission is becoming a big bottleneck similar to US, but India's data center capacity is maybe set to rise almost 5 times to 8 gigawatts by 2030. And this is according to Jefferies. Setting up 1 megawatt of data center in India requires a capex of $4 to $5 million, and hence setting up incremental data center capacity of 6.4 gigawatt by 2030 will need a capex of around $30 billion. Should create many opportunities for real estate players, electrical power systems, fit-out players, cooling systems, and network infrastructure players as well, which are among the top beneficiaries for the data center boom. And Indian telecom players, EPC players, power players, IT players, all these are set to benefit going forward with this data center boom.
Well, 2025, the year of data centers. Vinny, thank you for summing that up. We take a leave on this edition of Trading Hour from Mangalam, Ritu and me. Thank you so much for watching. We wish you all a very happy New Year's Eve. We'll be back tomorrow to wish you a happy New Year. Thank you so much for watching.
I'm surprised you didn't crack the "I'll see you next year" joke. It was totally Hormaz's joke to crack. But we'll wrap up on this note of Trading Hour.
Nifty trades with a positive bias on the last trading session of 2025. Mid-caps and small-caps trade stronger with gains between 0.7 to 0.9% in a repeat performance for the second straight day. Metals, PSU banks lead sectoral gains. The oil and gas pack also joins in the strong gains today.
The government has imposed safeguard duties on selected steel imports for 3 years. The duty will be imposed at 12% in the first year, 11.5% in the second year, and 11% in the third year, as recommended by the DGTR earlier. Steel stocks respond favorably. JSW Steel, Tata Steel are the top gainers on the Nifty.
The world's best-known investor, Warren Buffett, is stepping down today after 6 decades at the helm of Berkshire, which he grew into a massive conglomerate whose business includes insurance, utilities, rail, and more. Along the way, he became the leading voice in the world of investing, doling out words of wisdom in his highly anticipated annual letters to shareholders. Hello and welcome to Halftime Report live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Ekta Batra and Vinny Motiwala. Last day of 2025 and markets are in the new year mode already. Nifty at the day's high led by metal pack and a lot of other sectors which are contributing to the gains that we are seeing right now as well. But before we discuss that and a lot more, a lot is happening in the defense space as well, right? So let's go across to our colleague Parikshit, who is in conversation with Baba Kalyani, the CMD at Bharat Forge. Parikshit.
Well, there has been a lot of action at the Ministry of Defence over the last 1 week, and Bharat Forge has won a major order for close quarter carbines. This is the second major order they won from the Ministry of Defence. The earlier one was in March, and that was for advanced towed artillery guns. The Chairman and Managing Director of Bharat Forge, Mr. Baba Kalyani, is joining us. Mr. Kalyani, thank you very much for being with us. Wishing you a very happy new year, first of all. Could you give us a sense how Bharat Forge will benefit from this order? And this is a 2,770 crore order for 4.25 lakh close quarter carbines. How much of this order is going to Bharat Forge?
Well, thank you very much. First of all, Happy New Year to you and everybody on the channel. I'd like to first take this opportunity to officially thank ARD and DRDO for the tremendous partnership that they had with Bharat Forge in development of this product. It was very similar even for the ATAGs. So the similarity between these two products is that both are indigenously designed, developed and manufactured products. First time Indian designed products and developed products are competing with foreign products and winning. I think that's a very significant milestone that we've been able to achieve. To answer your question, we have 60% of this contract because the L1 gets 60%, we were L1, so 60% of that quantity will come to us. We are quite ready and we are very hopeful that once we productionize this, which will happen in the next 4 or 5 months, we will also create capability to start looking at international markets for these products. So I think this story will continue with, like it is happening with our other defense forests, where we've been able to export artillery guns. We will hopefully be able to export small arms in a big way moving forward.
Right. Could you give us a sense of how you are preparing to deliver on this order, the kind of investments that have gone in, and the kind of collaboration? If you can give us some more color on the partnership with DRDO on this.
Well, DRDO's arm that is involved in designing and developing small arms is in Pune. It's called ARD, Armament Research Development Establishment. So our people have had a very close relationship with them as we were developing this product, which was designed by ARD. And so all the internal firing trials, making sure that components are exactly made the way the designers have thought about, and they're interchangeable. The most important thing here is components are all interchangeable, and that creates a huge capability and huge advantage for the user, the Indian Army, that they don't have to worry about if something happens to one gun, can they replace the part with another part. So all that is kind of taken care of. We don't have any external collaborations here. It's all internal. This gun, right from the raw material to the finished product, is all made in our plant. We have set up a special plant for this in Jejuri. It's a plant that has got a capacity to produce about 50,000 to 60,000 weapons per year. But easily, it's a modular plant. It can easily be double, triple based on the requirements that are there.
Right. Would you be expecting more such orders from the government in 2026? Are there certain kinds of weapon systems you're hoping to participate in?
Yeah, we are participating in a couple of more programs, again with ARD and DRDO, which they are designing. And hopefully, some of those programs might come up in 2026 or maybe 2027. I don't know. Depends on the process of filing trials and everything else that needs to be done for them. But yeah, we are quite sure that there will be other programs. But we are also beginning to see in the last couple of weeks a lot of interest from companies abroad in terms of wanting us to produce weapons for them here. So that's another thing we are beginning to see. And those quantities may be even bigger than the quantities that we are looking at for the Indian Army.
All right. Could you give us a sense of what are some of the weapon systems for which you're getting a lot of orders and inquiries for? And are there certain export orders which are likely to firm up and get announced in the next few weeks and months?
No, we don't have any export orders yet, but we are certainly talking to, I would say 2 or 3 companies, large companies, who want to move their production out of Europe into India. And as you know, Europe now has to produce a lot more than what they have been producing. The whole 5% of GDP for defense expenditure is a big drive for European companies, and they simply don't have capacity. And Europe has another big problem. They don't have manpower either. In terms of export orders, yeah, we are looking at export orders for artillery guns, which are in process, and hopefully they will get materialized in 26.
Okay. Just to also ask you about the recent meeting of the Defence Acquisition Council. They had spoken about approving a proposal for SPICE 1000 long-range guidance kits. Now, you have a JV with an Israeli company on making SPICE bombs and SPICE missiles. Is this a program that is likely to benefit Bharat Forge, and will you be participating in this as well?
Yeah, 100%. There's no doubt about it. I think we have our best products, and we will definitely benefit from this announcement that was made in the DSC.
Right. If I were to also ask you, sir, about the kind of investments you would be making in future technologies in 2026, because what Operation Sindoor has shown us, the need for readiness in combat drones, early warning systems, and advanced warfare for the future. What would be your capex push or the focus of your investments in 2026 and going forward?
We lost connectivity. Sorry.
Yeah. So what I'm trying to ask you, sir, that what will be the focus of your capex in terms of future technologies? Currently, after Operation Sindoor, we're seeing a lot of focus on future technologies in the defense sector. So what would be of particular interest to you?
We are working very seriously on drones, on UAVs, and on anti-drone systems for the Indian Army, air defense systems. So these are all the future technologies that we are working with. These technologies are largely electronic in nature, unlike artillery guns and small arms, which are weapons. Drones are also weapons because they do carry explosives. But we are hopeful of getting a reasonable amount of contracts, let's say, in this area in 26. Okay. And we are spending a lot of capex in this area also.
Could you broadly give us some numbers, sir, some color on what you're investing in drones and some of the future weapon systems that you mentioned?
In drones and anti-drone systems, those are 2 things, and then you have UAVs, 3 things. So in drones, we are setting up a plant in Bangalore to make drones. We are setting up a facility to make UAVs also in Bangalore. And on the anti-drone system, we haven't yet decided where we will produce it, but it's pretty sophisticated, but it's probably be made here in Pune because it requires multiple technologies. A lot of it electronics, radar-based technology. It requires, of course, guns, lasers, and all kinds of things. So it'll probably be made here. We also have a lot of orders now with the Indian Navy on developing unmanned systems for the Navy. Also, a lot of interest from the Navy to develop naval guns. So both the 30 millimeter gun for the Navy, which will be ready in another 6 months' time, and the 76 millimeter gun, which is the main gun for every ship. These two guns are required on every ship, by the way. And this will also be done, I would say, in the next couple of months. By the end of 26, these products should be ready.
Okay.
We are also getting into the propulsion system for naval ships. Nobody makes the propulsion system today in India. We will be the first company that will provide an indigenously designed propulsion system, which includes the propeller shaft, which is a forging, so it's very natural for us to be in that business. A gearbox, a pitch control propeller, a pitch control electronic system, and all that. Apart from that, we've tied up with large companies like L3Harris and others who make deck machinery. So we are going to get into a lot of deck machinery, companies like FMD. So we have many tie-ups that we have done with US companies, almost half a dozen companies, which are all companies in the high-tech business. And I think the India-US defense dialogue is proceeding pretty well. So we are getting our clearances quite fast from the US government for all this.
Mr. Kalani, you mentioned that some of the export orders that you're talking about are much bigger than the orders that you're currently getting from the Indian government. Could you give us a sense or some color on the size of those orders?
Very difficult to say with the numbers, but all I can say is the demand in Europe, if they talk about going to 5% GDP, the demand is extremely high. So let's wait and see. I mean, it's a bit early to give you numbers, but I'm sure India is going. This is a sweet spot for Indian companies. Companies that can design, develop, and manufacture these products with their own technology, create the capability. It's an extremely sweet spot because we are extremely competitive compared to anybody in the world.
Right. I would also like to ask you, what do you think would be the total order book that Bharat Forge will have by the end of this fiscal?
Well, currently we have an order book of almost, I would say, if I take the carbine order into consideration, almost about 10,000 crores. And we hope that by the end of 26, this order book can go up quite dramatically to at least 12,000, 14,000 crores, something like that.
Okay. In terms of reforms, Rajnath Singh, the defense minister, had said at the start of 2025 that 2025 would be the year of reforms. What are your expectations now on the reform front in the defense sector specifically? What about the new DAP?
I think the government of India, Ministry of Defense, is doing a lot of good work in getting reforms to reduce there are 2-3 main areas where they are working on. First is how do you reduce the time required from when you get, let's say, a requisition or a request from the Indian Armed Forces to the time when a product is delivered, including the whole process of RFI, RFP, testing, etc., etc. So I think the MOD is driving this, at a very high level. I know the Defense Secretary himself is very involved in this, and I'm quite sure that we will come out with some. They will come out with some very good process, which will shorten this whole time. The second is in the new DAP. There's also a process which I am told. I haven't seen the DAP myself, but I think it's going to be shared with industry very soon. There's also going to be a process for, instead of emergency procurement, we're going to have a process called fast track procurement, which is going to be Emergency procurement was, let's say, up to 300 crores, but this is going to be a much larger number. And this itself is a very good process to shorten the whole cycle. I think the Ministry of Defense, under the Honorable Defense Minister, the Defense Secretary, the Defense Acquisition Head, they're all working very diligently on getting this done. And I'm sure we'll see these announcements in the next month or so.
Okay. Speaking about the broader India-US trade talks, it's been a volatile year. Could you give us a sense on how Bharat Forge has been impacted by 50% tariffs and this volatility between India and US?
Well, we've been as impacted as anybody else would be with this tariff. Okay. So I don't want to get into more details about the business, but our business continues as normal. The problem is in our markets in the US, the main market itself is down by 45-50%. So that's an internal problem. That's nothing to do with the tariffs. But I think, people are getting adjusted, people are getting used to this, and people are finding solutions. I mean, we don't see this as a big problem, but certainly it will be a big solution to get into a high growth trajectory once this is the trade deal is done.
Are you expecting the trade deal to happen anytime soon?
Well, we've been hearing this like you've been hearing this for the last 3 months. Every time our delegation goes to the US or somebody comes here, there is talk about a trade deal happening like tomorrow. So I don't know. Right now we're in a holiday period. But I can see that the U.S. White House is pretty busy with all kinds of things with Zelensky and Netanyahu and everybody else. So I hope that in the early part of the year that is just coming, there will be time for looking at trade.
But Mr. Kalyani, has Bharat Forge now started looking beyond an India-US trade deal? Are you now well on course with your plan B in case this trade deal does not happen?
We have a plan. I wouldn't say it's a plan B. We have a plan to grow our business irrespective of the trade deal. So that plan is pretty much on track.
Okay. In terms of the budget is round the corner. The government is seeking suggestions. What do you think is that one reform in the union budget which could help the defense sector?
See, the one major reform which we have talked even last year is that we need to have EXIM credit available for exports. And today, the EXIM credit is done through the normal EXIM bank system. I think it needs to be done through MOD because they understand this business very well. They understand the nuances of this business. And if that happens, then the whole area of Africa, Southeast Asia, all these countries that are dependent on credit and where our neighbor is providing them with a lot of credit, 3 years credit for products, is walking away with business. So this is one. Second, just like what the government of India, what the Honorable Prime Minister has done with the big 1 lakh crore budget for R&D, out of which 20,000 crores was given to the private sector. We need a R&D budget for the defense sector because today the entire defense R&D is done by DRDO. And of course, companies that work with DRDO, we have beginning to understand that we also need to do a lot of R&D to speed up the DRDO process ourselves. So I think there's a need to have a budget available to the Indian private sector for R&D.
Right.
This will be our 2 asks as far as the budget is concerned.
So this is the defense sector, but broadly in terms of chasing a sustained 8 or 9% growth, what we need for a Viksit Bharat, what could unleash private investments in the country overall? Now, I'm not just asking specifically about the auto sector or the automobile sector, but generally lift the sentiments, allow companies to invest, get more FDI. What do you think the budget could do on that front?
I think, to a large extent, the economic policy and thinking is on track. Just look at every sector, whether it's electronics, whether it's data centers, the kind of investment that are getting announced here And 5 years ago, you wouldn't think that was possible. Okay, $50 billion, $100 billion. I mean, these are numbers, mega scale numbers that India could never even dream of, and it's happening. So I think, we are pretty much on track. I think what is really important is now to create the kind of ecosystem within our country, clean up our cities, make proper roads, create an environment that is conducive for business, create logistics that is faster, reduce our logistics costs. We are still running at 16-17% logistics cost compared to 7-8% of China or other countries. I mean, those are areas that have to be focused. Yeah, we are building roads, we are doing all these things, but that is still not reducing logistic costs, because when you are in a city like Pune, for example, to move from Pune to the highway takes about an hour and a half. So there are these problems that need to be resolved, and somebody has to start looking at it in a lot more detail than what is being looked at today.
Right. Mr. Kalyani, as someone who leads one of the biggest defense companies in the country, as an industry veteran, which are some of the areas where you would want to focus on, considering there is a trade volatility going on? The Russia-Ukraine war has not ended. Countries are trying to find new partners. What do you think India needs to double down on? And as a leading private sector company, what would you be doing in terms of all these tensions that we're seeing? Even with India and China, things are not all right. We're still not getting those rare earth magnets. Things are moving slowly on the business and economic relations between India and China. So in this kind of atmosphere, how are you trying to protect yourself, defend yourself, and grow for the future?
Well, I think, what you say is right, is true. But as far as we are concerned, my own belief is that we need to focus on creating our own technology. If you create your own technology in the area of defense, okay, indigenous technology, the market will come to you. You don't have to go anywhere, because you are very competitive, you have the manpower, you have the skill sets, which nobody else has. So the focus has to be on creating your own technology. I mean, you look at our two DRDO products, ATACMS gun and the carbine. I mean, these are amazing products, all designed and made in India. And I think, there are many more such products that we are currently working with DRDO. We are working with for an FICV track, FICV wheel. We are working on turret program. This is another area where there are only 2 or 3 companies in the entire world who make turrets. So we are going to be probably the third company who is going to get into the turret business in a big way here. So
all right.
There are lots of things that you can do, but the whole thing is you have to create your own technology. You cannot go outside and go to somebody and say, "Give me your technology." Because it's not going to give you all of it anyway.
Right. And in light of that, sir, will you be looking at more JVs with either Israeli companies or Russian companies or European companies?
No, I mean, I think we have enough JVs. We have enough activities in that area. We are not doing anything with Russian companies, by the way, because that's on the banned list. But we have a company. We have a JV with Rafael, which is an Israeli company. We don't like too many JVs, because JVs also create a structural problem of creating a structure, a company, managing it. We'd rather do simple arrangements of getting technology and then developing that technology on that base ourselves. And I think that model works well. It works well for the companies abroad. It works well for us also. We also made some small investments in small defense companies in Europe, which we continue to do. We have made an investment in a company in Italy, in Spain, and this is something that we will continue to do.
All right. Thank you very much, Mr. Kalyani, for joining us with your outlook on the defense sector, how Bharat Forge has managed to navigate global headwinds and deliver on growth, and what you expect from 2026 as well. Thank you so much for being with us.
Thank you, and all the best. Happy New Year.
Wishing you a very happy New Year as well, sir. On that note, we take a short break here on CNBC TV18. Don't go anywhere. More news and updates when we return.
Fly Emirates, fly better.
Welcome back. You're still tuned into Halftime Report. Let's talk about the real estate sector. Equity capital inflows into India's real estate market rose 14% on a YY basis to a record high of $10.2 billion in the first 9 months of 2025. In fact, according to Equirus, real estate continues to be the most preferred asset class for investors in the first half of 2025 as well. To discuss more, we are now joined by Vijay Agrawal, lead real estate and infra at Equirus Capital, and Anshuman Magazine chairman and CEO, India, Southeast Asia, Middle East and Africa at CBRE. Gentlemen, good morning. Thank you so much for joining in. The last day of 2025, so there's so much to talk about in terms of the recap for 2025 and the outlook for 2026 as well. Anshuman, let me start with you. What were the big takeaways as far as the deal landscape in real estate is concerned, equity flows as well, which are the sectors which contributed? And do you expect the activity to pick up even further in 2026? And which segments do you think will contribute now?
Great. Thanks for having me. This year, 2025 has been a record year for investments in real estate. Close to $14 billion are expected by even this calendar year. This is unprecedented. And large part of this money actually went into I would say 47% approximately went into buying land. The rest really went into core asset, which means income producing assets, primarily office. 30%, close to 30% in the office sector. As you know, that has performed really well. And the rest, of course, we saw some investments going into data center, hotels, and overall, this has been a great year. Also, this was a record year for office leasing. Close to 84 million square feet of office space is expected to be taken up by the end of this year. There's still a few days left while we get all the data together. And this is marginally about 4-5% higher than last year because the base was quite high. So yeah, 25 has been a great year. If you look at the last 3 years in India, more than 225 million square feet of office space has been taken up. So yes, it is great, and we are hoping the momentum will continue in 26. Although the percentage increase in these numbers may not be higher in 26 because the base is higher, but even if we increase it, what is expected at 4-5-6%, it will mean a lot of activity in the investment side in real estate in 26 even.
Anshuman, would it be the same sectors, data centers, hotels, hospitals, which would lead to that increased activity?
Yeah, see, what has happened is the large part, like I said, money is still going into residential and mixed-use development because that market has been good. So money normally flows in where, of course, the returns are higher as well as faster. But India's real estate market, one of the big strengths is its office market. A lot of the money, because the underlying occupiers are multinational companies, the yields are stable, and you're investing in core, so you're not taking development risk. I think that will continue. But the additional one, which will expand, no doubt, like you mentioned, data centers, we'll see more investment going there. We'll see more investment going to hotels and hospitality. This year, as you know, there's a big bounce back in the hospitality sector. And of course, healthcare. Healthcare is a major one, which we're already seeing a lot of investment happening,
Okay, all right. Just hold that thought, gentlemen, because we do have some important news which is coming for walk hard, so that stock should come up for you. It spiked up on the back of news that the European Medicines Agency, which is basically the European regulator, has given an accelerated assessment for WCK-5222, which is basically Xenic, that antibiotic drug which they have already received US FDA accelerated approval for as well. So that's the reason why you're seeing walk-hard spike up around 3% at this point in time. So important news coming in there, where after the US, it is Europe which is given accelerated approval for this particular drug. But Vijay, just wanted to narrow down on the residential market and one sub-segment of the residential market, which is basically your luxury as well as your ultra-luxury segment, which did see a strong amount of demand in this year, at least for the first half. Are you seeing that kind of momentum in terms of prices as well as volumes going into next year?
Hi, thanks. See, I think there is little bit slowdown on this luxury and ultra-luxury segment. Across all the markets. Some micro markets are doing well, but some markets we are seeing a little bit slowdown, which may be reflected in the next year's results, maybe H2 results of the company. H1 we had a very solid results from all the players, but the channel checks are saying that there's a slowdown.
Okay. Anshuman, I just want to pick up the point that you were talking about. Data centers, you expect that to do well. GCCs, you expect that to do well. Overall, we had a discussion today on data centers, and the opportunity seems to be large over the next couple of years. Could you just highlight in terms of where are you seeing these big opportunities for data centers as well as GCCs? Is it more tier 2, tier 3 where we'll see more development coming in, or even metro cities like Mumbai currently where there are more data centers is where the growth will come from?
The data centers will continue first to develop in the main cities. Mumbai, Chennai are major cities where data centers are coming, but we will see activity in Bangalore, Noida. It'll pass, but it would have to be because, as you know, data centers are 2-3 things. One, they are highly capital intensive. Number two, they need a lot of power and water. And everywhere, most of the cities and states sometimes do not have the amount of power and water you require. And also the investment required, some of the investors may not want to put in those tier 2, tier 3 cities. So the data centers, there will be a lot of investment going on, but the speed of development of data center, for example, are not going to be like logistics, where you can build a warehouse in 9 months and get running. Here, because of the capital investment and also land acquisition, etc., it takes longer time to develop a data center. But the fact remains, we are still, as far as the data center is concerned, we're still a small market. So next 4, 5, 7 years, we'll see major activity and billions of dollars will come into data centers. You mentioned global GCCs, the Global Capability Centers. That's what is driving our office market. And in going forward, also the Global Capability Centers, the existing companies who are already here are expanding substantially. But we will see new companies coming in. In fact, in spite of so much talk about global capability centers, there are still many firms in America and Europe who have still not offshored into India or have not expanded on their own. They're given to third-party service providers. And what I expect going forward is that this market is only going to expand. And it will actually, because our base is high in the office sector, it will, even if it sustains or slightly increases from the base today, it will be huge activity in the office market.
Okay, take that point. Vijay, quickly, you also mentioned that in last 3 years, REITs got the highest amount of funding, followed by large caps. Then we had mid caps. Do you think 2026 will be the year for REITs? What about some of these big developers in the residential space as well?
So REITs definitely, there are many developers who who can launch their REITs. Maybe I think there are 3-4 developers who have a size and they can launch the REITs in coming next 2 years. Residential players, we are also seeing there are players from Bangalore, Chennai, like Casa Grande is coming from Chennai. Bangalore, there are 3-4 more developers can come for their IPO in the capital markets. Then NCR region, Mumbai region, there are few developers who have a good size. They can also plan for their IPO.
Okay.
I think tier 2 and tier 3 cities, we will have a challenge because they will not have a scale to get the IPO listed.
Okay, all right. Anshuman, quickly then, we've spoken about the places where you could probably see high growth, but Vijay is, alluding to a little bit of pressure in the residential market, if I'm not mistaken, going into next year. Would you share that sentiment that maybe prices could possibly stagnate? Do you think there's a possibility of a correction in prices?
That would depend on the city. Today, the way our market is developed, you can't put a general comment because, for example, in places like Gurgaon, where the prices have gone up significantly up, or parts of Mumbai, there could be a slowdown in price increases. There are other markets where there is a shortage of supply in prime areas, so you'll not see prices coming down. But overall, real estate, like any other sector, is cyclical. We have had a great run for a few years. It is inevitable that growth is never perpetual. So it's inevitable things may slow down in certain micro markets and residential, especially where the prices have gone up significantly up since last few years. In fact, in a short period of time, we have seen, in some micro markets, exponential increase in prices. And obviously, they're not sustainable. But overall, if you look at the residential demand, I think it is here to stay. There would be slowdown in some markets. We can't avoid that,
Okay, Anshuman as well as Vijay, thank you so much for joining us this afternoon. Hope you all have a great New Year as well. Happy New Year to both of you all, your families as well as your team as well. But on that note, we are going to take a very short break. After the break, we're going to come back and Manisha Gupta will be in conversation with Saurabh of PNG Jewelers. So we'll wait out for that conversation.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back to Halftime Report on CNBC TV18. Nifty as of now 26,100 above that mark. But what's happening in the world of FNOs? To bring us those latest trends, we have Mangalam joining in with us from the FNO desk. Good afternoon, Mangalam. And today in the morning, I'm going to say that Sudarshan started the day by talking about FNO saying Ant bhala to sab bhala. Seems like wahi ho raha hai. We are seeing 2025 and beginning of 2026 at 26,000 levels.
Well, I don't know what Ant Sudarshan was talking about, because in my case, it's Shuruaat. It's the start of the Jan series, right? It's day one of Jan series today. And we had the Nifty Bank, the Midcap index, both doing well, all three of them doing well. So in that regard, I think Sudarshan and I, speak about the bhalai of the bulls and not whether it's the start or the end. The good part is that the Nifty has crossed important technical levels. So it's above 20-day moving average of around 25,982, now closer to that 26,100 mark. And the advanced decline, this was something which was a bit of a pain point for the market for the last 4 or 5 trading sessions, where more number of stocks were declining than the number of stocks which were advancing. So the new series has started fairly well from a bull's perspective. The good part, however, is that it's been led by indices that have been doing well all through 2025. Metals, autos and PSU banks. If you look at the top index, sectoral indices gainers, you would see these three at the top of the list for 2025 gainers. And the one which is underperforming today has actually been an underperformer all of 2025 as well. Importantly, now that the Nifty is crossed past that 26,000 mark, a lot of these put writers are active there. And now it's crossed, it's flirting above that 26,100 mark. But call writers at 26,100 are still fairly active. And the premium out there is closer to 100 rupees. So the street is playing for a range of around 26,000 or 25,950 as a support, and on the way up around 26,225 or 26,200 as resistance. So those are a couple of levels that we will be tracking very closely. And in terms of individual stocks, so watch out for Sammaan Capital. With the kind of open interest jump that we're seeing, it is likely that the stock enters FNO band, if not today, then over the next couple of sessions.
Okay, all right, Mangalam, thanks very much for that. So those are all the FNO cues lined up. We'll take a short break. We're up next, commodities with Manisha. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back, and joining us now is Saurabh Gadgil, is Chairman and Managing Director at PNG Jewelers. Saurabh, hi, good to have you, and last day of the year, and what a year it has been in sense of price moves to begin with. First of all, a question on that itself, because even as we are the last few hours of this year, we still are talking about price moves that we continue to see in gold, in silver, in platinum, in diamond, etc. How would you rate 2025 as a year where price perhaps was a headline through and through?
Hi, Manisha. Wishing you and your viewers a happy New Year 2026. See, the year has been a year which is full of gold and silver price movements. I think gold has almost doubled, silver has tripled this year, and it's been an unprecedented year. But having said that, consumers have remained focused on the market. Both investors and jewelry buying has been, quite decent. Diwali was a blockbuster for us the entire year. And a lot of trends are coming out. People's faith in gold is still very strong. Silver is seeing a lot of demand from even first-time investors. And the trend towards lightweight jewelry, the trend towards lower caratage, I think it started picking up. So the next year is going to be a very interesting year when if prices remain at these levels or go further up, how will the market accept these things? Will lightweight jewelry rule the roost? Will it be 18 karat? Will we see 14 karat coming in? So I think all these questions are what are the challenges for the upcoming year.
Oh, absolutely. Saurabh, what are you planning then? What is your sense in the next year? What is it that you as PN Gadgil would be focusing on if we look at the prices here, if the price volatility continues?
The expansion will continue as we have mentioned in investor call also that we'll be adding another 20-25 stores next year. A combination of our PNG traditional stores and our new format LS by PNG, Lifestyle by PNG. So focus will be to add at least 12 to 13 lifestyle stores. So this format is what we think has caught up very well. We are on 4 stores old in LS by PNG, and we recently signed Sarah Tendulkar as the face for lifestyle. So that I think is a format which is young. It's a no occasion buying, trendy design, and that I think is somewhere not concerned with prices. It's more design oriented. It's more fashion oriented. So that's going to be our focus for next year, along with our traditional full-fledged PNG stores. But I think growth will continue, and we are positive that the market in India looks very strong. Gold here, jewelry here is not just a piece of jewelry. It's emotion, it's culture, tradition. So I think all this will keep the market momentum going, and expansion will continue. But yes, definitely, I think lifestyle, lightweight jewelry is what the focus will be for the coming year.
Oh, well, absolutely. Fusion jewelry design is going to be the hero, and that is perhaps what will lead to a lot of buying in the next year as well. But sort of coming on the diamond part of it as well, and that seems to have picked up given the fact that gold, silver, platinum, palladium, everything gained, but not diamond prices.
Yes, diamond, I think, has been steady for the entire year. Diamond had seen a steady price rise at the retail level of around 3-4%. But that has kept consumers, quite happy with diamond buying. Natural diamonds are doing well, and I think will continue to do well as we go ahead. So I think diamond and color stone is a category which will again see good growth in the coming year. Diamond, I think, is right now still 18 karat. Gold may come to 14 karat. But diamond and precious stones, especially emeralds and rubies, I think will be what will be in focus for the year 2026.
All right. So diamonds and emeralds are going to be in focus next year. What are you buying?
I really don't know. I have to think. There's so much to buy.
It would really be interesting to know what the diamond prices will trend at next year, Manisha. What do you think, considering that just earlier this week, we're talking about how Titan is getting into the entire lab-grown diamond segment. So it just goes to show that, natural diamonds might not be the preferred lot anymore.
Oh, well, yes. Even after years and years of India buying natural diamonds, the penetration is only at 11%. So clearly not too many people own it. And diamonds, naturals that is, made an all-time high in 2022. From those all-time highs, we are down by 40%. So, well, that is where naturals are. And as far as lab-growns go, well, yes, you can own a ring and a big one, lab-grown at 25,000-30,000 rupees. So I think that is where the aspirations are.
All right, Manisha, thanks very much for joining in and talking to us about the entire precious metals market. We'll take a short break, but we'll get you more on the markets, more on stocks once we're back. Stay tuned.
Fly Emirates, fly better.
Welcome back. Well, for the broader markets, it's definitely picking up pace on the last day of the year. So the Midcap index is currently up around 1.3%. We have the Nifty, which is up around 200 odd points as well. So good going. We do have the steel stocks, which are dominating today. So GSW Steel is up around 4.7%. But even the banks are not doing too badly. So the IndusInd Bank stock should come up for you. That stock is up around 3 odd percent. It's not done much this year. It's down around 9.9% on a year-to-date basis. But today it's picking up pace, up around 3 odd percent for that counter. Reliance Industries also on the upside, up around 2 odd percent for that stock, along with Titan, which is up around 2 odd percent as well. It's just a handful of stocks, just about 6 stocks which are declining on the Nifty. So we have TCS, Wipro, which are on the downside, along with Infosys as well. In fact, the entire IT pack is seeing a little bit of profit booking, and through Sun Pharma in the mix, but just about marginally lower for Sun at this point. On that note, it's a wrap on the last edition of Halftime Report in 2025. Thank you very much for watching. Thank you from the entire team. Business Lunch will take all the action ahead. Nifty trades with a positive bias in the last trading session of 2025. Mid-caps and small-caps trade stronger in a repeat performance for the second straight day. Metals and PSU banks lead sectoral gains. The oil and gas pack also join in with strong gains today.
The government has imposed safeguard duty on selected steel imports for 3 years. The duty will be imposed at 12% in the first year, 11.5% in the second year and 11% in the third year, as recommended by the DGTR earlier. Steel stocks respond favorably. JSW Steel, Tata Steel are the top gainers on the Nifty.
The world's best-known investor Warren Buffett is stepping down today after 6 decades at the helm of Berkshire, where he grew into a massive conglomerate whose businesses include insurance, utilities, rail and more. Along the way, he became the leading voice in the world of investing, doling out words of wisdom in his highly anticipated annual letters to shareholders.
Hello and welcome to Business Lunch, live from the Motilal Oswal studio. I am Arundhati Ramnan and with me is Ekta Batra. Hi Ekta, good afternoon. It's been quite a day for the markets, right? They're all in party mode right now. But for the year, the Nifty up 10%, but still, lagging some of its peers.
Hi, Arundhati. Yes, absolutely. Lagging a couple of its peers, and the pain in the broader markets and specific stocks is something that can't go unnoticed. But for today, we're ending the day on a high, or maybe at least that's what it looks like at this point in time. So we have the Nifty, which is up around 200 odd points, and the Midcap index, which is up around 1.3% at this point. The advanced decline ratio is holding on the positive side. So we have around 2,900 stocks advancing to just about 1,300 to 1,350 stocks which are declining on the Bombay Stock Exchange. Talking about specific stocks, the one sector which really stands out is the entire steel space. So we have the safeguard duty, which is really aiding counters today.
Absolutely. The steel stocks are doing really well today on the upside. The boost came after the government announced that much awaited and expected safeguard duty for the next 3 years. If you take a look, Jindal Steel, JSW Steel, all of them gaining over 4% in trade. Those auto names today also doing very well ahead of those auto sales numbers, which are expected to be good. TVS Motor, Eicher Motor, Bajaj Auto, all of them over 1% in the green. The only index that's seeing some profit booking today is that IT pack, down about 0.2%. We've got TCS, Wipro, Tech Mahindra, all of them lagging in trade today. But our top focus this afternoon is steel stocks, which are surging after the government announced a 3-year safeguard duty of up to 12% on select steel imports. Sudarshan is here to tell us more on that. Sudarshan?
So steel sector has got the New Year gift. If you remember, this month only in the first weekend, Steel Secretary had come on the channel. We had asked him about this safeguard duty, and he had told us that this would be announced very soon. If you remember, April 2025, that was the time when DGTR, Director General of Trade Remedies, had announced temporary safeguard duty, and that was applicable for 200 days. And it expired in the early part of November. After that, we were expecting that it's going to be announced very soon, and finally it came, and government has now announced safeguard duty that would be applicable for next 3 years, that is till 2028. So first year from April 21, 2025 to April 2026, the duty is of 12%. After that, it comes down to 11.5% for the second year. Then it comes down to 11% for the third year. And this is applicable to all the imports that we do from China, Vietnam, and some of the other countries. And it's being taken very positively for steel companies, because normally this is the period when prices come down. So it's going to support the domestic industry, and that's the reason you are seeing a big move in all the major names. Tata Steel, JSW Steel, top Nifty gainers amongst Midcap, JSP, and all the other names are also higher in the trade.
Okay, absolutely a great day for steel stocks. But Sudarshan, stay on. Auto sales numbers for the month of January will be released tomorrow. Give us a preview on what we can expect.
So highway run for the auto segment started in the month of September, may continue even the month of December, and all these auto companies are likely to end 2025 on a very high note. We are expecting a strong set of numbers across the segment. All the companies are expected to report a double-digit growth as far as wholesales are concerned. If we talk about the commercial vehicle, that's basically being aided by or supported by rising freight rates, and as far as passenger vehicle and two-wheelers are concerned, the higher conversion that we had started seeing post GST rate cut is likely continuing even in the month of December. Even the ongoing wedding season is aiding to the demand. So now talking about the sector wise, Two-wheeler is expected to see a growth of 30%. Passenger vehicle is expected to see a growth of 22%. Commercial vehicle growth maybe 12%, and even tractor segment is expected to see a growth of 18%. These expectations are from Nomura. If you talk about the company-wise in two-wheeler segment, all the companies are expected to report a double-digit growth, with Bajaj Auto's growth rising by 15%, Hero Moto 26%, TVS Motor 23%, and Royal Enfield too may see a growth of more than 20%. Coming to the passenger vehicle segment, again here also double-digit growth, with Maruti seeing a growth of 19%, Hyundai may see a growth of 14%, even Tata Motors passenger vehicle may see a growth in the double digit, and that can be 17%, and M&M Auto continues to outperform, and their growth can be up to 22%. Talking about the commercial vehicle segment, Tata Motors commercial vehicle may see a growth of 14%, Ashok Leyland growth may come at 17%, and in the tractor segment, Mahindra & Mahindra tractor may see a growth of 15%. So all in all, it's a double-digit growth across the sector, and strong month, basically strong December, we are expecting from auto companies.
So double-digit growth expected for the auto pack in those sales numbers. Thank you so much for those details, Sudarshan. The Nifty is set to end the year with returns of 9%. And while this figure may seem subdued, the story under the surface paints a different picture. At the end of last year, we told you about 10 index constituents who were set to make some or the other record, good or bad, by the end of the year. Hormaz Fatakia is here with the stocks on his radar. Hormaz?
Well, it's been a very engaging year for the Nifty, if you would like to call it that, because even if the index has given single-digit returns in the positive, there have been enough and more stocks that have made noise all through the year. Let's start off with one big name that has been Trent. And if you look at this chart, after years of delivering stellar returns, some even doubling in 23, doubling in 24, it is the first time after 2013 that Trent will be delivering negative returns. The stock is down 41% this year. There have been downgrades, yet the street continues to remain on the positive. 17 analysts still have a buy rating on the stock, 6650 being the highest target, 4300 being the lowest. In fact, Trent is now trading below its lowest price target as we end this year. We spoke about Reliance Industries breaking one record, but then you can't keep the big boy away for far too long, and after that minor blip in 2024, the stock is back to winning ways. A 27% return in 2025. It's turned out to be the best year that the stock has had since 2020. The street continues to remain near consensus bullish towards the stock. 35 analysts still have a buy rating, 1890 being the highest target, 1350 being the lowest among the few that still have a cautious stance on the stock. Consistency is the key, as they say, and HDFC Bank justifies that tag. Last year, we were talking about the fact that despite being positive returns, 3 out of the 4 years have seen single-digit returns for HDFC Bank. It has defied that norm this year, 11% higher on the Nifty Big Boy, India's largest private sector lender, and continues to deliver positive returns ever since the start of 2015. Here too, the street remains a near consensus bullish recommendations, with 46 analysts still saying a buy, 1460 being the highest target, just around 1050 being the lowest. A stock that has had a wonderful year has been Eicher Motors, and after just one single negative year or two in 2018 and 2019, the stock is up 51% this year, and it is turning out to be the best year the stock has had since 2014, when the stock had tripled in value, and it is still among the best performers on the Nifty this time around. The street here, well, it's a slightly mixed opinion here. 22 analysts still say a buy rating, highest target being around 8,000 rupees, the lowest being around 4,700. 6 analysts still believe that valuations are expensive and continue to remain cautious on the stock. Tata Group in general has had a very disappointing year, and leading the pack is TCS, the largest group company, of course. It's turning out to be the worst year that TCS has had since 2008. That year, the stock was down around 60%. This year, the stock is down 20%, in line with all of the fall that you have seen in the IT names, but it has been one of the major reasons why the Nifty upside was capped this year. Yet, analysts are still seeing that the tide is turning for TCS, 4,810 being the highest target, 2,800 being the lowest. 36 analysts still say a buy rating. As we mentioned, consistency, one stock that has also justified this parameter is Bharat Electronics, or BEL, and barring 2018 when the stock had halved, it has been a positive journey for the stock. In the last 5 years, the stock has has delivered double-digit returns and healthy ones at that. There's been a 33% return this year as well for Bharat Electronics is the top gainer on the PSU index, and 27 analysts still believe that the stock still has more upside left, highest target being in excess of 680 rupees. Possibly the stock of December, and among the best NBFCs, Shriram Finance is one such name. After 3 negative years, the stock has had its 5th positive year, 70% higher this year. It has turned out to be the best year that the stock has had since 2017. And here too, the street continues to remain bullish. 35 buy recommendations, no sell recommendations, 1225 being the highest target for the stock. We don't necessarily talk about Grasim when we talk of Nifty names, but here too, the stock has continued to deliver steady returns, if not stellar, and 4 out of the last 5 years the stock has delivered double-digit returns. In fact, barring 2018 and 2019, every time the stock has gained, the stock has delivered positive double-digit returns with the exception of 2022. Here too, the street continues to remain bullish. 8 analysts have a buy rating with targets going up to as high as 3,700 rupees. For Adani Enterprises, it's turning out to be the 3rd straight year of negative returns for the stock, and this time it's been a double-digit fall for it. And here too, and it does not have any much analyst coverage, does Adani Enterprises, so a 3rd straight year of negative returns. And the last one here is HUL, Hindustan Unilever, and I'm talking about the stock being on the edge. Why? Because as of now, the year-to-date returns on the stock is 0. But why is this important? Is because never in the last 30 years has Hindustan Unilever delivered 2 back-to-back years of negative returns. The last time it delivered negative returns was in 2021, then that 13% fall in 2024. It remains to be seen whether that streak gets broken by close of trade today, but the street continues to remain bullish on HUL as well, with almost 32 analysts still saying a buy, targets going up to as high as 3150. But that was the Nifty for you this year. The returns may be quiet, but there have been stocks that have made noise, some for the good, some not so.
Okay, absolutely, Hormuz, and absolute extremely good analysis in terms of how the year panned out. On that note, we're going to take a short break, but quick commerce gig workers have announced a nationwide strike demanding better working conditions. Details on that after this short break.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're still with us on Business Lunch. Moving on, in response to a nationwide strike by gig workers, platforms like Swiggy, Zomato have increased their delivery incentives and peak hour payouts. Shilpa Ranipeta is here with more details on that front. Shilpa?
Well, with gig workers threatening a nationwide strike on the 31st of December today, later in the day when the orders are at peak, food delivery platforms are quietly pushing back with higher peak hour payouts. Now, Swiggy and Zomato have been messaging delivery partners over the past 2 days, offering additional incentives through the evening and late night slots, which is when the order volumes are at their highest. Now, some of the messages seen by CNBC TV18 show that delivery partners are being offered about 30 rupees extra between 4 to 6 p.m., between 100 to 105 rupees extra between 6 to 10 p.m., and about 80 rupees between midnight and between 10 p.m. and midnight. Zomato is also offering an additional 80 rupees between midnight to 4 a.m. Instamart, Blinkit, Zepto are also offering higher peak hour payouts. Now, this, remember, is on top of the roughly 25 rupees per order that delivery workers say that they typically earn through food delivery orders. Now, workers argue that these short-term incentives still do little to address the deeper structural issues, which is what they're protesting against. Nearly 1.7 lakh gig workers, led by the Indian Federation of App-Based Transport Workers, have threatened to go on strike on New Year's Eve. They are protesting unsafe delivery targets, falling wages, arbitrary ID blocking, police harassment, and a denial of dignity and social security. Now, they are demanding that there be regulation under labor laws, fair and predictable wages, mandatory rest break between deliveries, and the right to organize, and all of this even as they await the implementation of the Social Security Bill. Now, brokerage Elara Securities, in a note earlier this week, estimated that a widespread strike could hit order volumes for Eternal and for Swiggy by up to 10 to 20%, and that could translate to a 0.3 to 0.7% revenue impact in the third quarter in food delivery and quick commerce. And this will largely be in select southern metro markets, is Elara's estimate. Now, festive days, remember, typically see up to 60% higher orders than usual. But Elara also flags that there could be limits to this disruption because New Year's Eve is among the highest earning days for gig workers, and this sector is still very highly unorganized, and login decisions are often driven by individual incentives, and that's something that platform workers are now leaning on. Now, a strike that also happened on the 25th of December saw about just 40,000 workers participate, with limited impact in small pockets of in areas like Gurugram and in some southern markets. Remember, India has 1.7 crore delivery workers. Swiggy and Zomato have declined to comment. For now, incentives are the platform's first line of defense, even as worker unrest continues to simmer. Back to you.
Okay, all right. Thanks very much, Shilpa, for that story. We'll take a short break, but for now, it's Warren Buffett's last day at the helm of Berkshire Hathaway, bringing an end to a legendary 60-year career. A recap of the iconic investor's journey and succession strategy at Berkshire Hathaway follows on the other side. Stay tuned. Welcome back. You're still tuned into Business Lunch on CNBC TV18. Well, as we wrap up on 2025, today also marks the last day of Warren Buffett as the CEO of Berkshire Hathaway. This will end a career spanning over 60 years, which spanned from him being known as the Oracle of Omaha to his bets being widely publicized, quotes quoted by every market participant, and so on. Hormuz joins in to take us through his journey and to brief us on his successor.
Today may be the last day of 2025, but this day also holds special significance because today is the last day of Warren Buffett as the CEO of Berkshire Hathaway, ending a career spanned over 60 years that took him to be known as the Oracle of Omaha, to his bets being widely publicized, quotes being quoted by every market participant, and so on. Now, everyone is aware of the fact that Buffett bet on Berkshire simply because it traded below its working capital value at that point of time. Today, that investment has created a conglomerate that spans across insurance, infrastructure, railways, energy, consumer and industrial brands, and of course, the much talked about investment portfolio. The price was what he paid back then. The value is what stands today, 6 decades later. Today, to buy one Class A share of Berkshire, you need to shell out $750,000. Yes, that's Buffett and his principle of long-term compounding for you. A $1,000 investment back then, 60 years ago, would today be worth $45 million. Someone is definitely sitting in the shade today because someone planted a tree a long time ago. You see what I did there? Or as the Gen Zs would like to say, hashtag if you know, you know. Buffett leaves Berkshire with a massive cash pile, literally massive, $382 billion. Now that is more than the GDP of 152 countries on the planet. And just as all good things come to an end, Buffett's stint has also ended. But the question now is, what next? Who takes over the reins of the conglomerate? Meet Greg Abel, the 63-year-old Canadian who takes over the widespread conglomerate starting tomorrow. Abel is not a direct Berkshire insider though. He started off as a CA with PwC, then joined Cal Energy in 1992, and Cal Energy then went on to acquire Mid-American Energy in 1999, post which Berkshire had acquired a controlling stake in the company. He then became CEO of Mid-American in 2008, which was then renamed Berkshire Hathaway Energy in 2014. Abel quickly climbed the ladder at Berkshire. In 2018, he was named the vice chairman for its non-insurance operations and also appointed to the board of the conglomerate. Buffett had confirmed that Abel will succeed him as Berkshire's CEO back in 2021 itself, but made the formal announcement in May this year, stating, and I quote, "The time has arrived where Greg should become the chief executive officer of the company at the year end." Only Buffett's children knew of this, not even Abel. Maybe Buffett knew of Abel's competitive advantage and above all, the durability of that advantage. Abel's presence is already being felt in Berkshire circles. As recently as November, Berkshire disclosed a $4.5 billion stake in Google's parent Alphabet, sending Wall Street into speculation mode, as this could not have been Buffett's decision alone, considering his prior anti-tech stance. He always called Apple still his biggest bet despite the selling spree recently, a consumer tech company. But there is a lot that Abel still has to conquer. First up, win the trust of investors, the shareholders, the Buffett Pugloos, as the Gen Zs would say. Although the board has wholly backed Abel, the shareholder trust would be paramount. Next up, hunt for bets to deploy Berkshire's cash pile. There were some murmurs about Buffett's lack of will to deploy that cash and prefer the safety of treasuries instead. The Alphabet stake may just have been the start. A major reason why Buffett picked Abel was his trust that he will continue the culture at Berkshire. Unlike Buffett's showman-like aura, Abel prefers to stay away from the limelight and let his work talk. He was also once hailed for this attitude by the late Charlie Munger. Of course, being at the helm of something as big as Berkshire will keep Abel in the limelight, but his balancing act of managing this and simultaneously delivering on the promises will be closely monitored. With Buffett at the helm of Berkshire, there was a sense of continuity, the thought that he'll be around forever. But that's not the case. Even if in hushed tones, questions are being asked. What next? Will Berkshire still be Buffett's Berkshire, or will Abel be able to turn a new chapter in this story? Abel has now stepped into shoes that once looked impossible to fill. While they may not be impossible, they certainly are large ones, $1 trillion and a little more large for sure.
Absolutely. Thank you so much for those details, Hormaz. But, let's take a look at the markets, all of them in the green at the high point of the day, hoping to ring in the new year on a positive note. The Nifty is well above that 26,100 mark at 26,154, 200 points higher. The Midcap index faring better than the blue chips, that index up over 1%. But with that, it is a wrap on this edition of Business Lunch. Here's wishing all of our viewers a very prosperous and happy new year. From Ekta and me, goodbye and many thanks for watching. Midcap Radar coming up next.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. And we are coming to you live it's the last Midcap Radar for the year 2025. We do start the January series as well. And what a stellar rally on the first day. Nifty comfortably above the 26,150 mark.
That's right. Good afternoon, Sonal. And the good part is, most of the portfolios that have mid-caps, that's doing quite well. The mid-cap index is trading well above the 1.2% mark. So that's something that's very positive. Lot of beaten down names, especially EMS stocks. All of these stocks have recovered quite sharply in the session today. But a lot lined up on the show. So let's start off the top headlines. Market at day's high as on the last trading session of 2025. Mid-caps and small caps outperformed frontline indices in a repeat performance for the second straight day. Metals and PSU banks lead sectoral gains while IT stocks drag marginally.
Privi Specialty Chemicals slips more than 10% after equity worth 1,100 crore rupees changes hands. Promoter group entity likely to have sold stake in the company. We'll await the details in the block deal data.
Zydus Wellness skyrockets on the Motilal Oswal note. A buy rating with a target price of 575 rupees a share based on what the brokerage calls the best risk-reward profile in the industry.
Indian Hotel sells its entire shareholding in Taj GVK Hotels and Resorts. Promoter Shalini Bhupal acquires 25.5% stake for 592 crore rupees. Okay, some stocks which are on our radar now. As Vivek pointed out earlier, mid-caps are surging. It's a 1.1% gain there. Bank Nifty is too supporting the broader, the benchmark index. That index is up 1.3%. Metals, that's a one-way rally for metals. We have been talking about it every day, and that continues to be the case today as well. That index is up almost 2%, pushing the Nifty higher as well. But mid-caps and small caps, they continue to be on our radar. And as you pointed out, that space is seeing a stellar rally.
Well, that's right, making the portfolio feel a little better on the last day of the year. Well, two stocks on the radar. The first one, of course, will be Idea. All eyes will be on the outcome of the cabinet meet, whether there is any update on that. Idea, that particular stock is up almost 4%. And along with that, Industars too is in focus. But these stocks and a whole host of other stocks is what Sudarshan has on his radar. This is our special segment, Midcap Movers. Sudarshan is at the wall to take us to the mid-caps that are moving around in the session.
So after a few days of range bound of trade that we have seen in the market over the last few days, finally today it's the day that we are seeing all-round gains, and one segment or one sector that has been in the focus for the last few days, and today also it's in the focus, and there is a news flow. Finally, government has announced safeguard duty, and that will be applicable for next 3 years, and safeguard duty in the first year is 12%, and going forward it will come down a bit, and in the last third year, it will be 11%. And tracking that news, we are seeing a big move in all the steel names. SAIL, you can see up more than 5%. JSPL is up almost 3%. Similar move is seen for Kalyani Steel. 7 your top Nifty gainers are also JSW Steel and Tata Steel. Now, amid all-round gains that we are seeing in the market, all the oil and gas names are trading higher with healthy volumes. OMC, HPCL, BPCL, IOC higher in the range of 3 to 5%. Even Oil India and Gujarat Gas are trading with gains in the range of 4 to 6%. EMS companies, the question is, all these companies, are they seeing fresh buying or there is something else? Because today all these companies have seen a sudden up move in the last 1 hour. PG Electroplast up more than 3%, Amba Enterprises up almost 2%. Similar move is seen for Dixon Technologies. And lastly, Keynes Technology also, after being under pressure for the last few days, today this stock is also higher, up almost 2%. But there are certain stocks, there are certain pockets which are under pressure even this strong session. First one is Hindustan Zinc, and there is a reason to it because silver prices have been volatile over the last few days. Today in the early morning trade on the MCX, there was a sharp fall in the silver price. It had fallen as much as 7%, and because of that you are seeing a downtick in Hindustan Zinc. PV Fintech, there is a reason again. Commission charges, IRDI, that is the insurance regulator, may come out with a draft regulation norm, and because of that this stock is under pressure. And last one is PV Specialty. Promoter is likely to have sold more than 6% stake worth more than 1100 crore, and because of that this stock is under pressure as well.
Okay, yes, we've been talking about that stock and discussed it in greater detail as well. But Sudarshan, thank you so much for joining in. That's about all the mid-cap movers that are in focus. Let's now welcome Ruchit Jain from Motilal Oswal Financial Services for a technical check on the markets. Ruchit, good afternoon. Thank you so much for joining in. Well, what are the charts suggesting? The January series has started on a strong note. Will we see additional gains on this by the last hour of trade?
Yeah, very good afternoon, Sonal. Very good afternoon, Vivek. Well, if you look at last 2 months, the last 2 series, I think markets have seen more of a consolidation on the index front. October end, we were around this 26,000 mark, and still we are around that 26,000 mark only. But if you look at this entire consolidation, the good thing is that the index has managed to take support around its 50 DMA on every correction, and markets are not closed below 50 DMA even on a single trading session. So that DMA is now placed around 25,800. So I think till that support is intact, overall biasness remains sideways to positive. And if you look at the sectoral momentum, last few weeks, I think it was only the metals which were witnessing a good up move. But now we can see that participation coming in from banking, NBFCs, OMCs, auto. So up move is getting spread to different sectors now from just one sector. So I think this is a positive sign, and that should lead to further up move in the near term. So we are also advising to trade with a positive bias till 25,800 on the Nifty is intact. I think market should head higher in the near term.
Well, thank you so much, Ruchit, for views as far as the index is concerned. But for the last trading day of 2025, what are your top picks?
So we have a couple of recommendations from the large cap space which are looking good. One is Tata Steel. Overall metal space definitely has done well, but now the steel-related stocks have started seeing some good momentum with increase in volumes. Tata Steel has already formed a base around its 200 DMA recently. So at current levels, we recommend to go long here with stop loss below 173 for potential up move towards 200 in the near term. And OMCs definitely seem to be one of the space where we should see some good moves ahead because of the bullish price volume actions which are happening. IOC within the space, we like all three AMCs, but the risk reward ratio on IOC is favorable at current levels. No, considering an HPCL and BPCL have already seen a good move. So at current levels with a stop loss below 161, short-term traders can go long on IOC for potential up move towards 176.
All right, take that point, Richard. Thank you so much for joining in and wishing you a very happy new year. That's about the market technicals, but we'll slip into a break. When we come back, so many stocks in the broader markets which are moving around. We'll take a look at them.
You want to talk business? Meet me in the onboard lounge.
Welcome back to Midcap Radar. Well, the market strength continues, especially in the broader end of the markets. But one particular stock that's doing quite well is Govt. It's buzzing in trade after a positive development for its drug Zenec. Ekta joins in with more details.
Govt is ending the year with what seems to be another positive for its antibiotic under development Zenec, also known as WCK-5222. The drug has been given accelerated assessment status by the European Medicines Agency or the European regulator, which means that the EMA will review the drug faster than usual. This accelerated assessment status followed a pre-submission meeting that the company had. Now, this development, remember, follows the US FDA, which is the US regulator, accepting Govt's new drug application for Zenec just earlier this month, which was the first ever acceptance of an NDA by an Indian pharmaceutical company. Now, Zenec has already been used in more than 70 patients under compassionate use. Govt has indicated that they were expecting faster approvals after the US FDA nod and expects US FDA approval by mid next year for the drug. Manufacturing, they have indicated, is going to be planned through a European Contract Manufacturing Organization. Now, when it comes to numbers, Wockhardt estimates that the peak sales potential of this drug could be around $1 to $2 billion, with around 40% coming in from the US market itself. The India opportunity, however, could be around 150 crores in terms of peak sales, but they are still to receive approval.
All right, thank you so much for joining us with all those details, Ekta. The other stock on our radar is Bharat Forge, in focus after receiving 1,662 crore rupee contract for supply of CQB carbines to the army. Baba Kalyani, the CMD of the company, tells CNBC TV18 that they are likely to close FY26 with an order book close to 14,000 crore rupees. Listen to that conversation.
First time Indian designed products and developed products are competing with foreign products and winning. I think that's a very significant milestone that we've been able to achieve. We don't have any external collaborations here. It's all internal. This gun, right from the raw material to the finished product, is all made in our plant. We have set up a special plant for this in Jejuri. It's a plant that has got a capacity to produce about 50,000 to 60,000 weapons per year. But easily, it's a modular plant. It can easily be doubled, tripled based on the requirements that are there. A lot of interest from companies abroad in terms of wanting us to produce weapons for them here. So that's another thing we are beginning to see. And those quantities may be even bigger than the quantities that we are looking at for the Indian Army. We are looking at export orders for artillery guns, which are in process, and hopefully they will get materialized in 26. Currently, we have an order book of almost, I would say, if I take the carbine order into consideration, almost about 10,000 crores. And we hope that by the end of 26, this order book can go up quite dramatically to at least 14,000 crores, something like that.
Well, some positive commentary coming in from Baba Kalyani there. The defense order book currently close to 10,000 crore, could rally up to 14,000 crore is what he said. But the other stock on our radar, and that's doing very well today, is Zydus Wellness. It is going up on the back of a positive note from Motilal Oswal. Manglam joins in with more details.
Well, that's correct. So Zydus Wellness, the last day of the year is doing a lot better because Motilal Oswal sees a near 35% upside from previous close on this stock. The stock up nearly double digits, and that's because they believe that, the portfolio that the company has of low sugar products, high protein products, functional nutrition and beverages, on-the-go products are doing extremely well. The company is actually, in leadership in several of these categories, and these are categories which have underlying mega trends in them. And to that, Motilal Oswal believes that the company can actually go ahead and leverage upon this portfolio to scale this business higher. And for all of this, the risk reward, the market cap versus the performance that the company is likely to do is a lot better as compared to other consumer companies with similar market caps, more so after the acquisitions that the company has made as well. So on a growth basis, Motilal Oswal expects a 14% EBITDA CAGR on organic basis and 36% CAGR on a consolidated basis over the next 3 financial years. And basis all of this, the stock is still, as per them, trading at a 30-35% discount to peers. So if you adjust the fair value higher as well, you come to closer to 575 rupees, and that's what the brokerage believes, and the stock is reflecting that.
The stock is higher by 8.5% as we speak. This stock is doing well on the upside, but the other stock that I am tracking is buzzing on the downside. Privi Specialty Chemicals, that's the stock on our radar. Now remember, there's been a block deal in this one, 38.8 lakh shares, which is basically 10% of equity worth 1,100 crore rupees exchanged hands in the block deal window in the morning. Sources did suggest yesterday that promoter group entity is likely to sell 6.32% stake. There is an option to upsize as well on that one. The promoter entity is Vivera Investment and Trading Private Limited, which will be selling stake. We'll of course get all the details in the block deal data later in the evening. But do remember, this is not the first time that the promoters have sold stake in the company this year itself. Currently, their stake stands at 69.89%, but back in June, they had already sold around 4% stake for 330 crore rupees. This is when their stake stood at 74.05%. The company in itself has seen a lot of change in hands as far as the promoter group is concerned or the ownership is concerned. In calendar year 17, Fairfax invested around 370 crore rupees in the company for a 51% stake. After that, there was a merger that happened between Privy Specialty and Adi Fine Chem. But because of some differences between the two companies, there was a demerger that took place again. And that is the time after which Fairfax sold the stake back to promoters of around 48.8% stake, and this took the promoter stake to around 74%. So a lot has happened, post which we have seen this gradual stake sale coming in from promoters as well. What does Privy Specialty do? It is an aroma chemical manufacturer which exports around 75 products, and it is also the top pick from Motilal Oswal. Remember, they recently initiated coverage on the stock with a buy rating and a target price of 3,960. They expect the company to deliver CAGR of 27% for revenues, 34% for EBITDA, 46% for adjusted EBITDA for the next 3 financial years, and this will be driven by 3 things. First will be increasing capacity in its core products. Second will be increased total addressable market for the new products that they are entering into. And third, they are working on improving relationship with existing customers for their big products. Now, the company has spoken about capacity expansion. 18,000 metric tons is what they are planning in FY27. This could actually more than double by FY29 in terms of capacity addition. The new products, they are expected to see margins of more than 40%, which is much higher than their current margins. And new products could be around 27% of their total revenues in FY29 versus 6% currently. So a lot of things coming together for this one. Now remember, SBI large and mid-cap fund holds around 1.6% stake. It'll be interesting to see whether they buy more stake in the block deal today. So that is one data that we'll be tracking. The stock trades at 28 times FY28 EPS, which is somewhere in the middle of the chemical value chain valuations as well. But yes, this is the stock, a big block deal. We'll get the details later in the evening today.
That's right. So post-market hours, once the block deal data is uploaded, we'll see. And most likely it appears as though the upside option was something that the promoter family did intend to go ahead and exercise a 90-day lock-up on further sale of shares. Well, we'll now slip into a short break. We'll get him on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. You're still tuned in Midcap Radar. Well, India's data center capacity is set for a massive surge. projected to expand nearly 10 folds by the end of 2030. But what's driving this explosive growth and who stands to benefit the most? Vinny Motiwala is here to decode India's booming data center sector and the key beneficiaries. Over to you, Vinny.
Right, thanks for that. So India's data center sector has marked 2025 as the breakout year. Capacity expanded from 0.5 gigawatt in 2020 to 1.6 gigawatt in 2025, fueled by 30 times the data traffic rise since 2017. 900 million internet users also came into India, and AI usage started increasing. And what was interesting that made OpenAI India market, OpenAI's second largest market. Now, in 2025, what more did we see? We saw mega investments that came in. Reliance Industries unveiled world's largest Jamnagar data center plus 1 gigawatt AI facility with NVIDIA. TCS launched its Hypervault for 1 to 1.2 gigawatt AI-graded capacity over the period of 5 years. OpenAI committed to 1 gigawatt amid DPDP Act mandates. Now, the total announcement that came in for 2025 hit $63 billion. $43 billion was ex of Reliance. So, yes, $20 billion approximately was Reliance. Now, with hyperscalers leasing 97.9 megawatt in first half itself, 48% increase over there is what we're seeing on a year-on-year basis. Occupancy at 97%. Mumbai dominating 50% share as well. Now, India added a record 30 gigawatt renewables in FY24-25, making it third globally, enabled by cheap solar power, supportive government as well. For renewables versus other countries, how do we stand for AI data centers, which need 5 to 6 times more energy? Now, power demand from data centers globally is estimated to grow at a CAGR of 17% till 2030. For India, it's expected at 33%. And with the US and EU power queues that are increasing there, execution timelines are increasing, there is permitting delays across the globe because of all these issues. The focus now shifts to India. India's data center capacity is projected to increase rapidly in the coming years, and obviously because of the factors I mentioned. Now, it's interesting to note that when data centers are created, 45% of it is capex cost, is non-IT equipments capex, whether you look at it like a cooling system, electricals, construction, etc., which accounts to most of the costs. IT costs come in at 55%. And India has no dearth of players in terms for equipment play, whether you look at an L&T for EPC, Cummins for backup power, there is infrastructure that is required, there are cooling systems that is required, so we have Voltas for that. Wiring, Polycab could benefit from that as well. So this will boost what? L&T, Cummins, Voltas, a dearth of companies that we have that will benefit from this as well. Now, in US, when you look at it, utilities present in the right region or even in companies which have access to electricity have seen a bigger success in the US versus other companies. In India, currently, most data centers are present, located in Mumbai region. 50% capacity is in the Mumbai region. Why? This is due to network access that is there via undersea cables. Further, when you look at it and break down India versus US, unlike US, India is one nation, one grid. Although transmission is becoming a big bottleneck similar to US, but India's data center capacity is maybe set to rise almost 5 times to 8 gigawatts by 2030. And this is according to Jefferies. Setting up 1 megawatt of data center in India requires a capex of $4 to $5 million, and hence setting up incremental data center capacity of 6.4 gigawatt by 2030 will need a capex of around $30 billion. Should create many opportunities for real estate players, electrical power systems, fit-out players, cooling systems, and network infrastructure players as well, which are among the top beneficiaries for the data center boom. And Indian telecom players, EPC players, power players, IT players, all these are set to benefit going forward with this data center boom.
Well, thank you so much, Vinny, for joining us and giving us all the things to look forward to, especially as far as the data center boom is concerned as we head into 2026. And as you can see on the bottom of the screen, there are flashes that indicate that the cabinet has likely approved an AGR relief package for Vodafone Idea. A very important development as far as Vodafone Idea is concerned. The stock near the day's highest point, and on the back of that, Indus Stars too has spiked higher. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. Markets as of now at the day's highest point, 26,171, up more than 200 points in today's trading session. Now, important flashes at the bottom of your screens for you all, and this is from sources that are saying to CNBC TV18, CNBC Awaaz, and here it is said that the cabinet is likely to have approved 5-year moratorium for the Vodafone Idea package, that relief AGR package that one was talking about. Other than that, this is approved as an AGR relief package. This was likely to come in as well, so we were seeing some bit of a move that's come in. As of now, this is what we're seeing from sources from CNBC Awaaz as well. Also, the cabinet has approved freezing of Vodafone Idea's AGR dues of 87,695 crores. So the cabinet has approved freezing of these AGR dues that are there of 87,600 crores approximately. Important for Vodafone Idea over there as well. So as of now, what we know is coming in, that they have likely approved that AGR relief package. They've approved freezing of that AGR dues that are there of 87,695 crores. So big one there coming in for Vodafone Idea. As of now, we're seeing that the stock is holding on to gains of almost 2%. Did see a spike as well. And this is likely to have been approved with a 5-year moratorium for Vodafone Idea. So very, very important over there, given that, you know, this has been going on for a while. The payment of 87,695 crores of AGR dues are being rescheduled to FY32 to FY41 is if what I read was right. So that is important as well. We have more details as and when they're coming in. Yes, rescheduled to FY32 to FY41. So yes, that's the time period now the reschedule goes in for the payment of this amount as well. But we have Gurmeet Chadha also, who's joining us on the call right now, who's the managing partner and CIO at Complete Circle. Gurmeet, good afternoon. Thank you so much for joining in. This seems like a big relief that's coming for Vodafone Idea. As of now, freezing of that 87,695 crores is coming from the cabinet. What are your first thoughts?
So I think welcome move. I think the government has made it clear that they would not want a duopoly in an important sector like telecom. I think there were also speculations and expectations of any waiver in interest. So overall debt is upwards of 2 lakh crores. The AGR dues are around 87,000 odd crores. So if there is any waiver in terms of interest and penal charges, etc., that would further give relief. So for now, I think it's great news. Also, good news in terms of keeping Vodafone Idea as a going concern, and also in terms of banks and financial institutions who have stakes in terms of loan there. So welcome news for the overall sector. Also, I think some rub-off should happen in the financials which have exposure to Voda.
Okay. Gurmeet, do wait by with us as well. We have HP Ranina, senior advocate at Supreme Court, joining us as well. Good afternoon, Mr. Ranina. This move has come in where the cabinet has obviously frozen the AGR dues right now of 87,600 crores for Vodafone Idea. Now, what are the next steps that come into play? They've said that they're rescheduling it as well. Anything important that we should watch out for from the law front that could maybe have a chance of not going through going forward?
Anyway, thank you for having me. I think important point is that this is a lifeline which the government has thrown to Vodafone. And but for that, Vodafone may have folded up. So I think it's excellent news. It's very important news for the telecom sector, for the consumers at large, for the ecosystem as well. Because as rightly pointed out, you can't have just two players in the field. You need a third player as well. So it's a very good news, and I don't think there are any legal hurdles or legal issues involved. When the government has taken a stand, and the Supreme Court itself had said earlier that the government is free to take whatever it does to save the company, I think there's no question of any legal hurdles now. I think it will simply go through, and I think Vodafone has got the best New Year's gift it could possibly have had.
Absolutely, sir. Best New Year gift right now for Vodafone Idea that's come in. Let's also bring on board Sanjay Asher, senior partner at Crawford Bailey and Company right now to talk to us about this as well. Mr. Asher, good afternoon. Thank you so much. Your thoughts on this? There is going to be a rescheduling in terms of payments as well that comes in between somewhere FY32 to FY41, and in terms of anything on the legality front that comes in for Vodafone Idea now.
So, first of all, good afternoon. First of all, it's very good news.
excellent news for Vodafone Idea as also for all its stakeholders. And it's a good development which the government has announced in favor of the telecom industry and in terms of Vodafone Idea. Now, I don't foresee any legal issues unless they bring about some new surprise by getting some new charges, or they try to get in some other levy. But otherwise the breaking up of the total dues to be paid over a period of time will also get a breather as far as Vodafone Idea is concerned. From a legal perspective, I don't foresee any issues as such now. So let's see, in case there is another PIL which unnecessarily upsets the apple cart, in terms of as to why Vodafone Idea has been given such a relief, although there is already a Supreme Court ruling and which directs the government to look into it and bring about some relief for the telecom industry and for Vodafone.
Sir, is there any case that this frozen AGR dues they mentioned that will be reassessed by the Department of Telecommunication based on audit reports? Is that anything to worry about? How does that work out? Every year is what they're going to be checking this?
Yes, they will check it, because it can't be that they will accept whatever Vodafone Idea says. Obviously, the numbers have to be signed off by the department before there is a demand or before they crystallize as to what exact amount is due from Vodafone Idea. So in my view, yes, there would be some sort of an audit which would be carried out by the department before freezing or before asking Vodafone Idea to pay the exact amount over a period of time.
Okay, let me also bring on board Prashant Nair as well. And we also have Vaibhav Kakkar joining us. Prashant, but a big relief that's come in, though the stock jumped up and now it's come down again. So I'm trying to figure out what's happening.
No, I think it was just, as of yesterday's close, it had Vodafone Idea had a market cap of 1,30,000 crores, right? I mean, so it's not a, so I think, and this was in that sense expected that something will come. It moved up from 8 rupees to 12 rupees. So, in anticipation of exactly this. So sometimes this is what happens. And now, exact details will be important. So just to read from some of what we are picking up, right? And this is what the government seems to be saying as part of, and why they've done this. The telecom sector, I'm just sort of reading from what we have. The telecom sector is deemed critical for economic growth, employment, digital India. The government wants multiple players to ensure competition, making Vodafone India's survival strategically important. So that's the starting point. I mean, in that detail that we have. They lay out Supreme Court's position, saying that the court had said that there's no legal bar on reconsidering the AGR issue. And then, of course, they come to the decision to freeze the AGR dues. And here, they're saying essentially that the cabinet is freezing the AGR dues at 87,695 crores as of 31st of December 2025. Payment of frozen AGR amount will be rescheduled from F532 to F541. That is what the detail here says. And they also say that AGR dues frozen as of 31st December 2025 will be reassessed by the DOT based on XYZ. I mean, so they sort of go on with some more things. But if I can just, Vaibhav Kakkar is also with us. Vaibhav, just a quick word. Payment of the frozen AGR amount will be rescheduled from F531.32 to F540.41. I mean, just your thoughts on this.
Yeah, hi, good afternoon. No, I think this is overall a great move by the government. This particular freezing, I think what they mean is that they will now apportion and amortize the dues that are payable over a 9-year financial cycle. And this certainly would have taken into account the revenue and the expected sort of bottom line that would play up for Vodafone on operating numbers to be able to assess as to how these payments can be made. I think just on a slightly more broader point of view, the foundational basis for this relief was already laid down by the Supreme Court in its order, where it had acknowledged two very unique data points. I think the fact that, if Vodafone does not get a relief package, in what is world's most populated country and one of the largest countries and consumers of data would be left with a duopoly of sorts. So I think that was a very important economic consideration. And the second fact, this is a uniquely placed company with 49% equity owned by the government itself.
So they have, that's the thing, the government has about 60,000 crores of market cap to defend in that sense, right?
Absolutely.
Just on this point, Sanjay Ashar, if I can come to you, the payment of this amount, which is 87,695 crores, the language is the payment of this amount is being rescheduled over F5 31-32 to F5 40-41. Sanjay, you want to just parse through this language for us? How would you read this?
It appears that from the language that 87,000 odd amount will be broken up into equal parts from F5 31 until 40-41. So in other words, if it is a period of 10 years or so, it will be broken up into 10 equal parts. So 8,700 odd crores every year. Which would effectively mean if you see in a commercial or a financial way that the present value of that 87,000 odd crores today would have got reduced to almost just 10% of the total due. So instead of saying that, look, I'm giving you a waiver of 90%, it's an indirect way of giving you this particular relief.
Basically, the payment starts in FY 31 and goes on till FY 41.
Correct. So they get a period of 15 years, 10 years plus another 5 years from today, yes.
Yeah, okay. Okay. And the other point, which is that the dues which are frozen as of 31st December 25 will be reassessed by the DOT based on, it says deduction verification guidelines, which are of 2020. Audit reports, a government-appointed committee will decide the outcome, which will be binding on both parties. They've laid out some conditions based on which DOT can then reassess the dues. Sanjay.
Yes, so in case it
this 87,000 crores also is not fixed. I mean, the DOT is free to, in this moratorium period, free to reassess this.
Yes, so 87,695 could be 88,000 or could be 86,000. In other words, after the government looks at it in the sense that scrutinizes it, checks it and audits it, whatever number comes out, that would be the frozen number. So in other words, it could be more than 87,695 crores on scrutiny by the department.
Right. Those numbers, I'm assuming, Sanjay, was only indicative, right? 86 or 88. I mean, it could be, depending on their assessment, it could be wildly different.
Yes, it could be more or it could be less as well.
It could be more or it could be less. So they also say that there is no relief for certain years. So AGR dues for F518, F519 were already finalized by the Supreme Court order, which is dated September of 2020. Those will remain unchanged. Those will have to be paid between F526 to F531. But those are for 2 years, 18 and 19, F518 and F519.
That is correct.
Yeah.
Yes.
Look at the stock, by the way, down 7%. And, exactly the point I was making in the morning, that there's a lot of excitement about what could the package mean, et cetera, But even at, 12 rupees, I mean, actually at 10 rupees, if you put in the numbers and take the best case scenario, and I have the sheet somewhere, I mean, it's kind of hard to imagine what can happen from a stock price perspective. Great news. The company, of course, is saved in that sense, and more competition, and we need more players, and it's important in that sense. But from a market perspective, I mean, it's a different ballgame altogether. Gurmeet, you've been listening into some of the conversation. You want to come in? Any other points?
I think, Prashant, for the immediate basis, I think it's more in terms of keeping it as a going concern. I think what it also does over a period of time allows it more options on fundraise. We saw some of the NBFCs being interested in December on some of the debt issuances. I think it was Tata Capital, if my memory is right. I think the focus should be more in terms of keeping it as a going concern. As an equity shareholder, in my view, because they are, the interest coverage ratio is so low, and their operational performance has been very, very weak. If you see, they've lost almost 50% of the subscriber post-merger. I think at some point of time, there could be some equity dilution also. I mean, it's a little speculative right now. So I think for now, it's more good news for the lenders and in terms of the overall ecosystem and less in terms of the stock price. That's my personal view.
Any thoughts on the other one, Indus Tower, if you can pull that up, Gurmeet, since we're on stocks. Any thoughts on Indus?
Yeah, I think so. Gets positive correlation, Prashant. But as you rightly said, a lot of the news in terms of this was in the price because there was expectation, and as one of the fellow panelists said, the foundation was laid by the Supreme Court order. I think we'll have to also see how will somebody like a Bharti react to it, because they also, I think, has about 40,000 crore AGR dues. But obviously, Bharti is now generating cash flows of 30,000-40,000 crores. So everything is good there. But as I said, a lot of it is in the price. But overall, as I said, good news for the ecosystem, and especially for lenders and in terms of more fundraising options now. I think the big trigger would, once you get a good strategic investor in terms of running Vodafone, I think you need a stronger hand other than government in terms of getting operationally, back on track.
Yeah. Vaibhav Kakkar is also with us. Look at the stock down 10% now. Vaibhav, your thoughts on, you've been listening into Sanjay, Gurmeet, sort of first reaction on how the market is taking it. I don't know if you track what, price, they say, encompasses a lot of things. But in this case, it may be a little different, right? Because there's a large amount of outstanding debt, and people will be working out and putting in the numbers to see what's the final equity value is going to be. But your thoughts, Vaibhav?
Yeah. No, I don't think one should really get overly concerned with the immediate fluctuation and volatility in the stock price. There was obviously a lot of speculation in the market of the extent of relief package that would be eventually offered to Vodafone Idea. I think it is in that backdrop that you're seeing the wild swings in the market at the moment. I think overall, once everybody appreciates the finer detailing around it. For instance, you asked some very valid questions around, how is this 88,000 crores going to get paid off? Is this going to be a portion over a certain period, or is this all pushed to 2041? It seems that it will all get a portion and amortized and paid over a 9-year cycle. So I think some of those detailings, when they're properly understood, I feel that the market will realize that government is doing its best to make sure that Vodafone Idea remains a relevant player. This is especially after the other two equity owners have taken a clear position that they will not be able to fund any further equity into the company. So I think in this backdrop, this is a very, very significant move. This also shows that the government is being nimble on its feet. I think in the backdrop of the experience in the aviation sector over the last few weeks, it's become even far more important that you cannot allow market competition to get compromised. So I think overall great. But of course, this itself is a large amount of liability. Let's not forget that. And as another gentleman brought out, Mr. Gurmeet, that some of these views, just in the context of the operating surplus that the company is spurting out, will itself be a difficult sort of play. And therefore, it's imperative that the management and the company now focuses on growth. And what also remains to be seen, and as a lawyer, I need to call that out, that needs to, if the other competition goes to the court asking for similar benefit and reliefs, and making a case out that there is no reason to create that kind of a distinction in terms of this kind of relief package. So one needs to see how that sort of nuance also plays out. So I believe that this is not the final word on the issue. It's likely to see.
I think we lost the line there with Vaibhav suddenly. Okay, Vaibhav, sorry, we lost you there briefly. Go on, please finish that point. Okay, I don't think we can hear him. Vinny, on that point that you were asking about the audit. The
audit reports, yeah.
So basically what they're saying is that from what we can understand, and we confirmed with Sanjay as well, that for the 5-year, the moratorium period, the DOT can do an audit based on some guidelines. One is the Supreme Court.
But is it like a normal audit that we have every year, and do they have that ability then to change that amount every year or anything, or once it's
it's not 1 year. It's not every year. This is an audit which they can audit the demand, the claim based on two factors which has been highlighted in the document, and that's it. I mean, the number, as Sanjay said, can move up, can move down. That's it. I mean, so obviously, I mean, if you are Vodafone Idea, would expect that the number will move down. Because it's the government which is now using the Supreme Court directive that the Supreme Court, what did the Supreme Court say? They said that the government is free to change and they can provide relief if so wanted. They provided this relief. And if you're Vodafone Idea, you would imagine that, they provide more relief. The number actually moves down from here whenever that audit happens, if that audit happens. So it's not an annual thing. It's like a one-time thing if the government or the DOT decides to do so. In that sense, that amount is the amount on which the audit will be done is the due as of 31st December 2025, which is at near 88,000 odd crores or so in terms of the demand. 10% lower, by the way. That's been the big story, I guess, bang in the middle of the day with the relief coming in for Vodafone Idea. Gurmeet, I don't know if you have any thoughts on this. Do you think, and this is slightly tangential, Gurmeet, are you there? Okay, Sanjay, are you there?
I'm there.
I just had a slightly off, maybe a little tangential in terms of question. I was wondering, right, this entire Indigo, in that sense, fiasco which took place early December, I mean, kind of shone the spotlight on having fewer players or one or two players or with a duopoly kind of position in any sector. And airlines is very important. Telecom is equally important. You think, I mean, there's some parallels we can draw. I'm not sure if this influenced the government's decision in any which way, but, basically quicken the process of making sure that Vodafone Idea is around and doing what it takes to make sure that we have a viable third player. Any thoughts, Sanjay?
No, I agree with that. There has to be a third player because only with Indigo and Air India, with just two players, it can't be that an important, in that sense, utility service, transport, can function or should be allowed to function. So there has to be a third player, and two, somebody who is becoming like a giant, so to say, should be kept in check in that sense to see whether everything from a regulatory perspective is being properly followed or not. I'm not saying that Indigo did not follow that. I'm not suggesting for a moment that. But it's question of the principle that just to see that everybody is following the rules of the game, and at the same time, a third player should also be invited or should be there in that particular business.
Sure, Sanjay. Point taken there. Prashant, you were talking about the stock already pricing in as well, right? Last 4 months as well as December so far, the stock has closed on the positive side. And obviously today also so far it is up 9%. So I think already priced in and now down 10% in the trading session as of now. Vodafone Idea.
No, absolutely. And I think, what we'll do is we'll maybe take a quick commercial break here. I mean, 10% lower on Vodafone. I think Indus Tower, which has also done well, by the way, not the frenzied move one way or the other, but it's a more settled move, but it's on the way down, about 1% lower, 417 on Indus Tower as well. It's a big story hitting us bang in the middle of the afternoon, as I said. Sanjay, thanks for staying with us and running and talking us through some of the detail in this. There will be a cabinet briefing, I'm assuming, and we will cut to it as and when that happens. Gurmeet, thank you very much. If you're there, Weber, thank you for joining us as well. It's, thanks for staying with us on over the last half hour on the Vodafone Idea programming. We'll take a quick commercial break here. Closing bell will pick up on the programming on the other side. Stay with us.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
Taiwan index is managing to hold on to some bit of a gain of almost 0.5% there.
Now, Nifty and the Nifty Bank, they are both, by the way, below the 20-day moving average.
The commission regulations are not there. They started paying much more commission than what it was stipulated in the regulations.
A stock may trade at 35 times PE, and that will be 5% premium to long-term average.
Opening rates about 0.25% higher, so much better start compared to yesterday, 26,025.
The headwinds which we faced last year, 2025, was very unusual.
They've hit the hammer into the ground. Today, it's going to take time to deliver results.
The Nifty above 26,000, so trying to end the year with a bang.
If you create your own technology in the area of defense, indigenous technology, the market will come to you.
Making the portfolio feel a little better on the last day of the year.
Well, closing out with some green, let's hope so, right? I mean, last 60 minutes of 2025, at least market hours, last 60 trading minutes of 2020, not last 60 minutes. This is Closing Bell. We're coming to you from the CNBC TV18 Motilal Oswal studios. I'm Prashant, with me, my colleague Surabhi. Surabhi, hi.
Hi, Prashant. Not bad, right? The bulls will say this is better than perhaps most hoped for, because you got a nice upward drift throughout the session.
Yeah.
The Nifty's reclaimed 26,000, not just 26,000 actually, 26,100 for what it's worth. And well, it has a nice ring to it. We're practically at the all-time high, just 0.5% away. So managed to climb several walls of worries through this year, but there are more that still remain.
Some walls we've not yet climbed through, right?
Leaving some for 26.
Okay, well, if you're just joining us, right? I mean, in the last 30 minutes or so, we've presented some programming on Vodafone Idea. We'll just look at the stop before we go any further, because that is something which we will continue to focus on. Stocks down 15% now, 10 rupees and 30 paise, 10 rupees and 20 paise, as things stand right now. So,
Prashant, just to sum it up, and I mean, you've been speaking to a whole panel of experts and legal luminaries as well.
Yeah.
So they've got more time to pay the due.
Yeah.
But I guess the thing is that the dues, as of now, still remain at a little over 87,000 crores. So could that be explaining the bulk of the disappointment? There's no waiver. There's no relief saying, okay, this much is waived off. You don't need to pay the amount. The amount remains the same.
I was not really sort of in tune with what the exact expectation was, but my view, which I said in the morning on Bazaar as well, that if you there were workings which I had. Basically, if you take the most optimistic of scenarios in terms of the relief, now that the relief has come and maybe we'll get details in the briefing, but even if you put all of that in and actually looked at what the equity value will work out, it was kind of 10, 11, it ran from 8 rupees to 12 rupees.
12 rupees, yeah.
So it's kind of tough to justify if you just look at the numbers. Sentiment, etc., is another thing. Okay, government stepped in and third viable player now, another 10 years, and etc., etc., etc. Maybe, I don't know, maybe the briefing will have more details, right?
Yeah.
Like, for example, the note says that the DOT is allowed to do another audit. So the number does not have to be 88,000, that 87,000, whatever number. The DOT has the option to do another audit, which is the government of India, and based on some guidelines, and that number can move. It can be lower. It can be lower or higher. Correct.
Lower or higher. So the thing is, the uncertainty to that extent, I mean, there's no immediate relief in the form of a lower payout. It's a deferred payout. That's what we know as of today, I suppose.
Unless the
DOT committee decides
audit,
that...
it could be lower, 100% it could be lower. But for now, I mean, what we have, of course, is the fact that, I mean, we had a very, very sharp move in terms of the price, and we are back at about 10 rupees and 25 paise at this point in time. So that's Voda Idea for you. Indus Tower is down about 1.25% or so as well at this point in time. Okay, let's just quickly run you through what's coming up here. Voda Idea, of course, is one, but the markets are also in focus. We're above 26,100 on the Nifty. Small caps are outperforming. Broad-based gains across sectors. Metals, PSU, private banks are leading the way. Steel stocks of course, doing well once again. Actually, it's steel, PSU banks. It's a kind of a repeat of what we saw yesterday. The only new index which is sort of joined into the mix is the oil and gas space. And here you got names like HP, BP, IOC, MRPL, CPCL, which are doing very well. With steel, of course, on your screen, it's the safeguard duties which have been imposed, which I think are leading to a bit of a lift here for many of these names. How should you position yourself? That's the question. Mitesh comes in with exactly that perspective. Mitesh, what would you do? You know, in the morning, I was asking you whether around that 40-day where we were, may make sense to take some exploratory longs. I'm not sure if you trust this move as we go into the new year.
I think, the idea is that the market was range bound and suggested if we get entry around yesterday's low, which we didn't get, that will be a buying opportunity. I think still, the market needs to get past 126, 200, 220. And, once it does that, then I think I would even look at a level of around 26, 400 odd as the resistance coming from the upward sloping line, joining all the tops in the last 3 weeks. So the market isn't weak, but the signs of a breakout are not there. We are now close to about 26,200, 220 zones. So I would advise traders as we get there to take some profits over there. In case we get past that, then I think another 200 points will happen, and then a breakout finally. So there's still time for that. But for the timing, the good news is that it's not weak. Metals are shining very well, and a lot of other stocks are doing good. So I have two long calls. One is Tata Motors personal vehicle, or TMPV. That's a buy with a stop at 361 for targets of 378. And ONGC is a buy as well. Keep a stop at 235, look for targets of 249, 250.
Mitesh, just before we let you go, any advice on Voda Idea? Because today's fall, I mean, and from 10%, it's now gone to 15% freeze, I think. For people, it was always going to be volatile, but it's just very severe, the pace of the fall. So any advice here?
I think the last significant breakout which happened for Vodafone Idea was around 9.7, 9.6, and I think we are heading towards that. I think in case we hold that, then I think it should be all okay and we could retest 12 odd levels. But for the time being, I'll keep a watch on 9.7, 9.6 zone.
Yeah, okay, got it. Mitesh, we'll come back to you for more. Thanks very much. There's a price hike from Hyundai Motor, 0.6%. Average is 0.6% across models from 1st of January 2026. Okay, well, steel is in focus, right? There's the safeguard duty which has come in, different rates over the next 3 years. Sudarshan is here with details on this. So over to you.
So long-awaited announcement has finally come. If you remember, in the month of April 2025, DGTR, that is Director General of Trade Remedies, had announced temporary safeguard duty, and that was applicable for 200 days, and it expired in the early part of November. Now, government has come out and extended that safeguard duty for the next 3 years. So in the first year from that would be applicable April 21, 2025 to April 21, 2026. And for that, duty is 12%. For the second year, duty comes down to 11.5%. And for the third year, duty will be 11%. Remember, this is done to safeguard the domestic industry, which was feeling the pain from the imports that were coming in from countries like China and Vietnam. And to protect that, to protect the domestic industry, government has announced this safeguard duty for 3 years. This was a long-awaited demand from the industry, and that is being taken very positively. You can see top Nifty gainers, JSW still up almost 5%, Tata still up. Even in the mid-cap space, if you see JSP, Jindal Stainless, Kalyan States, all the whole set of names are trading with healthy gains on the back of this announcement. And because of the reason is it's being taken positively. It was a long pending demand of the industry.
Okay, all right. That explains the excitement and the move on the stock. So thanks for that. Let's discuss this and a lot of other themes with our guest on the show today. We've got Siddharth Khemka joining in from Motilal Oswal. Sid, good afternoon and season's greetings. I think you might be all set for a party, right? But then tomorrow's working, market's working. You're going to be making it to office tomorrow?
Good afternoon and season's greeting to you and all the viewers. Definitely we have to work. Our markets is among the few globally which are open on 1st of Jan. So we'll definitely have a party in the evening, but it will be a limited period party.
Yeah, I think a lot of us have grayed our hair or lost our hair, wondering why we are the only market open on the 1st of January. But I think 2 decades and no answers, right? Anyway, so we'll let that grouse continue. But Siddharth, let's start with all the newsmakers of the day.
And the steel stocks, like Sudarshan was just telling us, finally that safeguard duty has come in. And it's a very clear roadmap as well. Next 2 odd years, how that duty will play out. Your thoughts? Does it make sense to buy any steel stock? And if yes, which one do you like?
Yeah, definitely. I think the global commodity rally is there for 2026 after the precious metals that had moved up. I think the base metals are something that is likely to see the uptick in 2026. The dollar index continues to remain weak. There is a lot of impetus as well as stimulus in China to revive growth. That is also helping the base metal prices. And I think if you look back home, I think there is a lot of case after 2 years of low capex from the government. This year, there is a lot of hope that the government capex spending should also increase. That is also positive for the metal stocks. I think with this safeguard duty in place, makes case for being positive on the ferrous after the precious metals. I think aluminium is something which was doing well. Now I think the ferrous side is also likely to see the uptick in terms of the benefit of the safeguard duty, especially from the Chinese import. So what we like Tata Steel, where we have a buy rating, target price of 210. The company has its long-term strategy focusing on volume expansion, value-added products. I think Indian business is expected to continue to do strong performance, plus the added benefit of a likely improvement in the European business, which could add to the overall upside to Tata Steel.
Okay, that's a call on the ferrous space. On the whole Vodafone idea debate, we were just discussing this, Prashant and I, to make sense of this 15% of knee-jerk reaction on the stock. Though they've been given more time, but what's your sense? I mean, what has triggered that profit-taking or that disappointment today?
I think markets were factoring in at least a bigger or a longer repayment moratorium. I think that is what is a key thing that is taken the market by surprise. Also, the fact that I think, again, there were some quarters in the market which were expecting that some waiver in terms of the dues could be provided. Now, as you were rightly discussing, and I think Prashant was highlighting that the DOT will have the committee to discuss and reevaluate the number. So they have not given the upfront, which definitely could be much lower than the current numbers. So I think the stock had moved up. There is some bit of profit booking after the news, and I think there is some bit of disappointment on the moratorium period, the repayment schedule, and no clarity in terms of the waiver or discount to the actual repayment amount. Nonetheless, I think this entire event should be taken positively once the market reacts today.
I guess it's also human psyche, right, Prashant? It's like if you have a massive amount of rent, let's say, overdue, and you keep negotiating about when to pay, I'll pay next month, or I'll pay the month after, or the quarter after, and all that's fine. But what really gets you excited is if the landlord says, that, okay, fine, let's just come to a middle ground, let's just settle at a slightly lower figure, right? That's what gets one super excited if you have any outstanding amount. But that's human psyche. We can all want and wish, but ultimately, what we've got today is that you pay, but we give you a longer payment duration. The rest we have to still discuss.
It's like EMI and payment.
It's like EMI. Like someone comes
duration
and
of the
tells
loan.
you, this car loan, it's okay. 30% is cancelled. No need to pay. Then you get super excited.
Well, let's just stay with steel, but in a slightly different way. We're talking about graphite electrode makers, right? HEG and Graphite India. Both stocks are surging as we speak. Vivek is joining us now to tell us the key triggers. What's at play? Vivek, take it away.
Well, that's right. HEG and Graphite, in fact, both of these names are up almost 30% from their recent lows in November and December. They're doing very well. Now, a couple of important points. Also, a key trigger that comes out from tomorrow. So the first thing is, European Union come tomorrow. That is the new year, will start rolling out CBAM. CBAM is what? Carbon Border Adjustment Mechanism. So basically, steel and aluminium imports that go into the European Union will be taxed on the volume of emissions that they produce, during the course of production of steel. So what will actually happen as far as steel makers and steel exporters, especially for Indian companies, are concerned, it will raise both landed costs and also start impacting the margins, given the fact that they will have to start taking the hit. On the other hand, the move actually incentivizes cleaner production of steel and improves competitiveness of low-carbon producers. So where do HEG and graphite come into the picture in this particular case? Remember, both of these companies produce graphite electrodes used in EAF steel making, which is electric arc furnaces, which is a much lower emission form of producing steel compared to the traditional coal-fired furnaces. Now, there's a recent MK note that came, sometime in December. They're saying that Indian graphite electrode producers are embarking on a fresh capex cycle to capture structural uplift as far as EAF-linked demand is concerned. They're saying even a 5 to 7% increase in EAF share globally would translate into an additional 30 to 35 metric tons of EAF steel output. They highlight a few key triggers as far as HEG and graphite are concerned. Number one, China's anti-involution shift that aids Indian steelmakers, Europe's CBAM rollout, something that we just spoke about, and also globally coordinated policy resolve aimed at lifting the steel industry currently, which is experiencing a prolonged slowdown or a prolonged struggle. All of these factors aiding the kind of sharp up move that we've seen in HEG and graphite.
All right, Vivek, very comprehensive. Thank you very much for that. Very useful. Siddharth, do you have coverage here on these names? Any thoughts? Graphite and HEG.
So, Prashant, unfortunately, we don't have coverage, but I think with the view turning positive on the entire metal space, I think the largest use case industry for them is the steel companies, and I think that is where the demand is. And some of the other use cases are electric vehicles, the batteries, EV batteries. I think overall the view remains positive, but unfortunately, we don't have coverage.
Okay, all right, got that. Let's just see the Midcap index, by the way, is right in step with the Nifty with a gain of about 1%. So we've discussed some of the active parts of the market, and that is the steel space. HPCL is really flying high, 6% higher. There's Gujarat Gas as well, which is 6% up. Among other names, Chennai Petro, by the way, from the oil and gas arena, again a name which is up 6%. So some of these oil and gas names are really up and about. Okay, one more stock that's been in the news today is Bharat Forge. I'm just trying to see where it is right now. It's still, retaining a gain of about 1%. So it's not a big move or a breathtaking rally, but it's been a day of small gains for Bharat Forge. Now, the company won a relatively large order yesterday. It was a little over 1,600 crore rupees, 1,662 to be precise, for the supply of CQB carbines to the army. We caught up with Baba Kalyani to understand the relevance of this, the importance, the margins, and when the money really flows in. Listen to what he had to say.
First time Indian designed products and developed products are competing with foreign products and winning. I think that's a very significant milestone that we've been able to achieve. We don't have any external collaborations here. It's all internal. This gun, right from the raw material to the finished product, is all made in our plant. We have set up a special plant for this in Jejuri. It's a plant that has got a capacity to produce about 50,000 to 60,000 weapons per year. But easily, it's a modular plant. It can easily be doubled, tripled based on the requirements that are there. A lot of interest from companies abroad in terms of wanting us to produce weapons for them here. So that's another thing we are beginning to see. And those quantities may be even bigger than the quantities that we are looking at for the Indian Army. We are looking at export orders for artillery guns, which are in process, and hopefully they will get materialized in 26. Currently, we have an order book of almost, I would say, if I take the carbine order into consideration, almost about 10,000 crores. And we hope that by the end of 26, this order book can go up quite dramatically to at least 12,000, 14,000 crores, something like that.
All right, so that is Bharat Forge. Stocks had a lukewarm year, but 15% up over the course of the last 12 months. That's today. But it's still nowhere close to the peak. It's seen higher levels of around 1,800 earlier. So that very quickly, a word on Bharat Forge, whether it would at all make the cut for you if you want to play the automotive space or the defense space. And then a quick word before you go on all of these oil and gas names, from Gujarat Gas to Chennai Petro, everything, HPCL, everything is bouncing. Not quite sure if there's any fresh trigger. So quick thoughts.
Yeah, Surbi, quickly on Bharat Forge, definitely the defense aerospace is likely to be the key growth driver. They have a good order book, 11,400 crores executable over the next 3-4 years. Aerospace is looking good, military, naval applications. The key concern, however, is the US CV's outlook remains weak and only expected to revive by the second half of the next calendar year. So H2 of CY26. So in the near term, we believe while the growth from defense could be good, the core business is likely to remain lackluster, and hence we have a neutral rating, kind of wait and watch for the CV cycle to see some recovery, and then maybe look at it more incrementally positively. So a neutral rating on Bharat Forge. In terms of oil and gas companies, I think there is a slight bit of expectation that the Russia-Ukraine war, there can be a peace deal, and hence crude oil prices can come off, and hence I think the oil marketing companies look attractive. Beyond that, overall as well, we like oil marketing companies. They have been on the up cycle. The marketing margins have been pretty strong, and I think among them, HPCL is something that we like from the oil marketing companies.
Okay, all right. Siddharth, we'll leave it there. Good speaking with you. Hope you party hard, not too hard. And Happy New Year to you. And
Happy New Year to you.
Thanks very much for being with us today and always. We take a quick commercial break here. We'll come back. We will, have Deepak Shenoy joining us on the other side. So that discussion, he's founder of Capital Mind on the other side. Stay tuned. Welcome back. This is about 20 minutes in and about 40 minutes to go for the close in terms of trading action for this year. And then we'll be talking about 2026 just like that tomorrow morning. The Nifty, by the way, for the year is up, 10%? 10.7, 11%, right? So it's not bad at all. From a foreign investor perspective, of course, you knock out the rupee depreciation. So you got to do that. But otherwise, it's not US is up 22, NASDAQ is up 22. and NASDAQ is not even the best performing market. Actually, pretty much everything is done better than the US, and that's saying pretty much all large markets have done, let me contextualize, have done better than the US, and the US is up that much. So it's been a great year, and it's been a so-so year here in India, and some would say tough year, especially if you look at mid-caps, small caps, and so on and so forth. Deepak Shenoy is with us, founder at Capital Mind. Deepak, welcome to the program. Thanks very much. Season's greetings to you. Appreciate your time here with us as always. Before I get to here and now, I wanted to just kind of maybe take two questions on Mr. Buffett, who's stepping down today. Deepak, he's of course served over 60 years as at the helm of Berkshire, and 95 years old now. And he's sort of Hormuz had this data earlier for us in terms of the conglomerate that he's built, the interests that Berkshire has, and of course, I mean, the very, very large shoes that Greg Abel, the successor, is going to be stepping into. Yeah, that's the man. 63 years of age, Canadian nationality, and it's going to be something. I mean, I think the story doesn't need to be told. Everyone is aware of what Mr. Buffett has done at Berkshire. And of course, he's more than anything else I think I remember at some point, and he's been such a prolific writer, but also, of course, so much of him on video, which we are fortunate to have. And he was asked one time, how would you like to be remembered? He said, well, as a teacher. And I think that is perhaps the greatest gift that Warren Buffett has left for the investing world broadly. Deepak, some very smart, intelligent people do say that maybe Mr. Buffett's style of investing, perhaps in this very rapidly changing technological kind of world that we are in now, perhaps is a bit outdated. The principles, no, absolutely not. I mean, they remain the same, but his style of investing, I don't know if you have any thoughts on that or anything else you'd like to reflect on.
Oh yeah, Prashant, I think the biggest thing that he's left for us is the treasure trove of knowledge that he has imparted over these years, right? So it's not so much the exacting of the investment style, it's the discipline of investing that he's brought across. A lot of times he does things differently from the ways he says things. So he might say that you should invest, primarily or only for the long term. But his own investments, he's had, relatively short-term investments, as many as he has had long-term investments. So it's a bit of this thing. But actually, what he's trying to tell you is, when you start out investing, you think of an asset as something that's a long-term story, and then eventually that will, if it doesn't work out, then you should be quick to get off as well, so that you can maintain your long-term portfolios of stocks that you really like over a long term. There is, I think, a few of these nuggets of advice that I think I would disagree at face value, but I think in spirit he has the right approach or thought process. The nature of investing has changed. It's become more technology oriented. He's kind of missed that technology bus because he's more focused on investments that have, been around for a while. So they have the ability to generate high ROEs right from the beginning when he starts investing, and they're valued at relatively low prices. Whereas in today's day and age, you find that the more growth-oriented companies are valued at much higher, where they don't have ROEs currently that actually demonstrate themselves, but eventually they do once they grow to a certain size and they can demonstrate that they have reached a certain layer of excellence, like in Google or in Apple and things like that. I feel that, one of the reasons why it's so difficult to fill his shoes is he isn't actually quite afraid to keep that much cash available and ready for investing for the right time. Even though it has taken him 10 or 12 years, he doesn't mind staying on that. I think the other managers will find it more difficult because they weren't the founders of this company, and they perhaps may not be able to live down the public eye as much, because they haven't had those 40 years of success that have allowed them to say, listen, I know best, and I know I will wait for the right opportunity. But those are the things that I think the next set of people will find difficult. Buffett has been fantastic. Sorry.
Yeah. No, Deepak, great points. And I actually was thinking some of this earlier. The applicability, I wouldn't say relevance. I'm sure value investing will always be relevant, but the applicability and how do you apply value investing in today's market context, whether it's US markets, whether it's our own markets. And we were discussing this with Vineet Samre in the morning, actually, in our morning show, that we're living in very different times and very different markets, where, like you said, stocks which exhibit growth will be rewarded, and things will overshoot on the upside, and a lot of great pedigree, value companies and value stocks end up being value traps. Case in point right now could be, say, the FMCG universe. I mean, there's no issue with corporate governance, there's no issue with cash, but the market simply doesn't reward you. So how do you apply Mr. Warren Buffett's philosophy towards investing in markets which have taken on their own color and their own texture now in 2026 as we enter the new year?
So no predictions here from me on 2026, Surabhi. But here's the thing. Value stocks exist primarily around in the small and micro cap areas, where a person like Buffett would find difficult to invest because he has so much money. But not all of us have so much money, right? So we're all relatively smaller players. We can actually invest in some of these smaller cap companies and find value in those players and make a tremendous amount of return. Now, of course, what you can make at 1 crore of capital or 10 lakhs of capital is different from what you can make at 10,000 crores of capital. You don't have 10,000 crores of capital, then you should think of what you can do. Therefore, the value investing framework is not entirely lost on everybody. I think the smaller investors, the smaller fund managers, including people like us, will probably still be able to access some of these value opportunities simply because we have the size that allows us to participate in them meaningfully.
But it's also, Deepak, size is one thing and how much money you can put on the table is one aspect. The other thing is, to be a value investor, you have to deal with FOMO. And for people who even at a small scale try and be value investors and emulate some of this time-tested philosophy of Mr. Buffett, how do you deal with the fact that my portfolio simply hasn't performed? The market has moved on. People are sitting on 20-30% gain.
So here's the thing also, Surabhi. I think the FMCG players that you mentioned, they're not actually Buffett-type values.
No, I was just giving an example of relatively lower valued stocks in the market.
Absolutely.
Sorry, Deepak, that is why, there's only one Buffett, right?
That's also true.
As simple as that. He says, right, if you, so many famous sayings, he says if you have 180 IQ, you can sell 80 points because you don't need 180 IQ, you can do with 100. But that is also his folksy, humorous way of kind of downplaying his, I'll tell you what, with Buffett, and you asked the question on investing, but to me, and I think to a lot of people who are Buffett bucks, so to speak, it is basically a gyan about life. It's not so much about investing is, over the years, it's become investing is just one part of it. But his approach to, everything from, from raising kids to what you should, all kinds of facets, right? There are so many. There's a fantastic book, which is, I don't remember the name now, it's a black-covered, thick book. It's organized as a conversation with Charlie Munger and Warren Buffett and what they've said over the last 50 years. And it's been ordered into question and answers. And most of it is not about investing. It is all about, life and so on and so forth in general. So, but that is why he is who he is. Deepak, just one other thing, right? One other observation. I don't know if you found it, but it doesn't get talked about too much when we all talk about Buffett and all of that, right? The guy is
it's Buffett and Munger Unscripted. I think that's the book, and I remember because Mr. Ramesh Damani referred to the same book that you're talking about.
No, it's not.
It's not that one?
It's not that.
Okay.
It's a librarian, and I don't know. I'll get the book.
We'll get to it.
Deepak, the guy is just too smart, yeah. The IQ can't, when you listen to the guy talking, and we all say, well, we can do what Buffett does, but the point is we ignore a very basic starting point. I think everything else aside, the compute power is something else, is off the charts. You could actually, some of the earlier interviews and videos, if you watch of him, the pace at which he's articulating complex ideas, it shines through. And I don't think that gets enough credit, although he himself downplays it.
No, I think, to be honest, he's that sharp at 95.
Yeah.
I went to one of his annual conferences about a couple of years back, and I remember a young lady asked him, what she should invest in. She's starting early in life, and investing. What should I invest in now that will give her a head start? And what he said was, invest in yourself. Effectively, what you do now is going to give you more money than anything else that you invest in. So you will earn a lot more that by just investing in yourself. And I think that's a great idea. Your first crore comes from your salary, your income, not from having invested in other people's companies. So I think that's a really wise insight. He's smart. He's so smart that sometimes it shocks you about how well he's able to think even at 95. I forget what I said yesterday when I'm just about 50. So I think it's remarkable.
No, I think we've all been lucky and hope he has many more years. He's just stepping off Berkshire, but I hope he uses the free time he has to do many more interviews and especially the long form ones now. And I think it'll be a delight. Just treasure trove of information and wisdom out there. Deepak, just a quick bit on markets now as we enter 2026.
Prediction time.
Forecast prediction. Although Mr. Buffett would scoff at it.
And he said, I'm not going to do it.
Deepak
also said, I'm not predicting, but come on.
It's a time to predict. But honestly, if you told me that at the end of 2025, that India would have a war with Pakistan, the rupee would fall so much, the RBI would cut rates by 125 basis points, and yet the 10 years bond yield would not significantly improve, then the US would cut rates and its long-term bonds would react negatively in comparison. The gold and silver prices would reach all these. I would have been, laughing and saying, what's wrong?
It's like the year that no one could predict. That's what I call 2025, the year that no single human being could ever predict, I think. And that's what one learning. Don't try and keep second-guessing markets. They will do what they need to do. But go on. So where does that leave us?
No, that leaves us with only one thing. Despite all of these things, the Indian markets have gone up. This is a point to say, don't try to predict. Try to respond to the market instead. Things will work in certain directions. Things will not work in certain directions. You have to change direction midway. I think that's what the story of 2026 is also going to be. You may get a lot of your predictions right, but the market may react in a completely different way from what you comprehend. And that's not a bug. That's a feature. That's how markets are. They are unpredictable for a reason. Is that eventually your idea is to get with the tide. In that sense, I tend to follow prices a lot because prices give me feedback about what's happening, sometimes more than we know. And I think we've institutionalized that in a way by creating algorithms as well. But I think data is going to become an even more bigger part of what we decide on what market feedback really is. And my lesson in 2025 has been don't try to second guess. I think my thing in 2026 is expect the worst and still, let the markets tell you where they're going to go, even when the worst happens.
Expect the worst, hope for the best. As that's the, oldest, I guess, piece of wisdom in the book. Thank you so much for that, Deepak. Wish you a very, very happy, pleasant, prosperous 2026. And we look forward to more conversations in the coming year. Thank you.
Thanks. We'll be happy 2026 to all of you at CNBC TV18 and to all of your viewers as well.
Thanks a lot. Well, with that, let's quickly go to Ashmit because he's got a very busy, couple of hours ahead of him. He's tracking all the developments with respect to Vodafone Idea. There's going to be a cabinet briefing as well. Ashmit, so let's just recap what we know so far.
Well, the cabinet briefing as we speak is underway. We're yet to hear from the Minister Ashwini Vaishnav on this latest decision. But as far as from what we're picking up after speaking to sources is that there are 4 key takeaways that the cabinet has approved with respect to Vodafone Idea and its AGR dues. Number 1, there will be a freeze as far as the total AGR payout is concerned at an amount of 87,695 crore rupees, and that's as of 31st of December 2025. That's the first key takeaway, a freeze on the amount in question. The second is that for the next 5 fiscals, beginning FY27, there will be a moratorium on any payouts as far as Vodafone Idea is concerned. So for the next 5 fiscal years, no payouts are required to be made by Vodafone Idea. That's the second part of the relief package that the cabinet has considered and approved. The third is that the payment schedule for the confirmed amount will begin as late as FY32. It will be a 10-year payment schedule that will extend all the way till FY41. So that's the third leg of the relief that has been proposed by the cabinet. And the fourth and the final, and this is perhaps the most crucial one, the long-standing demand of Vodafone Idea. They have been arguing that, look, there has been double counting of a lot of entries. There is arithmetic errors as far as computation of the overall AGR demand is concerned. On that one particular front, what the cabinet, we're given to understand, has approved is that there will be a government-appointed committee that will go ahead and reassess and recompute all the AGR dues in question, and only after that will there be a final amount that will be put across to Vodafone Idea. So clearly, 4 legs of this relief. Number one, the moratorium. Number one, the freeze on the amount. Number 2, the moratorium. Third, the 10-year payment schedule. And fourth, and perhaps most importantly, a reassessment exercise is now to begin with a government-led committee. Back to you.
Ashmi, thank you very much for that. Some more decisions at the bottom of the screen with regards to what the cabinet has decided. But the big one, of course, has been a Vodafone Idea. We'll take a break. We're back. We'll tell you. We'll get you some trading ideas. There's 20 minutes to go to wrap out 2025. Stay tuned.
Welcome back. The market continues to be in cruise control mode on the last trading day of 2025. Let's figure out what's happening in the F&O space. Mangalam brings us the latest from day one of the new series. How's it looking, Mangalam?
Day one of the new series and the market straight out of the blocks. You know, we have the Nifty which is closing in on the 26,200 mark after having crossed past important levels this morning, the 20-day moving average in particular. The Bank Nifty doing well, the mid-caps as well. What's heartening is that portfolios today might be feeling a lot better. I don't know how much of that is on account of NAV propping and the fact that it's the last calendar day of this year as well. But importantly, the broader markets where the advances are far outnumbering decliners. And that's after a very long time that we've seen that over the last 5 or 6 trading sessions, we've seen on an average 17 to 1800 stocks in the red for about 7 to 800 stocks in the green. So that's positive. But let's see how much of this up move sustains. The reason why I say that is because a large part of this up move is on account of the call writing at 26,000 and 26,100. All of that is now coming a little undone. So those call writers have been caught on the wrong side. That's propelled the markets higher. Now put writers are getting a little more aggressive. So we have 26,100 put, which has seen a lot of writing. 26,000 put was fairly well written all through the course of the day. Now the out of money puts, which are rather in the money puts, which are 26,200, they are seeing some writing, and that's something that we will monitor because call writers are active at 26,200 still. So can the market sustain above 26,250 or 26,260 is something that we will track, because as put writers are getting aggressive, the put call ratio is getting overheated as well. So the put call ratio is at now 1.37 as compared to 0.09. So just monitor the Nifty put call ratio. And finally, a bunch of stocks that I'm tracking: HBCL, IOC, BPCL, all these oil marketing companies seeing a lot of long positions being added. And we have TCS. IT has been an underperformer today, and like all through this year, TCS is seeing some shorting activity.
Okay, all right, got that. Mangalam, thank you very much for the latest from the F&O market. So those are the cues that we are picking up at this point in time. Let's quickly move on, and we're still getting more announcements. Nothing on Vodafone Idea, actually. More approvals in terms of highway projects, etc., from the cabinet meeting that's underway. But for the timing, let's get some final trades. Final trades for 2025. Mitesh, what do you have for us?
Yeah. BTSC and Petronet, I think, oil refinery is doing well. So Petronet is also, something which is kind of moved towards the high of the day. BTSC with a stop at about 281.5 for targets of 288. And Shree Cement is the other one. That's, also moved up nicely. Good breakout here. So keep a stop at about 26,420 and look for a target around 26,900.
Okay, all right. Thanks very much for that, Mitesh. Well, I think we can bring in Yash now, who is joining in. So, we've been following this Insurance Commission story over the last couple of days. And the Secretary of Department of Financial Services spoke with our colleague Sapna Das and said that, well, IRDAI is essentially going to come out with draft regulations on insurance commissions. Now, what we're doing here and what Yash has done is looked at data from IRDAI annual report for 2020. This is data for 2025, Yash, right?
That's correct.
In terms of what are commissions paid, and then contrasted that against things like number of policies, number of new policies and premiums, etc. Take it away, Yash.
Well, Prashant, we've been asking this question that why this, this particular action as far as commissions are concerned. And as far as the action itself is concerned, the obvious answer is simply that higher commissions technically mean higher premiums for policyholders. But there's a very interesting answer which also lies in the data. And that answer essentially is that higher commissions have not resulted in higher policy growth or higher premium for insurance companies. The numbers very clearly state this. In FY25, and as you said, this is as per IRDAI's annual report, in FY25, the commissions paid by life insurance companies as a total industry, that increased by 18%. Number of policies in the same year fell by about 7.5%. Premium in the same year for life insurers increased just by about 7%. Now let's look at private life insurance companies. The commission paid by private life insurance industry, that increased by 39%. But at the same time, policy growth was just about 5% and the premium growth was just about 12%. As I said, this is as per IRDAI's annual report. Let's look at general insurance industry. Totally general insurers, the commission which they paid in FY25, that increased by 20%, but number of policies, that increased just by 16%. Premium increased just by about 6%. As far as PSU general insurers are concerned, their commission increased by 27%. Number of policy growth was just about 5%. Premium growth was just about 5%. Private insurers, the commission which they paid increased by 16%. Number of policies grew by 23%. The premium growth was just about 5%. Finally, standalone health insurers, the commission which they paid, that increased by 24%. The number of policies issued, that grew just by about 16%. Premium also grew by just about 16%. So, of course, the clear answer as far action on commission is concerned is to reduce premiums of policyholders. But even in the year where commissions increased significantly, it did not reflect in policy growth or premiums for insurance companies.
Okay, all right. Yash, thank you very much for that. So that is the data. Stark, very, very stark actually. Mayuresh Joshi is with us, Director Research at MarketSmith India. Mayuresh, season's greetings and I guess last 12 minutes of trade for 25. Any reflections, Mayuresh, on 25, things you should have done, things you shouldn't have done in terms of stocks?
Afternoon, Prashant. No, season's greetings and wish you and everyone at CNBC 18 and all the viewers a very prosperous, peaceful and healthy 2026. I think reflecting on 25, I think tough year, specifically for the broader markets. At MarketSmith India, we are growth investors, so we chase growth and momentum. So we did see the initial few months where momentum was very, very strong, but it actually lagged off by the end of the last quarter. And therefore, I think all the gains that we had probably made had substantially reduced. So I think the lesson 2025 was that once you're done with your risk reward targets, I think book it and probably have money in the bank.
Okay, all right. Hi, good to have you in, Mayuresh. So now tell us, what is the bright new idea for 2026? Give us a rocket stock, something that will go up 100%. That's what everybody wants, right? It boils down to that at the end of the day.
Afternoon, Surabhi, I hope I knew that.
If only it was that simple, huh?
Exactly. So I think a few sectors that we are seeing at MarketSmith India in terms of our thematic sectoral analysis that we probably do. I think a few sectors which are coming into a rally attempt are consumer discretionary, they are FMCG, and it's a combination of reality and infra. And therefore, I think it's a mix of stocks that we've got on the watch list from all these sectors put together. BFSI selectively should continue doing well in our opinion. And therefore, I think I've already spoken about stocks like a Bank of Maharashtra or Shriram Finance from the NBFC universe. But certain stocks in these themes that we are looking at from a thematic perspective over the next few months. FMCG, I think Tata Consumer is something where our belief is Indian beverages, Indian food business, including Sampan, should probably hold up quite well. Volume should hold up, margin should be reasonable, input costs are relatively benign. And therefore, I think FMCG selectively should continue doing well. In terms of consumer discretionary, Vishal Megamart is something that we continue liking. Our own sense is that Q2 numbers have been relatively strong. As discretionary spending improves, specifically in tier 2, tier 3 cities over the next few quarters, with a mix of government initiatives, a mix of GST rationalization and discretionary incomes going up because of higher MSPs with key elections happening over the next few months and next few quarters. The discretionary pattern should improve, benefiting and aiding Vishal Megamart, which has a good mix in terms of apparel, FMCG, and other FMCG products as well. When it comes to reality, Phoenix Mills on declines is something that we continue liking or keeping a watch out for. Our sense is the kind of fit outs that they've probably done so far. The rent escalations are probably on track and they should probably be able to suffice a large part of the analyst community expectations, which makes us largely believe that the kind of additions that they're probably doing, both in terms of mall additions as well as the hotel addition in number of keys with calibrated capex should aid return ratios. I think a few stocks and a few.
That's Vishal. That's Vishal Megamart, Phoenix Mills, and there's one more that you mentioned, right?
Yeah.
Vishal Megamart and Phoenix Mills.
Yeah.
2. Okay, we'll work with 2 for now. All right. Okay, stay on, Mayuresh. We need to take a very, very quick break. We'll be back and we'll count down to the final few minutes of trade in 2025. Welcome back. So we've got a good-looking screen, almost 200 points up on the Nifty. It's not quite at the highest point of the session, but it's a good close. And for what it's worth, you want to end the year filled with hope. Mayuresh, I just want to talk about some of the gainers of today. The entire oil and gas space is buzzing quite a bit. HPCL 6%, Gujarat Gas 5%, MRPL 6.5%. I don't know if it's just thin trading and stocks showing these outsized moves or whether there's any fresh trigger that's coming up ahead in January. Your thoughts?
Well, for Gujarat Gas in particular, propane prices are up slowly. So I think if you probably look at the arbitrage between propane prices and natural gas prices, that has probably come down to a large extent. And therefore, I think a lot of the unorganized players in Morbi, which probably did not use natural gas, they were probably using propane. With prices moving higher, the arbitrage has probably now shortened out or narrowed down, making it very, very competitive for players like Gujarat Gas in the industrial belt of Morbi itself. So I think that's one trigger which is probably working in favor of Gujarat Gas. For HP, BP, IOC, again, I think the expectations in terms of Singapore GRMs, which have remained relatively stronger, the expectations in terms of refining margins being strong, the expectations in terms of the pipeline or the transmission revenues remaining strong and stable going forward as well. And let's not forget the dividend yield that they give. Are probably acting as triggers. However, I think the risk factor here remains how Singapore GRMs probably move. So it's more a momentum play, in my opinion, which is probably aiding these stocks.
Yeah. By the way, these stocks had a very, very sharp correction as well from the highs. MRP. I mean, they had a frenzied move, from actually almost a one-way move from. It took 2 years, but from March of 2023 all the way straight up, green candle after green candle. In 1 year, MRPL, for example, got up to about 200. The high was about 290, and then of course it underwent a correction, went to about $100, from 100 to about 185 over the next 6 odd months or so, and from a high of 185, dropped once again to 140. So, his very, very violent reactions, both Chennai and MRPL, so to speak, the standalone refiners in that sense. Just taking a quick look before we sort of wrap out at, any other new additions to the mix today. Not really, is there? Steel continues to kind of sort of dominate the price action today. HP is the other one, shining singularly, 6% higher on HPCL, and it's a solid one for HP. I mean, IOC and BP are up in the range of about 2.5%, and I think BP is up about 4% or so. Yeah, but HP, really stand out with a 6.25% kind of gain. Wockhardt is the other one. I think there is some fast tracking of its novel molecule which has come through in Europe, so that's about 5.5% higher. And the other one is Craftsman Auto. I mean, about 6% on this one. Coimbatore-based auto ancillary company, has done phenomenally well over the years. So just some names. Idea will go home with about an 11-12% cut. And naturally, I mean, on a day like today, stock number one in terms of, on the downside, number one volume traded loser at this point in time. So 10 rupees 67 paise. Of course, I think the low was low was 975. So it's basically come up about a rupee or so from the lows today. Otherwise, it's largely on the upside. It's showing up in terms of broader markets as well. 2,200 stocks are higher, and you got about 955 or 956 stocks which are lower at this point. Any more clarity you would, Mayuresh, await for as far as Idea is concerned? I mean, I think there will be some detailed communication of the relief to Idea, but that'll perhaps we'll only get later in the evening.
Absolutely. Looking forward for that. But Prashant, again, I think the stock has always remained under the lens, considering its excessive debt carried on to its books, as well as the limited circles that it is operating out of. And let's not forget, I think the capex that they need to do to be 5G ready in almost all the circles that they're present in. So I think they have a whole host of challenges in front of them as well. So let's see what the communique promises.
Okay, all right. Down to less than a minute now before the bell goes off for 2025. Mayuresh, thanks very much. We will let you go and start enjoying your evening. Have a fabulous, fabulous 2026. Well, let's recap then. What has been a good end? I mean, an end practically at all-time highs. Tough, challenging year, but the market managed to circumvent or sort of, drift through most of it. Investors' patience was tested, and many, especially retail investors, did come out with flying colors. Okay, so let's see what's led the gains today. JSW Steel, Tata Steel, the steel pack up and about. A lot of the oil and gas plays that we were just discussing. ONGC on the Nifty screen up 2.5%. Reliance up about 2% as well. Banks have had a good session. So Axis Bank almost 2% higher. Kotak Mahindra Bank about 2.5% higher. Not bad over there. On financials, Shriram Finance continued its forward march, up 2%, taking its yearly tally. Hold your breath, 72% up on Shriram Finance this year. Titan, 2%, with the lab-grown foray being in sharp focus. M&M, Power Grid, BEL, HUL, lots of gainers actually on the Nifty. Not much to complain today. You only had TCS, Tech Mahindra and Infosys, some of the IT names that were on the red side. But otherwise, at least it's a very feel-good screen for what it's worth, Prashant.
Yeah. Nice, right? To end 200 points higher.
Looks nice. No complaints.
Okay, I think that's it. Surabhi, for Surabhi as well, this is the last day for now, Surabhi. I'm not going to say any goodbyes. So I think...
No, I'll see you around in the office. But yes, as far as having the privilege of anchoring fabulous, fabulous programming on CNBC TV18 is concerned, for now, a bit of a breather.
Yeah.
And I think digital content beckons. So we'll see how that goes.
Yeah, no, absolutely. And welcome anytime, Surabhi, if you want to step in.
Right around the corner, outside the door, like you say.
Well, that's it from both of us here on the team on Closing Bell. Hope we've helped you along this year on shows that we've been on. And of course, we'll see you tomorrow. We are one of the very few markets which is going to be trading. Most major global markets are going to be shut. But as tradition goes in India, markets are very much on. Have a responsible evening, responsible celebrations, and see you bright and early tomorrow morning.
And I'll just add, since I won't be here tomorrow morning, let me take this opportunity of wishing all of our viewers a fabulous, fabulous, healthy, wealthy, prosperous, and peaceful 2026. Thank you so much for watching.
Nifty gains 10% in 2025 but underperforms its Asian peers. The best performing indices are PSU banks, metals and auto, while media, realty and IT fall the most in 2025. For the day, the Nifty snaps its 4-day losing streak to end 2025 higher amid broad-based gains.
A news lease of life for Vodafone Idea. The government freezes AGR dues worth more than 87,000 crore rupees for the next 5 years, reschedules payments over a 10-year period starting FY32. The stock falls 10%, briefly slips below its FPO price as well of around 11 rupees a share.
Steel stocks rally after the government imposes safeguard duties on select steel imports for 3 years. Duties of up to 12% will be imposed as per the DGTR's recommendations. JSW Steel and Tata Steel are top Nifty gainers. Hello and welcome to the last Markets Forward of 2025, your go-to show where we aim to get you all of the key data points to gear up for the next trading day. I'm Ritu Singh and with me is my colleague Hormaz Fadakia. Hormaz, not a bad end to what has been a bit of a mediocre year. Markets closing about 200 points up on the Nifty, 545 points up on the Sensex. So, investors must think perhaps in the last year of the year, the portfolio is feeling a bit better after, such a terrible few sessions we saw in the past couple of weeks.
Indeed, I loved the emphasis on the last market forward though, Ritu, of the year. And you still take a 10% gain considering the volatility, the uncertainty, the tariffs, all of it that we have encountered all through the year. The Nifty, a 10th straight year of positive returns. Of course, the mid-cap index also, but the small-cap index ending with losses this time around. So this is what the market has been this year. Of course, we'll talk about it in greater detail. But for a 10% advance on the index, hitting a record high as well, briefly albeit, you take that in the kind of year we have had. Of course, we have not had the kind of performance that our other global market peers have had, but a 10% gain is a gain nonetheless, Ritu.
Well, yes, it is. A 10% gain is something to talk about. But the last trading day for the year is done. And here's what we have lined up for you on the show today. We'll start with the top movers and shakers of the day with Vivek Iyer. We'll also put the spotlight on how the stock markets fared in 2025, decode the government's AGR relief for Vodafone and Idea, and tell you why steel stocks rallied in trade. That's not all. Warren Buffett's last day at the helm of Berkshire Hathaway, bringing an end to a legendary 60-year career. We'll bring you a recap of the iconic investor's journey and succession strategy ahead.
And on to our first segment of the day. Vivek is here and he'll tell us about the top movers and shakers of the day today. Vivek, over to you.
Well, that's right. December 31st, what moved the market is something that we're looking at. The metal pack, whole of December, we've been speaking about how this particular space has been doing very well today. Another session after the imposition of the protection as far as the domestic steel industry is concerned. All of the metal stocks did very well, sale high by over 4%. The entire NBFC pack, after the kind of move that we saw across Shriram Fin, most of these stocks also started off the December series on a very positive note. Names like Shriram, REC, REDA, PFC, all of the names did very well in the session. Out of the FNO from the January series, but HFCL took that as a positive cue. The stock ended higher as one of the top gainers as far as the NSE 500 was concerned. HFCL is the name that we are discussing. NCC, again, another name that actually came out of the FNO segment, but this particular name too today on very good cash volumes went higher by over 3.5%. And Zydus Wellness, one particular stock that moved higher on the back of a positive brokerage note from Motilal Oswal, over 7% higher. Quite a few laggards as well. Policy Bazaar yesterday too was a laggard. Today again further selling pressure seen on the back of the kind of commissioning cuts that the street is worrying about. Hindustan Zinc profit booking seen across most of the names that have exposure to silver. So Hindustan Zinc fell. You also saw Navin Fluorine down, one of the top laggards. Bajaj Finance, one of the top laggards as far as the FNO space was concerned, recovered quite a lot in the last hour of the session. And IDA as well as Indus Tower, both of these names were extremely volatile on the back of the AGR relief news flow that came about. IDA ended lower by almost 10% today.
And now to take the discussion forward, I've been joined by Mayuresh Joshi of William O'Neill and Sudeep Shah of SBI Securities. Gentlemen, good evening. Thank you for joining in. Start off with you, Sudeep. The index has ended above the 26,000 mark today, but of course it can be the year-end NAV propping and so on and so forth. Where do you see the index going in the January series? Because history has not been very kind to the index in the January series. So your call on the Nifty for the Jan series for now.
Good evening, Ormas. First of all, one thing is that we have ended the year absolutely with a bang, whatever may be the reason, whether it is NAV propping or whether it is buying from lower levels after a tight 2 months range-bound trading that we have seen in Nifty. So if we see the history, November and December generally have been very good months for the markets, and January has been on the weaker side. But this time around, November and December were not that great for the market. So I am just with just some kind of a hope that might be the history might not repeat in January. And there are reasons to do so. We'll have budget on the 1st of February. So before that, there are a lot of expectations and a lot of statements regarding that, which will keep the market vibrant and lively. So overall, if you see last 6 weeks, Nifty has been in a range. But last few sessions, we have seen banking, we have seen auto, we've seen a lot of sectors as well as sub-sectors reviving from lower levels. So that is giving me some kind of a hope. And if we see the levels, 25,850, 25,900 will act as an important support. On the upside, we expect levels of 26,400, 26,500, a new all-time high to be witnessed on Nifty in the coming few weeks. Bank Nifty,
sure.
58.
Okay, Mayuresh and Sudeep, hold on. We have another news we'll focus on today, and it's really been the stock of the last hour, at least, if not the last few days. New lease of life for Vodafone Idea after the government freezes AGR dues worth more than 87,000 crore rupees for the next 5 years. The government has rescheduled payments over a 10-year period starting FY32. The stock tumbled 9% despite that news. Ashmit Kumar is here to take us through the details of what has been offered in terms of relief for Vodafone today. Ashmit?
Well, there are 4 key takeaways that we need to bear in mind as a part of this relief package that has been cleared by the cabinet. Number one, we understand is that there will be a freeze as far as the AGR dues is concerned. That freeze is as of 31st of December 2025. The amount in question is 87,695 crore rupees. That's the first leg. The second is that for the next 5 fiscal years, beginning FY27, stretching all the way till FY31, there will be a moratorium on payout of dues. So essentially, protecting Vodafone Idea to the extent that no AGR payments will be required to be made. That's the second leg. The third is that there will be a 10-year payment schedule that has been proposed that will begin from FY32, stretch all the way across to FY41. Now, that's the third leg. The fourth is perhaps, however, the most critical aspect of it, and this has been a long-standing demand of Vodafone Idea. Vodafone Idea has been talking about how this AGR amount that was finalized was erroneous. There was double counting of various entries, that there were arithmetic errors in computation of this finalized amount, and therefore Vodafone Idea for long had been seeking a reassessment, a recalculation of all these dues. That is a demand that has been agreed to by the cabinet. The cabinet saying that yes, going forward there will be a government-appointed committee that will be reassessing these AGR dues in question, and then will arrive at a final amount that will be payable by Vodafone Idea. So clearly, important relief package being announced, being proposed, being cleared by the cabinet. But having said that, there is also just a final caveat to bear in mind that there are smaller dues for FY18 and FY19. That is something for which the cabinet is clear that payment is likely to continue. But for all other dues, moratorium for the next 5 years, then a 10-year payment schedule, and of course the finalized dues will have to be cleared by a new government-appointed committee. Back to you.
Ashmit, thank you for that update there. Mayuresh, you heard Ashmit there. A lot of uncertainty still surrounding Vodafone Idea. But of course, one thing being clear that the government does not want a duopoly in this sector. But with the kind of news that was priced in, do you still believe that there is still more chaos that is still left before things come to a standstill?
Afternoon, Ormas. First of all, season's greetings to you, Ritu, Sudeep, and the entire team at CNBC TV18. No, again, I think as Ashwin mentioned, I think it is a relief of sorts for Vodafone Idea because the kind of hit they would have taken in terms of the spectrum payments and the debt repayment itself over the next few years would have already hurt a very weakened P&L and balance sheet. Having said that, I think the core element now remains in terms of balance sheet and P&L repair. They're operating out a few circles almost. The other problematic area is that they need to have that accelerated capex done as far as the 5G ecosystem is concerned, where Jio, Airtel and its competitors are probably moving on to even the 6G ecosystem as we speak. And therefore, I think having excessive capex is not there on the books, at least at this juncture. ARPU increases have played their part. They still will play their part, but I think a large part of that will still go into a large part of debt servicing, debt repair. And as Ashwin mentioned, I think some news of 18-19 still there, which probably means that some balance sheet pain still exists. So I think let's wait for more clarity to come on this one. Largely till that point of time, I think Jio and Airtel will still probably continue to rule as far as the telecom sector is concerned.
Perhaps we'll hear more through the day, and that's an important one to update. But Sudeep, the other sector that's sort of been in focus has been the metal space. Steel stocks in particular today on the back of that safeguard duty being announced for, now we have clarity for 3 years that the 12.5 will taper down to 11, but it stays for 3 years. Your view on the sector and some of the outperformers you see there?
So, see, Nifty Metal has given a breakout, and post that breakout, we have seen a sustained up move in the last several months now. This is the news that has come yesterday, but prior to that also a lot of news flow with respect to the lower dollar index and the metal prices soaring high in the last several months. So this sector has been in limelight, and we feel that this could continue because the dollar index, we expect it to further weaken closer to 96.5, 97 levels. So that could give an additional fillip to Nifty Metal Index, and specifically in specific, if you see Jindal Steel, JSW Steel, Tata Steel, SAIL, all these four stocks we feel could be the top performers, because now Nalco, Hindalco, they have already run up a lot. So risk reward there is a bit dicey. So the other four names that I have just mentioned now offers an attractive risk reward from the current price points.
Indeed, the steel sector being the focal point of the day before Vodafone Idea took over in the second half. But let's hear out from Sudarshan with more details about the safeguard duty and how does it impact all of these steel companies. Sudarshan.
So long-awaited announcement has finally come. If you remember, in the month of April 2025, DGTR, that is Directorate General of Trade Remedies, had announced temporary safeguard duty, and that was applicable for 200 days, and it expired in the early part of November. Now, government has come out and extended that safeguard duty for the next 3 years. So in the first year from that would be applicable April 21, 2025 to April 21, 2026. And for that duty is 12%. For the second year, duty comes down to 11.5%. And for the third year, duty will be 11%. Remember, this is done to safeguard the domestic industry, which was feeling the pain from the imports that were coming in from countries like China and Vietnam. And to protect that, to protect the domestic industry, government has announced this safeguard duty for 3 years. This was a long-awaited demand from the industry, and that is being taken very positively. You can see top Nifty gainers, JSW Steel up almost 5%, Tata Steel up. Even in the mid-cap space, if you see JSP, Jindal Stainless, Kalyan Steels, all the whole set of names are trading with healthy gains on the back of this announcement. And because of the reason is it's being taken positively, and it was a long pending demand of the industry.
All the stocks gaining anywhere between 3 and 4-5%. So Darshan, stay with us. So auto stocks were also gaining ahead of the auto sales numbers for December that we're going to get tomorrow. Is it expected to be a good figure for these companies, Sudarshan?
So highway run for the auto segment started in the month of September, may continue even the month of December, and all these auto companies are likely to end 2025 on a very high note. We are expecting a strong set of numbers across the segment. All the companies are expected to report a double-digit growth as far as wholesales are concerned. If you talk about the commercial vehicle, that's basically being aided by or supported by rising freight rates, and as far as passenger vehicle and two-wheelers are concerned, the higher conversion that we had started seeing post GST rate cut is likely continuing even in the month of December. Even the ongoing wedding season is aiding to the demand. So now talking about the sector-wise, two-wheeler is expected to see a growth of 30%. Passenger vehicle is expected to see a growth of 22%. Commercial vehicle growth maybe 12%, and even tractor segment is expected to see a growth of 18%. These expectations are from Nomura. If you talk about the company-wise in two-wheeler segment, all the companies are expected to report a double-digit growth, with Bajaj Auto's growth rising by 15%, Hero Moto 26%, TVS Motor 23%, and Royal Enfield 2 may see a growth of more than 20%. Coming to the passenger vehicle segment, again, here also double-digit growth, with Maruti seeing a growth of 19%, Hyundai may see a growth of 14%, even Tata Motors passenger vehicle may see a growth in the double digit, and that can be 17%, and M&M Auto continues to outperform, and their growth can be up to 22%. Talking about the commercial vehicle segment, Tata Motors commercial vehicle may see a growth of 14%, Ashok Leyland growth may come at 17%, and in the tractor segment, Mahindra & Mahindra Tractor may see a growth of 15%. So all in all, it's a double-digit growth across the sector, and strong month, basically strong December, we are expecting from auto companies.
Strong December expected indeed. Mayuresh, PVs, CVs, tractors, two-wheelers, where do your preferences lie within the auto space?
I think a mix of all, to be honest. And we continue holding stocks like an Eicher, a Hyundai, a TVS Motor, a Hero MotoCorp, and ancillary to the tractor plays a VST tiller in our portfolio. So our sense is, as Sudarshan mentioned, strong numbers will continue for the OEM universe. There are more launches expected over the next few months. And therefore, I think the double-digit volume growth that most automakers are probably expecting, with input cost remaining benign, better margins, would reflect better on profitability. So the rating rankings that we see in markets with India seem to favor the sector as a whole. So we continue remaining bullish on this one and holding these stocks as a clear.
All right. On that note, Mayuresh and Sudeep, both of you, thank you for joining us today, and wish you both a fantastic 2026. And we hope to speak to you again soon. Okay, on that note, we're going to slip into a short break. But up next, it's Warren Buffett's last day at the helm of Berkshire Hathaway, bringing an end to a legendary 60-year-long career. We'll recap the iconic investor's journey and succession strategy when we return on the other side. Stay tuned. Welcome back. You're watching Markets Forward. Now let's take stock of the top corporate voices of the day. Blue Star is positive on FY27 and it is eyeing 15% growth for FY25. Speaking to CNBC TV18, the company's MD B. Tyagarajan said it has seen an improvement in sales over November and December. He added that inventory levels would normalize to 40 to 45 days in the coming weeks. The other stock is Bharat Forge that gained in trade after it won its largest ever small arms deal from the Ministry of Defence. In a conversation with CNBC TV18, the firm's MD Baba Kalyani said that 60% of the order of the 4.25 lakh carbines will go to Bharat Forge, adding that this will help create capabilities to create an international market for the product. He also pointed out that 100% of the gun was made in the company's plant. He said that while it had the capacity to make 50,000 to 60,000 such arms per year, it can easily double that capacity. But today marks the last day of Warren Buffett as the CEO of Berkshire Hathaway. This will end a career that spanned 6 decades, from him being known as the Oracle of Omaha to his bets being widely publicized, quotes quoted by every market participant. Hormaz has walked across to the wall to take us through that journey.
Hey, today being the last day of the year, of course, but it holds special significance for Warren Buffett as well and for Berkshire Hathaway. Today being his last day as the CEO to end a career that has spanned over 6 decades. And almost everybody now knows as to why Warren Buffett bet on Berkshire Hathaway, because it was trading below its working capital value at that time. But today, that investment has created a conglomerate that spans across insurance, infrastructure, railways, energy, consumer and industrial brands, and of course the much talked about investment portfolio. The price is what he paid, the value is what stands today 6 decades later. Today, to buy one Class A share of Berkshire Hathaway, you need to shell out $750,000. Yes, that's Buffett and his principle of a long-term compounding for you. A $1,000 investment 60 years ago would today be worth $45 million. That someone is definitely sitting in the shade today because someone planted a tree a long time ago. Now, Buffett leaves Berkshire Hathaway with a massive cash pile, literally massive, because it is $382 billion. That's more than the GDP of 152 countries on this planet. And just as all good things come to an end, Buffett's stint has ended. But the next question is, who is next? Who takes over? Meet Greg Abel, the 63-year-old Canadian who takes over the reins of this widespread conglomerate starting tomorrow. And Abel's presence is already being felt in Berkshire circles, because as recently as November this year, Berkshire disclosed a $4.5 billion stake in Google's parent Alphabet, sending Wall Street into speculation mode, as this could not have been Buffett's decision alone, considering his prior anti-tech stance. Now, he always has called Apple still his biggest bet, a consumer services company. But there is still a lot that Abel still has to conquer. First up, to win the trust of his investors and the shareholders. Although the board has wholly backed him, the shareholder trust would be paramount. Next up, hunt for bets to deploy Berkshire's cash pile. That Alphabet stake buy might just be the start of that as well. Now, a major reason why Buffett picked Abel was his trust that he will continue the culture at Berkshire, and unlike Buffett's showman like era or his aura, Abel prefers to stay away from the limelight and let his work talk. Now, he was also once hailed for this attitude by the late Charlie Munger. With Buffett at the helm of Berkshire, there was a sense of continuity, the thought that he'll be around forever, but that's not the case. Will Berkshire still be Buffett's Berkshire, or will Abel be able to turn in a new chapter in this story? Well, he stepped into the shoes that once looked impossible to fill. While they may not be impossible, they are certainly large ones, $1 trillion and more at large for sure.
Well, Hormaz, he's out of the corner office, but definitely not out of the conversation. And we'll end this show with that powerful quote that is often repeated when we talk about Warren Buffett, that, in markets, it's not about speed, it's not about leverage, it's always been about discipline. On that note, we're going to wrap up this edition of Markets Forward. We will be back with more news and updates on the other side, so stay tuned.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty end 2025 with 10% gains, underperforming Asian and global peers. PSU banks, metal and automobile are the top performers. IT, real estate and media stocks are the big laggards. Rupee ends the year just below the 90 mark against the dollar. The Indian currency depreciates 5% in 2025, making it the worst performer in Asia. A new lease of life for Vodafone Idea. Government freezes AGR dues worth more than 87,000 crore rupees for the next 5 years. Reschedules payments over a 10-year period starting FY32. A government panel will also reassess the dues and the decision will be binding on both parties. Telecom operators lock horns with Adani for not allowing them to set up network infrastructure at the newly opened Navi Mumbai airport. Telcos seek government intervention alleging denial of permission. Adani hits back, accusing telcos of acting like a cartel on pricing. Shares of steelmakers rally after government imposes a safeguard duty for 3 years, says a sudden surge in imports has affected domestic prices. Reserve Bank says that Indian commercial banks exhibited sound financial health in 2025 on the back of strong capital and liquidity buffers. Adds that stress test results affirm banks' resilience to withstand losses under adverse scenarios. The RBI report also highlights that strong capital buffers improving asset quality keep NBFCs robust. Bharat Forge will close FY26 with an order book of around 14,000 crore rupees as Baba Kalyani secures a second major government contract to supply guns designed and developed in India. That's an exclusive. Zomato, Swiggy and Zepto announced new incentives for deliveries on peak hours today. This after gig workers announced a strike on New Year's Eve, citing unsafe working conditions, declining wages, lack of social security among others. Ocean of mourners flood the streets of Dhaka on Khalida Zia's final journey. Bangladesh's first female prime minister and one of the nation's most influential leaders is laid to rest beside the grave of her husband, former President Ziaur Rahman. India's external affairs minister attends the funeral. After spending 60 years at the helm, legendary investor Warren Buffett retires as the CEO of Berkshire Hathaway today. Longtime Lieutenant Greg Abel will take the reins of the company with a record cash reserve of $380 billion. All right, let's start with the day's market action. The Wall Street snapped a 4-day ending streak, ending the year higher amid broad-based gains. Nifty rose nearly 1% and crossed the 26,100 mark for the year. Nifty and Sensex gained 10% each. However, underperformed its Asian peers and key global indices. PSU Bank, Metal and Autos were the best performing indices, rising between 23 to 30%. Meanwhile, media, realty and IT fell the most amongst indices, slipping between 12 to 20%. 31 Nifty stocks gave positive returns with gains ranging from 1% to 72%. From equities to currencies, the rupee ended the year just shy of the 90 mark against the dollar. The Indian currency has depreciated 5% this year and is the worst performer in Asia. This is also the rupee's steepest annual fall in 3 years. From currencies to the commodities market, crude oil prices are on track to register its steepest annual fall since 2020. Prices have fallen more than 2025. Fears that supply will outpace demand, higher tariffs, OPEC plus output hikes and sanctions on Russia, Iran and Venezuela all weighed on prices through the year. Silver prices remained volatile too, falling nearly 8% after gaining 10% in the last trading session. This as aggressive profit booking and thin year-end liquidity triggered heavy selling across commodity markets. Despite this, the white metal's price is 139% higher than it was at the start of the year. Similarly, gold prices also softened just before the new year. However, the yellow metal has been on a bull run in 2025 with prices rising by 65% this year. All right, the top story we're tracking this evening, a new lease of life for Vodafone Idea. The Union Cabinet has frozen AGR dues worth more than 87,000 crore rupees for the next 5 years. The payments have been rescheduled to a 10-year period starting FY32. A government panel will also reassess the dues and the decision will be binding on both parties. Shares of the company declined 10% to drop below the 11 rupee mark, which was the price set for a follow-on public offer in April last year. Ashmit Kumar is here with the details. Ashmit.
Well, there are 4 key takeaways that we need to bear in mind as a part of this relief package that has been cleared by the cabinet. Number one, we understand is that there will be a freeze as far as the AGR dues is concerned. That freeze is as of 31st of December 2025. The amount in question is 87,695 crore rupees. That's the first leg. The second is that for the next 5 fiscal years, beginning FY27, stretching all the way till FY31, there will be a moratorium on payout of dues. So essentially, protecting Vodafone Idea to the extent that no AGR payments will be required to be made. That's the second leg. The third is that there will be a 10-year payment schedule that has been proposed that will begin from FY32, stretch all the way across to FY41. Now, that's the third leg. The fourth is perhaps, however, the most critical aspect of it, and this has been a long-standing demand of Vodafone Idea. Vodafone Idea has been talking about how this AGR amount that was finalized was erroneous. There was double counting of various entries, that there were arithmetic errors in computation of this finalized amount, and therefore Vodafone Idea for long had been seeking a reassessment, a recalculation of all these dues. That is a demand that has been agreed to by the cabinet. The cabinet saying that yes, going forward there will be a government appointed committee that will be reassessing these AGR dues in question and then will arrive at a final amount that will be payable by Vodafone Idea. So clearly important relief package being announced, being proposed, being cleared by the cabinet. But having said that, there is also just a final caveat to bear in mind that there are smaller dues for FY18 and FY19. That is something for which the cabinet is clear that payment is likely to continue. But for all other dues, moratorium for the next 5 years, then a 10-year payment schedule, and of course the finalized dues will have to be cleared by a new government-appointed committee. Back to you.
Right, thank you, Ashmit, for that. Let's shift our focus to another big story that we are tracking. Incumbent telecom companies have locked horns with Adani-run Navi Mumbai Airport for not allowing them to set up network infrastructure. Industry body COAI has sought the union government's intervention over alleged denial of permission and the airport authority imposing their exclusive in-building telecom arrangement on them. Adani Airports has hit back as well, saying they won't give in to cartelization of this entire process. Madiha Mujawar joins us now. Madiha, take us through the entire tussle.
Well, passengers who have travelled from and to Navi Mumbai Airport have been complaining about network issues. Even I was there and even I faced network issues when I was reporting on day one of the commercial operations. We are unable to make calls or access internet inside the airport. That's because lack of telecom towers inside the airport premises. And at the heart of the dispute is who controls the telecom infrastructure inside the new airport and at what cost. Now, India's 3 private telecom operators, Airtel, Jio and Vodafone Idea, have written to the Department of Telecommunications accusing Navi Mumbai International Airport of denying them right-of-way permissions. Now, under India's right-of-way framework, airport operators are statutorily obligated to allow licensed telecom companies to deploy their own network infrastructure like optical fiber, erect towers, or deploy other telecom infrastructure. But NMIL has installed its own in-building solutions and directed the telecom operators to utilize that network allegedly at exorbitant and commercially untenable charges. Now, operators say that NMIL is seeking approximately 92 lakh rupees per month per operator, aggregating to over 44 crore rupees per annum for 4 operators, including BSNL, to use the network installed by it. Now, here's the airport operator's version when we reached out to them. It said that it had made a conscious decision to install the in-building solution or IBS as it is called, as a neutral host telecom network, because at many airports, the airport NMIL argues that critical zones like baggage belts, ATC buildings and utility areas get neglected by the telecom service providers, affecting airport efficiency as well as passengers. Now, it also points out that airports are highly sensitive security zones requiring frequent maintenance, which is best handled directly by the airport operator. Now, with security clearances for entry already available, NMIL says that it is best suited to take care of this infrastructure. The NMIL is also saying that it never denied right of way to any telecom service provider. The airport says that IBS charges are in line with industry standards and that the telecom operators are yet to formally revert to the airport operator. And importantly, NMIL says that government-owned BSNL is already in advanced testing stages on the IBS network installed by NMIL. So that's the dispute, and the telecom operators are urging the government to direct NMIL to give them right of way, look into what they call a monopolistic setup, and stop blaming telcos for poor network coverage at the airport.
All right, thank you, Madiha, for that comprehensive update. Moving on, steel stocks ended the day higher after the government announced a safeguard duty on steel imports. Now, the government has imposed a 3-year import duty between 11 to 12% on certain steel products from the 21st of April. The temporary 200-day duty expired last month. The government has said that this duty is required since there has been a sudden and significant increase in steel imports. This increase is causing serious damage to the domestic industry. The government launched the market access support intervention under the export promotion mission. It will involve allocation of 4,500 crore rupees in 6 years for market access support. This includes a 500 crore rupee outlay for FY26. Abhimanyu Sharma has more. Abhimanyu.
The rollout of the export promotion mission has already begun, with the government already issuing the first guideline under a component of the export promotion mission, that is the market access initiative, in which the market access support of rupees 4,531 crores would be provided over a period of 6 years. The government aims to issue the remaining guidelines for the remaining components by the 31st of January to speed up the overall rollout of the export promotion mission, not just to help exporters tide over the current problems, but also to help them explore new markets for several products which the exporters are intending to export, but are finding several difficulties as far as reaching out to foreign buyers and also resolving several other concerns is concerned. The government has also indicated that the export promotion mission per se is not in response to the US tariffs, since the US tariffs are an entirely different issue at hand. The Commerce Ministry has also indicated that tariff of over 50% cannot be countered, and the sub-schemes under the export promotion mission for interest subvention and collateral are also ready. They are going to be notified shortly as part of a continuing initiative and endeavor by the government to resolve problems being faced by exporters, particularly for labor-intensive products, owing to the US tariffs and also due to a slowdown in several Western economies.
Right, thank you, Abhimanyu, for that. Defence stocks traded positively in trade after the government signed contracts worth over 4,600 crore rupees. Bharat Forge has emerged as the largest small arms contractor for indigenously designed and developed close quarters battle carbines. Speaking with CNBC TV18 exclusively, the company's CMD, Baba Kalyani, said that Bharat Forge will also explore international markets for carbines and is in talks with 2 to 3 large companies who want to shift production out of Europe into India.
And, we have 60% of this contract because the L1 gets 60%, we were L1, so 60% of that quantity will come to us. We are quite ready, and we are very hopeful that once we productionize this, which will happen in the next 4 or 5 months, we will also create capability to start looking at international markets for these products.
Right, let's shift our focus to a story that impacts a lot of people. Quick commerce delivery platforms have announced new incentives for deliveries during peak hours today. This has come after gig workers announced a strike on New Year's Eve, citing unsafe working conditions, declining wages, lack of social security, among others. Shilpa Ranipeta, who's been tracking this very closely, is here with more details. Shilpa.
Well, you know, with the gig workers threatening a nationwide strike on today, on the 31st of December, food delivery platforms have now quietly started pushing back with higher peak hour payouts. Now, Swiggy, Zomato and other platforms also have been messaging delivery partners and updating it on their apps over the past 2 days, offering additional incentives through the evening and late night slots. And this is when, remember, order volumes are typically at their highest. Now, some of these messages seen by CNBC TV18 show delivery partners being offered an extra 30 rupees per order for deliveries between 4 to 6 p.m. today, about 100 to 105 for deliveries between 10 p.m. Between 6 p.m. to 10 p.m. and 80 rupees between 10 p.m. till midnight. Zomato, in fact, is also offering an additional 80 rupees between midnight to 4 a.m. deliveries as well. And it's not just food delivery platforms. Instamart, Blinkit, Zepto are also offering higher peak hour payouts and guaranteed earnings, which would be based on the number of orders that these delivery partners deliver. While Eternal has not commented on the strike or the payouts, Swiggy told CNBC TV18 in a statement that these enhanced incentives are part of its standard process and are offered to allow delivery partners to earn more during peak demand periods across the year. Now, remember, nearly 1.7 lakh gig workers led by the Indian Federation of App-Based Transport Workers have threatened to go on strike today and during New Year's Eve. Now, they are protesting unsafe delivery targets, falling wages, arbitrary ID blocking, police harassment, and the denial of dignity and social security. And through the protest, they are demanding regulation under labor laws, fair and predictable wages, mandatory rest breaks, and the right to organize. And all of this even as they wait the implementation of the Social Security Bill. Now, brokerage Elara Securities, in a note earlier this year, estimated that a widespread strike could hit order volumes by up to 10 to 20% for these players, and that could translate into a 0.3 to 0.7% revenue impact in the third quarter. Remember, festival days typically see up to 60% higher orders. But Elara also flags that there could be limits to this disruption because New Year's Eve is among the highest earning days for these gig workers, and this sector is still highly unorganized, and so login decisions are often driven by individual incentives, and it's a decision that one person takes on his own, and that's in fact something that platforms are now leaning on. A strike that also happened on the 25th December saw just about 40,000 workers participated, and there was just limited impact in pockets of Gurugram and some southern markets. Remember, 40,000, but India has nearly 1.7 crore delivery workers. Now, we'll have to see during the peak hours later in the night today to get a sense of how many gig workers are actually participating in the strike and the ground level impact of the strike on these platforms and us consumers ordering from them. Back to you.
All right, thank you, Shilpa, for the heads up. On that note, we'll slip into a short break. Coming up next, after spending 60 years at the helm, legendary investor Warren Buffett retires as the CEO of Berkshire Hathaway today. Details when we return. Welcome back. It's the end of an era in Bangladesh's political history. The nation bid farewell to Khalida Zia, its first female prime minister, a lady who never lost a parliamentary seat that she contested. An ocean of mourners flooded the streets of Dhaka to pay their final respects, bringing the city to a standstill. One of the two vanguards who dominated Bangladesh politics for close to 4 decades. Khalida Zia died yesterday at the age of 80 after battling multiple health complications. India's External Affairs Minister S. Jaishankar attended the funeral and met Tariq Rahman, her son, and the acting chairman of the Bangladesh Nationalist Party, the BNP, government representatives from Pakistan, Bhutan, Nepal, and diplomats from over 30 nations were in attendance as well. All right, shifting focus to the continuous series that we are talking about and flagging the inconsistencies is about the CAG report. The government's top auditor has flagged serious discrepancies in the financial assistance extended to building and construction workers in Maharashtra during the COVID-19 pandemic. The CAG audit report also found wide-ranging lapses in welfare delivery, inspections, contract management and cess collection. Santya Gora has more. Santya.
So India's top auditor has revealed major lapses in the implementation of the Building and Other Construction Workers Welfare Act in Maharashtra. A CAG report flags serious financial irregularities in schemes meant for construction workers during the COVID period. Between April 2020 and March 2022, a financial assistance scheme was launched for construction workers, and the audit reveals that in over 44,000 cases, installments under the scheme were disbursed more than once to the same bank account. In several cases, payments were transferred 5 to 6 times to a single account, leading to an excess payment of over 5 crore rupees. The audit further reveals that 60% of beneficiary claims were approved after a delay of more than 1 year, but rejection process took only 7 days. HLL Lifecare Limited, a Government of India enterprise, was selected to conduct health checkups for construction workers in the state. However, only 15% of registered workers were able to avail the benefit. The report also flags a lack of transparency in awarding contracts. Contracts for safety kits and essential kits were awarded to Indo-Allied Protein Food Private Limited and Gunina Commercials Private Limited, firms that had no prior experience in safety or essential kits and had previously dealt only with school bags, shoes and notebooks. Till March 2022, 802 essential kits worth over 36 lakh rupees were distributed twice to 401 beneficiaries. In addition, over 24,000 safety kits worth 11.38 crore rupees were distributed twice to 12,215 beneficiaries. The report also reveals that planning authorities such as BMC and MMRDA excluded non-FSI areas while applying annual statements of rate, leading to a short recovery of over 29 crore rupees in cess collection. A consortium of ITI Limited and Arcus Infotech Private Limited was awarded a contract worth 88.60 crore rupees for developing worker registration and claim management modules. However, despite failing to develop the accounting and finance module, no action was taken against the consortium by the state government. Irregularities in contractual hiring, non-registration of construction sites and workers, and non-maintenance of a midday meal database are among the other serious lapses flagged in the report concerning the welfare of building and other construction workers.
All right, thank you, Santya, for this update. Moving on, after spending 60 years at the helm, legendary investor Warren Buffett will retire as the CEO of Berkshire Hathaway today. Longtime Lieutenant Greg Abel will take the reins of the company with a record cash reserve of $380 billion. Hormaz Patakia is here with more on the highlights of Buffett's 60-year-long career.
Today being the last day of the year, of course, but it holds special significance for Warren Buffett as well and for Berkshire Hathaway. Today being his last day as the CEO to end a career that has spanned over 6 decades. And almost everybody now knows as to why Warren Buffett bet on Berkshire Hathaway, because it was trading below its working capital value at that time. But today, that investment has created a conglomerate that spans across insurance, infrastructure, railways, energy, consumer and industrial brands, and of course, the much talked about investment portfolio. The price is what he paid, the value is what stands today, 6 decades later. Today, to buy one Class A share of Berkshire Hathaway, you need to shell out $750,000. Yes, that's Buffett and his principle of a long-term compounding for you. A $1,000 investment 60 years ago would today be worth $45 million. That someone is definitely sitting in the shade today because someone planted a tree a long time ago. Now, Buffett leaves Berkshire Hathaway with a massive cash pile, literally massive, because it is $382 billion. That's more than the GDP of 152 countries on this planet. And just as all good things come to an end, Buffett's stint has ended. But the next question is, who is next? Who takes over? Meet Greg Abel, the 63-year-old Canadian who takes over the reins of this widespread conglomerate starting tomorrow. And Abel's presence is already being felt in Berkshire circles because as recently as November this year, Berkshire disclosed a $4.5 billion stake in Google's parent Alphabet, sending Wall Street into speculation mode, as this could not have been Buffett's decision alone, considering his prior anti-tech stance. Now, he always has called Apple still his biggest bet, a consumer services company. But there is still a lot that Abel still has to conquer. First up, to win the trust of his investors and the shareholders. Although the board has wholly backed him, the shareholder trust would be paramount. Next up, hunt for bets to deploy Berkshire's cash pile. That Alphabet stake buy might just be the start of that as well. Now, a major reason why Buffett picked Abel was his trust that he will continue the culture at Berkshire, and unlike Buffett's showman like era or his aura, Abel prefers to stay away from the limelight and let his work talk. Now, he was also once hailed for this attitude by the late Charlie Munger. With Buffett at the helm of Berkshire, there was a sense of continuity, the thought that he'll be around forever, but that's not the case. Will Berkshire still be Buffett's Berkshire, or will Abel be able to turn in a new chapter in this story? Well, he stepped into the shoes that once looked impossible to fill. While they may not be impossible, they're certainly large ones, $1 trillion and more at large for sure.
Thank you, Hormaz, for that. With that, it's a wrap on this edition of Business 360. News and updates continue right here. Thank you for watching.
Let's talk money.
Hello and welcome to this special edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. First of all, let me take the opportunity of wishing all of our viewers a very, very, very happy end to 2025 and an even better 2026. Hope you had a great Christmas break. And here we are with wealth creation ideas for the new year. Now, if you tracked our conversation last week, and you really should, go on YouTube and check out that show. This is the second part of our conversation with Feroz Aziz and Mohit Gang. In the previous week's episode, we spoke about certain very important lessons that all of us have learned from 2025. These are timeless lessons in wealth management and personal finance. It's not just all gyan. The market has taught us their practical importance. So make sure you check out that episode. And now we move to the second leg of the conversation, which is 2026. So where do we put in the money? How do we generate wealth this year? Thank you for staying on for this very, very spirited conversation, gentlemen. So, I want to start with a quick, medium risk, average investor portfolio that you would want to draw out. How much fixed income, equity, debt, and we've had a great conversation in terms of whether it should have gold, shouldn't have gold, and both of their portfolios can be different. And that's where, we investors need to see what fits in with our risk appetite, our goals, and you can choose accordingly. But let's start with a top-down portfolio. How will Feroz's portfolio look in 2026?
My portfolio will look something which a retail investor may not be able to replicate, but I'll stay 65% in equity, mutual funds, and I only use mutual fund as a platform, not stocks. Because the risk is half. Both are called equity, but a mutual fund's risk is half of it. So 65% in equity, 35% I do in structure products, and I have 10-15% for leverage, opportunistic entries and exits. So this is my current portfolio. Then, of course, I'm into derivatives, so I've been doing that for 20 years. So on the mutual funds, I do some part of the derivative. That's Feroz's portfolio. Now, what do I recommend to a viewer? That's what is, I think, more important. I would still say 65% in equity. If you have the courage to put money, more money in equity, and if it's long-term money, you can go as much as 80. And then if you have a conventional debt in your portfolio, put half of that in gold. I don't know where people, Manisha, who is your colleague, also says that I've been bearish on gold. I've been the most bullish on gold, but I'm bearish on debt. I don't have debt. So I personally think half your debt money should be in gold. And it should have been in sovereign gold bond from 2015. I've been saying that. But having said which, sovereign gold bonds don't come. So 65% to 80% in equity for long-term money is very, very critical. And please don't look at past performance like Surabhi said in the previous show as well. And then you have debt portion. Half your debt can be in gold. But gold, please stagger. And buy a gold fund, not a gold ETF, is the point.
All right. And we'll talk about each of the specifics as we go along in our conversation. Mohit, your recommended ideal portfolio for a medium risk retail investor, 2026.
Got it. So look, I think the way we go about this entire process is we always allocate a tactical portfolio for clients, which is 20% kind of, and then 80% is more strategic, long-term in nature, right? So on the tactical side, it's predominantly more opportunistic bets, which we believe in taking. Leaving that aside, on the strategic bet, pot, the way I would structure is 50% domestic equities, around 20% international equities, around 10% in fixed income, and around 20% in commodities, which is a mix of gold and silver both, right? So that's where it is. I firmly believe that international equities has to be a part of your core portfolio, part of your strategic bet, right? And what you buy in that also becomes of utmost importance, because you can't continue to rely on US alone. US will be a large chunk of that international portfolio, but you have to buy other economies, other markets as well, and that's where the entire shape and contour will be. One caveat out here for the year going forward, in the domestic pot, we aren't so bullish and keen on small caps this time around. So we'll just focus on the large and the mid
on the large
basket.
and mid cap space. Okay, so let's do one thing. And you've given us lots of interesting ideas, and we've got a lot of queries as well on global diversification, because investors and viewers of the show also realize that a lot of global markets have been doing better than India. So should there be, some money deployed there? The problem is a lot of the mutual funds, global funds, are not accepting money. We'll come to that in a second. But let's start with the big fund manager and mutual fund calls for 2026. So Mohit, you said that you will be more large cap and large and mid cap oriented, not so much mid and small caps. Tell us why, and then let's start drilling this down to the funds and the fund managers.
Look, Surabhi, I think honestly in the small cap and the micro cap zone, there is still a lot of froth. in spite of the correction which we have seen, which is at the headline level, let's say around 7 to 9 odd %. At a fund specific level, it could be more or less. And at a stock specific level, quite a lot of stocks have got hammered down in the market. But I think on the sheer valuation perspective, I think there is still a lot of froth. Maybe you could be a great stock picker and figure out some good names out of them. I don't dispute that. But from a mutual fund perspective, I think the overall basket to me looks expensive. Mid caps and large caps, they have stayed the course through the year, haven't disappointed you so much as the broader market has. And my sense is the first leg of momentum and the first leg of rally should start from there. It always starts at the top and then trickles down to the bottom. So perhaps 6 months down the line, I might just change my view overall. If I see momentum and trend in the market, the problem is the market hasn't given us any momentum and trend this year. Sectors have rotated very fast.
That's because the FPIs haven't come back, like Feroz said. The moment they come back, I think...
Absolutely. Currency has to stabilize and FIs have to just start coming back into the market for us to believe in the broader trend, right? So there is no broader trend, and that's where you just take the safety cocoon of large caps, because you know that there is a passive money which keeps coming into large caps and keep feeding the self-fulfilling prophecy out there.
So let's come to the funds. Mohit's fund recommendations for 2026.
On the large cap side, it's Nifty Next 50 for me. If you are a little aggressive guy, and if a little moderate guy, then a Nifty 100. But I'll go with a Nifty Next 50, a UTI Nifty Next 50 on the overall large cap basket. I've always been a big believer of passives when it comes to large caps. And I think Nifty Next 50 hasn't done much this year, but the Nifty 50 has actually given good returns. And my sense is when I see the composition of Nifty Next 50, it's a lot of industrials and a lot of sectors which I personally think are going to do much better this year, and I think the second leg of catch-up should start from Nifty Next 50 in the markets.
So that's one. Other funds?
On the large and mid-cap side, I'll go with an active choice, which is Invesco Large and Mid-Cap. I think fantastic consistency, great track record. Tahir Basha as CIO has done a fantastic job. I really like the fund house, and I think from a allocation perspective also, it gives you enough cushion with a large cap allocation, and then the mid cap is a very good synergizer out there. On the third category, which is I'll rather go with a commodities fund, which is my choice, which is an Edelweiss gold and silver fund. I like the fund particularly because they keep dynamically maintaining the gold-silver ratio at 50-50 each, right? So the moment gold goes up, they trim down, they get silver. The moment silver goes up,
so it gives you kind of the best of both, and let the fund manager decide.
Absolutely, and it's I think it's an auto rebalancing which they keep doing on a very regular frequency, right?
So what, a SIP in this fund or lump sum, or what would you do?
If you are entering now afresh, I would say yes, a staggered investment, but not like a very long SIP. I would still go with a 6-month kind of a staggered investment into it. Yes. And if you're a more aggressive variety, then perhaps just go singularly gold.
Okay, Mohit is definitely a gold and silver bull. Got that. All right, so let's come to Feroz's choices. And Feroz, of course, is a big equity bull. He's just told us that 65 to 80% of investments, at least in the medium to long term, can be towards equities. In which funds, Feroz?
So large, mid and small ratio 55, 23, 22. That's what my 14 fund basket actually refers to. Why am I still bullish, unlike Mohit, on a small cap is, like my company is a part of NSE small cap 250. It's the 40th weight. So I look at all the companies from a relative standpoint as a professional. What I realize is 63 companies changed in the last 1 year. So the earnings growth of small cap has not been bad for even FY25. 18% is the growth, but the headline says minus 9%. But 63 companies have gone through a change. So I have to undo that change and then see the growth. This year also the growth potential of small cap is 33%. We look at EPS growth of these 250 companies. If 33% ki earnings growth aati hai, of course, that's an assumption. If that were to come, small caps have to reverse. That's point one. So I will have 22, 23%. I agree with Mohit on the international exposure. I have limited ability to research China, Korea. I don't like to sit here and I have to at least have some research there. So that's why inability is why there's no
global fund.
That's point two. If you want to take global exposure, there are some funds which take it because they're not branded as global funds, like a Parag Parikh Flexi Cap. Takes money, has gold exposure. Even if he doesn't buy global stocks, if I buy into it, I get that same proportion of that day into my portfolio. So those are like workarounds to get some global sensible exposure from a fund manager standpoint. Funds, which is what I think all viewers would be interested in. Invesco India Large Cap Fund, I believe that it can outperform the Nifty 50, which is the objective. Kotak Mid Cap. Mid Cap, har jagah se Mid Cap mein paisa aata hai. Multi Cap puts money in Mid Cap. There are only 150 stocks in Mid Cap.
In Mid Caps.
All of them put money in this 150
in this
stocks.
Mid Cap universe, which is only 150
prophecy.
stocks.
Because the $1 trillion is the market cap, free float market cap. people putting in money and there's limited. Of course, large cap, there are 100 in number, but there's more free float there.
Sure.
That's the third one is HDFC small cap, Kotak multi-cap, and Bandhan large and mid cap. These are the 5 funds. If one were to buy, which is a subset of my 14 schemes, you will still have the same proportions in large, mid and small.
Okay, all right. So there you go. Lots of choices. If you are a more conservative investor, then some of the passive funds, some of the large cap funds that Mohit has recommended. If you have the stomach for a little more risk and if you can stay the course, then some mid and small cap ideas as Feroz has put on the table. Now we have to take a quick break. But beyond some of these funds, there are newer products coming to the market. So what are these newer products that we need to watch in 2026? And who are the most interesting money managers, the men and women who manage our money, whom to keep our eye out on in 2026? Back with that in just a bit.
Let's talk money. Let's talk money.
Welcome back. Here with us on the New Year special edition of Let's Talk Money. Feroz and Mohit have been giving us a lot of very, very important advice when it comes to managing our wealth, our personal finances in 2026, along with some super duper specific fund ideas as well. Now, we've discussed a couple of their favorite funds for the new year. Gentlemen, I also want to get, your quick view on the AMCs to watch, because, what's happening in the market is like they're newer AMCs. Almost every month there's a new AMC coming. So the AMCs to watch, and individually the fund managers that you'll watch out for one reason or the other. They could have just taken over a fund. There could be a, a management change. But what are you keeping your eye on, Feroz?
My belief that a fund which is new, you don't have to hurry. Like a stock which is new, it can get listed and double. And we know the laundry list which has happened in FY20, calendar 25.
Yeah.
So in mutual funds, when you see new funds, what's the hurry? You can't have a 10 rupee NAV becoming 20. So wait for a new AMC to establish 3 years of track record. It's my belief. When you have 665 funds and I buy 14 of them, I already have enough variety. They'll new be added. If they're good, of course, there could be a Sunil Singhania kind of fund manager who's coming back into retail fund management, which I really respect. And
that's the Abacus AMC.
To encourage this move, I support them? Of course, I will support them, just so that the Prashant Jain has also come back to the fund manager and give back to the country. So I say don't be in a hurry when it comes to new AMCs. What to watch out for? I think the AMCs to watch out for are the funds which are the top funds, the funds which have actually had the muscle power to get best IPOs allocated for long-term investing. I think SBI, HDFC and a few others have done a very, very good job getting a lion's share of very good undervalued stocks in pre-IPO stages. I get immense respect. Like, for example, there was one stock where SBI bought 1,000 crores of it in pre-IPO anchor, and that doubled. Now that's like huge. That's like huge value created, right? Overnight you create 1,000 crores for investors. I really respect them. So if you really want to watch something tactically, those are the AMCs which build credibility that if there is economies of scale, I'll benefit from that.
Okay. 2 fund managers you'll watch, or 1 or 2 names, 2-3 names. And Sunil Singhania and Abacus, you've already named one. Anything else
I
you'd
would
like
definitely watch out for Chirag Setalvad because he proved me wrong like how.
Okay.
So
You've always liked him.
I loved him.
Yeah.
One thing which I had a hypothesis that large funds don't outperform. And I did all the study, his large funds outperformed in spite of he not marking up his own stocks. I did a lot of study. How is he generating so much alpha? And this size has not benefited him, nor has been a disadvantage. Size agnostic, excess return, I think he has been able to generate. I'm still trying to study how is he doing that so well.
Fantastic. Managing large funds and yet delivering alpha. Got that. Mohit, same question. AMCs and fund managers to watch this year.
Yeah, I think an interesting year ahead for all of us. From an AMC perspective, look, honestly, I'm watching out the new boys on the street. The first one being Jio BlackRock FlexiCap. I think they've come with their global Aladdin model and the Jio network. So I really want to see how well they shape up, right? And the 3 of the PMS AIF guys turning into AMCs, which is Helios, Abacus and Capital Mind. I have huge respect for all the 3 fund managers, Samir Arora, Deepak Shenoy and Sunil Singhania. All 3 of them, they've done fantastic job on their PMS and AIF front. But yes, retail game of mutual funds is a very different game and we'll have to wait and watch. Emerging AMCs, Bandhan and Invesco, because you'll find the names.
Why so?
They've done exceptionally well in performance. Can they sustain? And both are going through some corporate changes. So Invesco is turning out to be IndusInd now, and Bandhan has also gone through a lot of corporate changes. So we'll wait out and watch, can they sustain the performance? And the big boys who have not been performing, Kotak, ABSL and UTI. I think they're big names, big brands, not been performing that great, a lot of churn on the fund management side, so I'll watch out for them as well. These are the AMCs. On the fund manager side, specifically there's a lot of news around S. Naren, absolutely respected figure for his comments and for his life post ICICI whenever it happens. So yes, that is one thing to be watched out for. Rajiv Thakkar, absolutely, because he's a poster boy.
Parag Parikh.
Absolutely, Parag Parikh. He's the poster boy on social media of the fund industry. Huge AUM, sitting on 15,000 to 20,000 crores of cash. When does he actually deploy that, and can he really navigate the fund now with so much of cash and still overperform? He hasn't done that great in 2025. So that's one thing. Sandeep Tandon, great underperformance after some superb outperformance for 23-24. Can he turn the tide for himself? And last guy, Nilesh Surana, Mirai, emerging blue chip, which is now called large and mid cap fund, was a great fund, has shown some signs of revamp now. Can they bounce back in the market? I think these are the 4 names I'm watching.
I'm also going to make my notes. I will watch out for all of these AMCs and the fund managers that you guys just named. So that's helpful. But let's not forget that beyond traditional funds, I mean, the regulator has been in a big overdrive as always, right? Batting for the investor. And we have newer products coming in. 25 saw the launch of SIFs. 25 saw REITs get reclassified as equity. So if a fund wants to add more equity exposure, REITs or real estate investment trusts are being treated as equity, so that fund can invest in REITs as well. These are big changes, right? So this or anything else, any new products that we should watch out for, Feroz?
I'm very, very bullish on SIF. Because when I came into the industry, the first thing which hit me is there's so many people wanting to manage cash market money for larger good. But there's hardly anybody who's doing derivative skill for larger good. Everybody who knows derivatives is sitting in a room and making money for himself or a couple of friends of his. So derivative for larger good doesn't exist till date except structured products.
Doesn't sound, it's an alien concept, derivatives for larger good.
Yeah, so that's why I started learning derivatives, because there's nobody else who is wanting to. So I'm so happy that SIF is launched. Today, when you have a discussion in an AMC with their derivative representative, there's so many which don't have. Now they've gone on to higher. They don't know Black-Scholes pricing model. They don't know Delta, Vega, Gamma, Theta, Rho. And they are now having SIF license. So people are building skills. So I'm bullish long-term extensively. And SEBI has always said, I start small and give. Now there is 25 bips of 0.25% leverage possible. As the industry evolves, there'll be more freedom and larger canvas. So SIF, I'm very, very bullish. Second, I think I have to, like, since you mentioned regulator, and I've met some of them in informal context, they're so receptive to industry feedback. You see the latest circular of the consultation paper. There's so much pragmatic action rather than very, very one-sided action. So I think SEBI has been very client-centric, and if any investor watching has doubt of regulatory framework of a mutual fund, the only choice you have is to leave money under your bed. I'm not joking. If you're still anxious about SEBI regulation of mutual fund, then the only choice you're left with. And the same guy is speaking about regulation. One guy is speaking to me about regulation of mutual fund and is invested in a cryptocurrency and left it on some wallet, and it has been hacked. And the same guy ironically was saying mutual fund mein na bahut gafla ho sakta hai.
No, I completely agree that, and I think even mutual fund top bosses, they also acknowledge to me on air, off air, that even if the industry sometimes feels that, oh, there's an extra expense or something else or some tax change, at the end of the day, they also realize that every time the regulator does something that's positive for the investor, eventually it ends up benefiting the mutual fund industry as well. So, Mohit, new products to watch.
I think I totally agree with Feroz on the SIF bit. One more product which I will add perhaps is the GIFT City outward and inward propositions. I think global Indian is a huge market, huge market. And regulations and taxation have made it very tough for them to come in India and invest. I think through GIFT City inward, that route is becoming more favorable. Only thing is we got to see whether the ticket sizes become more nominal and retailish in nature, right? GIFT City outward, because a lot of your international funds are now closed for allocations because of the RBI limit freeze, right? So GIFT City outward, you have 3 choices right now. You have a DSP Global GIFT City fund, and you have an Edelweiss JP Morgan China fund, and you have a Parag Parikh fund which has got launched outward at retail ticket sizes. To my mind, this LRS limit utilization to invest in dollar denominated assets will become massive, Surpi. In times to come, this will be like one.
I think this could be the trend of 2026. And for sure, I'm going to invite you gentlemen back, because this requires a very, very thorough discussion. There are these new funds which are being set up in GIFT City, and retail investors. Ticket size will be slightly more than the average mutual funds that we invest in, but there will be a way to invest in overseas markets. Could be the biggest trend to watch. And Feroz, you're coming back for the SIF show. The specialized investment funds, more and more are launching, and we need expertise to help and understand their models and their strategies. But exciting times ahead for investors. Completely out of time. I mean, the last 1 hour just flew. Fantastic conversation. Thank you so much, and wish you both a very happy new year as well.
Thank you so much.
All right, viewers, make sure you catch the entire conversation, what you heard just now, as well as the first part. Both of these episodes are going to be out on YouTube. Once again, wish you a very healthy, very prosperous, and very peaceful 2026 ahead. Here's to making more money in the new year. Thank you for watching.
talk money.
Hello and welcome to Rewind 2025. I'm Parikshit Luthra. 2025 has drawn to a close with 10% gains both on Sensex and the Nifty. This was the 10th consecutive year of gains on the major indices. However, it was a tough year for the stock markets, with India underperforming its peers in Asia and around the world. Manglam Malu wraps up the year that was on Dalal Street.
2025 is over, and with that, it's another year where the Nifty has clocked gains. It's 10 consecutive years of positive moves for the Nifty. Over the last 5 or 6 years, the Nifty has done extremely well. So in that regard, 2025 looks weak. Yes, we ended 10.7% higher, but we were underperformers in the world. So this year was tough. It was resilient. We managed to gain about 10.7% on the frontline index, not so much in the broader markets. But this was also the year where we had to contend with a lot of global and domestic issues. Starting with the Iran-Israel war at the start of the year. Thereafter, we had our own domestic concerns with regards to Operation Sindoor. And then Trump's tariff tantrums. They continued throughout the year. Uncertainty on the India-US trade deal. There was the GST 2.0 transition. A lot of capital moving towards artificial intelligence. Heavy FPI selling, because of which towards the end of the year, we saw weakening currency as well. And because of the GST transition and low demand in the first half of this financial year, we saw low earnings growth too. So all of this meant that the Indian market were underperformers in the globe. If you look at the Indian index in 2025, the Nifty was up 10.7%. Yes, it was up 10.7%, but compare that to Dow Jones, which is up 14%, NASDAQ up 22%, even China, which was up 18%. So a lot of money actually moved to China after its underperformance against India in 2025. It did well. Even if you look at the emerging markets index, it was up 30% as against the Nifty, which was up 10.7%. KOSPI and Spain, both these indices gaining between 50 to 76%. In regard to that, the Indian markets look like they underperformed. And that's not all. The Asian markets, the Indian currency was the weakest performing currency in all of Asia. And if you adjust for the rupee weakness, the dollar-adjusted returns on the Nifty are a mere 5.5%, nearly half of what the reported 10.7% gain on the frontline index was. It was also the year of firsts. We had gold and silver see big rallies. In fact, the first time since near 1972 where the silver index was up over 160%, and rupee-adjusted terms, gold and silver definitely were the stars of this year. It wasn't an equities market, it was a precious metals market. But in that as well, we saw record FPI outflows of $34 billion from the equity markets. There was record funds raised via IPOs, and a lot of that was offers for sale, $22 billion, which is one of the highest that we've seen. And the discipline of the SIP investors continued. Nearly $3 billion every month on an average is what the SIP investors put in the Indian markets, and that kept us afloat and kept the index positive this year. And if you look at the sectoral indices as well, this year was the year of PSU banks, metals and autos. The underperformers were the IT index and the realty index. IT because of the global uncertainty and the flight to artificial intelligence or capital deployment towards that. If you look at, the broader markets, it wasn't the year where your portfolios felt better either. Nifty small cap index was down 6%. The mid cap at an index level was up 5%. But if you look at the BSE 500 stocks, the median return out there was a negative 5%. So more stocks actually declined than the number of stocks which rose in 2025. But the ones that rose from the frontline end, there were a few. Maruti, Eicher, both of them gave you over 50% returns. Shriram Finance was the star out there. And towards the end of the year, we got that MUFG infusion of capital coming in that company as well. Hindalco, Bajaj Finance were notable gainers. But among the notable losers, yes, there were the IT names as expected, Infosys, TCS, HCL Tech. But Trent, after seeing big gains in the last few years, this year was down in the dumps. Nearly 41% for an index stock for this year was Trent. If you look at the broader markets, there were big gainers coming in the form of L&T Finance, Hindustan Copper towards the end of the year, the big rally in copper prices, underlying metals did well for that stock. AB Capital nearly doubled your money. RBL Bank also had an infusion coming in from an FDI, so that did well. And Lotus Labs was up 81% as well. Performance finally catching up to what the company had promised. But in the broader markets, the underperformers were the high-flying EMS players. These stocks had done well earlier, but valuations were concerning and growth hadn't come by. So Keynes, PG Electroplast, Dixon, all of them down between 35 to 50%. Whirlpool as well, the international promoter looking to pay a stake in the company, and that stock nearly halved one's capital if one had invested at the start of 2025. Like every year, each year has a few extremities. Cupid was one, up 600% in 2025. Then you had Shukra Pharma, Cian Agro, names that we don't usually take, but big movers in 2025. As we wrap 2025, let's look ahead at 2026 as well. The biggest trigger would be a likely US-India trade deal. If that were to happen, that would be positive. The other thing we're looking at, after many months of underperformance, will earnings recover in India? Definitely after the steps that the government has taken. And were both these two to happen, then the FPI flows, which have been on the obverse or the selling side for the last many months, will that return and turn positive as well? All those things happen, then India outperforms. Well, there are likely IPOs as well in the form of Reliance Jio, Oyo, Zepto, many new age and old companies which have filed their IPO paper. So that IPO pipeline looks abuzz in 2026 as well. And finally, can't ever lose sight of the global interest rate and commodity price scenarios. So all these will be important triggers for 2026. 2025 taught you one thing. It's not about being clever, it's about staying put.
All right, so let's see how some of these big stocks perform in the year 2026. Now to the primary markets in Indian equities, which wrapped up their biggest year on record. Fundraising hit fresh highs, deal flows stayed relentless, and execution scaled up in a way the market has rarely seen before. Rachna Dhanrajani reports that this was not a repeat of the easy money IPO cycles of the past. Investors are getting picky.
2025 has gone down as India's biggest IPO year on record. The primary market has closed the year with record mobilization and record deal flows. India was the global leader based on the number of IPOs we had, but it was not a year of easy listing pops. It was a year where as size went up, so did the scrutiny, and investors became far more selective. According to Prime Database, 103 main board IPOs raised over 1.75 lakh crore rupees, up about 10% from the record high clocked in 2024. Including SMEs, total IPO mobilization crossed 1.87 lakh crore rupees, powered by a surge in smaller listings. The Primary Pulse 2025 report by Pantomith Capital says India ranks among the top 3 markets worldwide by IPO proceeds. But 2025 also marked a shift in the shape of the market. IPOs carried the fundraising load even as other routes cooled. Data from Prime database shows that overall public equity mobilization fell 18% to 3.06 lakh crore rupees, even as qualified institutional placements and offers for sale through exchanges declined sharply. Despite this lower mobilization, the year saw some of India's largest IPOs to date. Tata Capital led the pack with 15,512 crore rupee issue, followed by HDB Financial Services at 12,500 crores and LG Electronics India at 11,605 crore rupees. The average main board deal size held near 1,708 crore rupees, suggesting the market absorbed large supply without losing breadth. But none of these record numbers have meant record listings. Prime database says the average listing gain from IPOs fell to around 10% compared with 30% in 2024. Retail enthusiasm also eased. Average retail applications fell to 14.99 lakh from 18.87 lakh last year. A clear signal that price discovery got tougher, a lot tougher. Tougher regulations also played a role in this.
There has been not a great premium listing for some of the larger sized IPOs. But if you look at how the regulatory framework has also changed, SEBI has been very, very mindful of some of these new age IPOs, technology enabled IPOs with large sized startup IPOs looking at listing.
Anchor investors emerged as a big support in the IPO market. Prime database says anchors took 35% of issuances, and for the first time, mutual funds edged past FPIs in anchor allocation. Qualified institutional buyers, including anchors, absorbed about 62% of the IPO supply. And even as FPIs sold heavily in the secondary market, they still invested 73,000 crore rupees in the primary market.
We did more than 103 main board IPOs. And the execution was seamless. And you know what it basically meant that one IPO every second day. But that didn't really what happened. What really happened was multiple IPOs getting launched and completed on the same day. I think that was one of the key highlights. Execution was seamless. We saw very broad-based sectoral participation.
These are all strong indicators of a fast maturing IPO market. Another big indicator is the selectivity in fund deployment by investors. Quality was rewarded. Aggressive pricing, particularly outside the strongest themes, was punished. There was also rising awareness about where investor money was going because 2025's IPOs pointed to a clear exit cycle at play. According to Prime database, only 37% of IPO proceeds came as fresh capital. Offers for sale by promoters accounted for 45% of the amount, while private equity and venture capital sellers contributed 12%. The takeaway from 2025 is simple. The window is open, the market has depth, and execution has scaled. But the era of making easy money through automatic listing pops is fading. Investors are willing to play ball provided they can see the goal posts and know they're not going to move on a whim. As we head into 2026, experts say the writing is on the wall. IPO size will help, institutions will set the tone, and valuation discipline will decide outcomes. In Mumbai, Rachna Thandrajani.
All right, let's move on now. We're going to take a break here on Rewind 2025. But coming up, it was a turbulent year for Indian aviation with the Air India crash and Indigo disruptions. A special report by my colleague Madhiya Mujawar when we return. Welcome back. You're watching Rewind 2025. It was a glittering year for commodities, especially precious metals. Gold, silver and platinum hit new record highs as the appetite for safe haven investments remained robust. Manisha Gupta wraps up the performance of commodities in 2025.
2025 wasn't just about outperformance in metals versus other asset classes. It was about record highs where themes like renewables, tariffs, rare earth, financialization and policies from China and US led the market to dizzying heights. Well, a year which gave record gains in gold, silver, platinum and copper. 160% gains in silver and platinum and 70% in gold, followed by 43% in copper is what 2025 doled out. In 2025, gold hit record highs 52 times in a year. The year started with nearly $2,650 an ounce. It crossed $3,000 in March, $3,500 in September, $4,000 by the time it was October, and it went to newer highs above $4,550 by the time it's December 2025. The Indian prices also factored in rupee depreciation. It started the year at rupees 79,700 and was last seen trading at rupees 1,40,000 rupees per 10 grams. Posting strongest annual gains since 1979 on the back of US Fed rate cuts, strong central bank buying and record investment purchases. Silver, in the meanwhile, outperformed gold. It's a smaller and a more volatile commodity compared to gold. Started the year with nearly $29 an ounce. It was $45 an ounce in September, was at a 14-year highs. It crossed $50 an ounce in month of October to hit record highs and then has seen strings of record highs with nearly $25 an ounce of a gain just in the month of December. If you look at the Indian silver prices, well, they saw huge premium, frenzied investment buying, and the prices have gained from an 87,000 rupees to 2,54,000 rupees in this year itself. Not too far behind is platinum, taking out its previous record highs of $2,380 an ounce to make a new all-time high at $2,500 an ounce for this one. Platinum is headed to close 2025 as its biggest annual gain, supported by third year of deficit and a very strong automotive and investment demand for this one as well. We have seen strong gains continue in case of copper, or also called as Dr. Copper, making record highs in US, China, London and India. This is on the back of US tariff concerns. It also has to do with very strong demand that we have seen. Output slowdown in major producing countries like Chile, Peru, Indonesia. Strong demand also from various industrial sectors like AI, electric vehicles, data centers, keeping it bullish also for 2026 in the year to come.
All right, let's see how commodities perform in 2026. Shifting focus to aviation, 2025 turned out to be a year of tragedy and turbulence for Indian aviation. The Air India crash in Ahmedabad killed 260 people in June. The mass cancellations of Indigo flights in early December left more than 9 lakh passengers stranded across the country. But the industry also got some global recognition and some new infrastructure. Madhiya Mujawar looks back at the year that was for the Indian aviation industry.
2025 was a defining year for Indian aviation, a year of tragedy, disruption and frustration for passengers, but also a year of expansion, global recognition and new infrastructure. I was on the ground through many of these moments, and here's a rewind of how Indian aviation lived through one of its most turbulent years. The year began with tragedy. The Air India crash in Ahmedabad shook the country. 260 people, including 12 crew members, lost their lives when flight AI 171 crashed on the 12th of June, just seconds after takeoff. Families gathered outside hospital and crash site, waiting to collect whatever was left of their loved ones. 6 months on, the key questions remain unanswered. The preliminary investigation pointed to the fuel control switches moving from run to cutoff that caused both engines to lose thrust. But investigators are yet to establish how the switches moved, whether due to a technical failure or pilot action. The crash dented Air India's reputation, put the airline under intense regulatory scrutiny, and once again highlighted gaps in aviation safety oversight. Just weeks before the crash came Operation Sindoor, As Indian fighter jets struck terror targets across the line of control, several airports along the border were temporarily shut for security reasons. Flights were cancelled and diverted across airlines. Passengers faced last-minute disruptions, but the impact went beyond domestic operations. Pakistan's continued closure of its airspace for Indian airlines put significant pressure on Air India's international operations from North India. Flights to Europe and North America take longer routes now, increasing flying time, fuel burn, crew costs, and operational complexity for Air India. It underscored a hard reality. Aviation remains vulnerable to geopolitics, border tensions, weather, and global events beyond airlines' control. As the year progressed, we witnessed something never seen before. India's largest airline, Indigo, faced widespread, cascading flight disruptions, particularly at the Delhi airport. Hundreds of passengers were stranded, flights were delayed or cancelled through the day. This wasn't weather, this wasn't a one-off technical issue, it was an operational breakdown at scale, unprecedented in India and unheard of for an airline. Even amid these challenges, India's aviation rise was unmistakable. Earlier in the year, in June, India hosted the International Air Transport Association's annual general meeting, the world's most influential airline gathering. Global airline CEOs, aircraft makers, and regulators came to Delhi to discuss the future of aviation. With Air India and Indigo placing some of the largest aircraft orders in history, India has emerged as a critical market for global aerospace companies. What became a proof of India's stake in global aviation was aircraft engine maker Safran opening its largest engine MRO in the world, the largest MRO facility in Hyderabad. It positioned India as an emerging global hub for aircraft maintenance. The move brings jobs, technology, and places India higher up the global aviation value chain. 2025 also delivered long-awaited capacity relief. Navi Mumbai International Airport finally opened, giving India's financial capital a second aviation gateway. Airlines including Indigo, Akasa Air, Air India Express, and Star Air have already launched flights from the new airport. Built with 2 parallel runways, it will allow simultaneous takeoffs and landings, a crucial upgrade for a city long constrained by a single runway at the Mumbai airport. The Navi Mumbai airport features a next-generation terminal, digital passenger processing, and advanced baggage systems designed for faster turnarounds and smoother passenger flow. Adani Airports plans to position Navi Mumbai as a hub for foreign carriers. And finally, signs of resilience among smaller players. After years of financial stress, SpiceJet's fleet in service has climbed to 33 aircraft, its highest in years, signaling a gradual turnaround. Akasa Air, meanwhile, continues to stabilize operations and expand cautiously with a fleet of 31 aircraft now. India today has just 4 major airline groups, with Air India and Indigo controlling nearly 70% of the market. In that landscape, survival itself is a test of resilience. And survival also requires continuous capital to stay afloat. So Indian aviation in 2025 was a year of extremes, tragedy, disruption, and geopolitical stress on one side, infrastructure creation, global confidence, and hard-earned resilience on the other. The ambition is undeniable. The challenge now is execution in an industry where margins are thin and the skies are unforgiving.
Keep it with CNBC TV18 for all the news and updates. Thank you for watching, and here's wishing you a very happy New Year.
Hello and welcome to Rewind 2025. I'm Shireen Bhan. The year has turned out to be a landmark for India's financial regulatory landscape. Under Governor Sanjay Malhotra, the Reserve Bank of India has rolled out one of the most far-reaching reform agendas in over a decade. Ritu explains what changed, why it matters, and how the RBI's regulatory philosophy itself has evolved.
2025 is going to be remembered as the year the Reserve Bank of India fundamentally rewired how Indian banks operate. Under Governor Sanjay Malhotra, the RBI did not just tweak rules, it dismantled and rewrote them, merging many and simplifying more. In all, we saw more than 80 regulatory changes in a single year, all aimed at the single objective to free up bank balance sheets, to revive credit growth and prepare the system for India's next investment cycle. At the heart of these reforms lies a clear shift in regulatory thinking. Governor Sanjay Malhotra has argued that Indian banks today are far stronger than they were a decade ago, better capitalized, better governed, and more resilient to shocks.
We have taken measures very balanced, calibrated, thought out, considered, and we'll continue to take more measures, as and when required. Always the aim will be to promote the stability while at the same time improving competitiveness, encouraging and enhancing growth of the economy.
One of the most consequential changes came in M&A financing. For years, banks had faced tight restrictions on funding acquisitions and promoter buyouts, which was a hangover from the excesses of the last credit cycle. In 2025, the RBI recalibrated those limits and opened the doors for acquisition financing by banks. The signal was clear. Consolidation and capital reallocation are now seen as part of economic efficiency, not excess.
So there was a period of time when we thought acquisition by one company of another company typically is a hostile route, and that the bank should not be an instrument in doing this. So this was long back. So I think that has now been set right in current context, where everything is the market and everything goes through the marketplace. And now in a completely different context, I believe the Reserve Bank has done the right thing to open it up, because it's an excellent avenue of business for banks.
Linked to this was a broader easing of rules governing bank loans against shares, IPO financing and structured credit.
These announcements are, I call them as banking reforms 3.0.
Yeah.
And these reforms are, for a long-standing demand from the banking industry.
Yeah.
And very proactively addressed by the RBI.
Yeah.
I believe that they're absolutely credit accretive.
Prudentially, the RBI chose sequencing over shock therapy. The expected credit loss framework was deferred, allowing banks 4 years' time to adapt systems and capital planning. Older project finance norms were withdrawn and merged into a simple, unified credit framework.
Circumstances change, times change, requirements change, and so nothing should be frozen in time. And so that's why we had earlier also said that we will be continuously reviewing our regulation. It's very important that we continuously revise, review, improve our whole regulatory ecosystem.
Another major cleanup came through the removal of overlapping and legacy frameworks. The RBI consolidated a total of 3,809 circulars into updated master directions and scrapped another 5,673 obsolete circulars to ease compliance. Liquidity coverage ratio norms were relaxed and external commercial borrowing norms were liberalized, giving firms greater access to offshore capital while retaining safeguards on maturity, currency risk, and end use.
The global discourse has been to move towards a principle-based regulation for reasons of simplicity over exhaustive specification, which may not even be possible. Not only is it not possible, but it can also lead to a very creative way of complying with the regulations adopting a tick box kind of an approach that, yes, we have complied with these, and these provisions of the various regulations, and not serve really, the outcome.
These reforms extended beyond large banks. Risk weights on lending to NBFCs and MFIs were restored, co-lending norms expanded, and priority sector rules eased for small finance banks. Parallelly, the RBI addressed the cost of credit. Through 2025, it delivered 4 rate cuts, taking the repo rate from 6.5% to 5.25%. Loan reset norms were reviewed to ensure faster transmission to borrowers. The governor exuded confidence.
Since the October policy, the Indian economy has witnessed rapid disinflation, with inflation coming down to an unprecedentedly low level. Inflation at a benign 2.2% and growth at 8% for the first half of this year presents a rare Goldilocks period.
But the clearest signal of confidence showed through in bank licensing. After a long hiatus, the RBI granted a full-fledged banking license to AU Small Finance Bank and also approved Fino Payments Bank's transition into a small finance bank. The other significant shift came when RBI signaled greater openness to foreign capital, paving the way for Japan's SMBC to invest in Yes Bank and Emirates MBD buying a stake in RBL Bank. Taken together, the RBI's actions in 2025 mark a decisive shift from crisis-era regulation to growth-era regulation. Now, this is not deregulation without discipline, but the tone has changed. The RBI is no longer regulating for the last crisis, it is regulating for the next investment cycle. In Bengaluru, Ritu Singh.
Well, a significant year, 2025 for the RBI, many regulatory changes being ushered in. Now, 2025 has also been a landmark year for the goods and services tax in India, characterized by sweeping reforms, simplified slabs, strong collections and a major shake-up in how tobacco and sin goods are taxed. Timsy Jaipuria has the details on what changed. Timsy, the government finally gave the consumers and the industry something that they'd spent years asking for.
Well, let me take you back to Independence Day 2025. Since Prime Minister Modi took charge, he's reserved his 15th August speech for some big bang announcement. And this year was no different.
मेरे प्यारे देशवासियों, हम नेक्स्ट जनरेशन जीएसटी रिफॉर्म्स लेकर के आ रहे हैं. ये दिवाली के अंदर आपके लिए तोहफा बन जाएंगे.
The Finance Ministry went into hyperdrive after this, and Finance Minister Nirmala Sitharaman was able to deliver on what industry had been demanding for years: a simpler, cleaner rate structure, much ahead of schedule. She announced the changes on the 3rd September and set the 22nd of September for the biggest GST rate rationalization since the tax was launched in 2017. The old 4-slab structure of 5%, 12%, 18% and 28% was the first to go. In its place, we have a simplified 2-rate structure, a merit rate of 5% and a standard rate of 18%. We also have a special rate of 40% applicable only on sin goods. Of course, this meant a ton of goods had to be moved to new rates. So many key commodities like butter, ghee, biscuits, pasta, namkeen, etc., especially those categorized as basic and essential goods, were brought under the 5% slab. Remember, many of these were earlier taxed at either 12% or 18%. Goods like cement and paints, which were classified as standard goods, were moved to the 18% bracket. Most services remained to this rate slab. A major category here is basic 4-wheelers and 2-wheelers. These have been brought down from the 28% plus cess bracket to 18%, making them more affordable. Similarly, a bunch of consumer durables like TVs, refrigerators and washing machines have been moved down to the 18% slab from the earlier 28% slab. The council also cleaned up the list of items in the luxury, sin and demerit goods category. Now this list is limited to a few items like aerated drinks and luxury cars. So in the case of aerated beverages, the tax incidence has been kept the same but made simpler. Instead of 28% plus cess of 12%, these attract a flat 40%. Similarly, luxury cars also attract a flat 40% GST instead of the earlier 28% plus cess. Medicines were the other big impact area of this exercise. A host of drugs were brought down from 12% to either nil or were zero rated. This made these drugs cheaper. GST on essential services like health and life insurance premia has also been brought down from 18% to nil. So that's the much needed relief for these insurance customers and a long-standing demand from both the populace and industry. The government's confidence in pushing through and implementing this major reform came from two sources. One is the fact that there was a need to re-energize the consumption cycle. The other was a trend of strong GST collections, which were averaging at nearly 2 lakh rupees a month for most of the financial year. As you can see on this chart, there is a slight dip in the number announced at the beginning of December to 1.7 lakh crore rupees. This is the first collection where the full impact of GST 2.0 was felt, and the government is of the opinion that it is still indicating overall GST revenues as remaining robust. And so that's a strong sign that the simplified slabs, a rise in consumption due to cheaper goods, and improved compliance under GST 2.0 are helping sustain tax buoyancy. But there's one area that's yet to see a change in slabs, and that's the levy on cigarettes, tobacco products and pan masala. The GST Council had held off making any changes to these products as the compensation cess these brought in was still being used to pay off the loans taken to compensate states for the losses due to COVID-19 pandemic. Currently, these goods attract 28% GST plus cess. But we do have some clarity on how these will change once the loans are repaid. According to two bills introduced by the government, the Health Securities and National Security Cess Bill 2025 and Central Excise Amendment Bill 2025, the government plans to replace the quantum of compensation cess levy on cigarettes, cigars, gutka and other tobacco products and pan masala. Under GST 2.0, these products are expected to fall under the new demerit slab of 40%, and the gap in the tax incidence will be made up by the new taxes. On pan masala, for instance, tax will be 40% GST plus health securities and national security cess. On cigarettes and other tobacco products, we are looking at 40% GST plus a higher rate of central excise duty. Effectively, this will retain the overall tax incidence on these products, preventing any sharp drop in government revenues while keeping prices steady. So, for the Goods and Services Tax 2025 has not been just a year of routine tweaks. It's been a year of evolution into a leaner tax with simpler slabs, stronger collections and sharper enforcement, while keeping consumer prices in check and setting the consumption cycle rolling again. In New Delhi, Timsi Jaipuria.
Well, 2025, the year that we saw that big GST rate rationalization. Up next on Rewind 2025, a year of top-level churn across the FMCG industry in India and around the world. That and more when we return. You're watching Rewind. Well, this is Rewind 2025. It's been a sluggish year for steel makers across the world. Weak demand, high energy costs, tariff tensions and persistent overcapacity proved to be a heady cocktail for companies world over. However, the new year is bringing fresh hope for the industry. Nigel explains why steel makers are pinning their hopes on a turnaround in 2026.
Well, that's right. The big question is what's in store for steel in 2026? Well, in the near term, steel prices, they have weakened, and that's likely to weigh on margins for steel companies just in the near term. In India, the hot rolled coil prices, they're down by roughly around 8% from the September quarter. That's driven by lower Asian prices as well as the expiry of the interim 12% safeguard duty, which happened in early November. But that's where things start to get a little bit more interesting. Now, there are growing hopes that steel prices may be close to the bottom. And they say this because Asian steel spreads, well, they are at near 15-year lows, almost 40% below their long-term averages. At these prices, these levels, spreads, well, they look unsustainable. And part of the street is optimistic of a recovery, especially if China's anti-involution policy leads to production or supply cuts. Now, let's turn our attention to the largest steel producer, which is China. China's steel production is down by close to 3 to around 4% year to date. But exports, they're up by around 6.5 to around 7%, and they remain elevated because Chinese demand has been weak. In fact, Chinese exports have crossed 100 million tons in the first 11 months of 2025 itself, and that continues to put pressure on steel prices. Turning to India, well, India's steel consumption has grown by around 11 to around 12% CAGR over the last 4 years, and growth of around 7 to 8% is expected in the times to come. At the same time, Indian steel companies, well, they are adding capacity, which means demand needs to keep pace to avoid oversupply. And that brings us to a key policy trigger. With Chinese exports high and export options limited, well, steel companies are hoping for the reintroduction of safeguard duty that expired in November 2025. Earlier in 2025, remember, the interim 12% safeguard duty helped domestic HRC prices trade at roughly around 9% premium to landed imports. But once that duty expired in November, prices, well, they have quickly converged with import levels. If safeguard duty returns, well, they could provide the much needed support to domestic steel prices. So heading into 2026, steel, well, it faces near-term pressure, but the setup could hopefully slowly improve with spreads near the bottom. Policy support will be in focus, and demand growth, as always, will be the key swing factor.
Well, thanks very much, Nigel. Will it be a turnaround year for steel? One will have to wait to see. But it was a year of change for consumer companies world over. Unilever, PepsiCo, Diageo, L'Oreal all saw changes in the corner office. In India, HUL, Nestle, Britannia saw leadership changes as the FMCG industry transformed into a high-stakes battleground. Shilpa reports the message to FMCG CEOs from the boardroom is simple: perform or perish.
The corner offices at many FMCG firms saw new occupants through 2025. From Hindustan Unilever and Britannia in India to Nestle, Unilever to PepsiCo globally, 2025 had some of the biggest consumer giants seeing one of the most dramatic waves of C-suite churn in over a decade. Let's start at home. HUL, India's largest FMCG company, saw CEO Rohit Java step down barely 2 years in the top job. His exit came after muted sales, flat volumes and investor pushback on the revival pace. Priya Nair, who served as the president of beauty and well-being at Unilever globally and has over 30 years of experience, has since taken charge and set HUL on a path that focuses on volumes to rekindle growth. Then there's Britannia. CEO Rajneet Kohli resigned in March and moved to HUL. He was replaced at Britannia by Rakshit Hargave, who was the CEO of Birla Opus. But then came the real shocker. Long-time MD Varun Berry abruptly announced his exit in November, with even his notice period being waived off. Markets reacted instantly, the stock slid over 5%, and all eyes are now on incoming chief Rakshit Hargave to steady the ship. There were also planned changes at Nestle India. That was a planned retirement. Manish Tiwari, who was heading Amazon India, has stepped in to replace Suresh Narayanan, who has been at the helm for a decade. Narayanan successfully steered Nestle through its biggest crisis, the Maggi ban, and then he focused on innovation and diversified Nestle's portfolio with expansion into categories like breakfast cereals, pet food, and more. Tiwari is now banking on digital growth, innovation, and a consumer-centric strategy to get the FMCG giant accelerating on the next leg of growth. L'Oreal India and Diageo India also saw leadership changes. Overall, 2025 have been a tough year for the FMCG industry in India, which struggled with rising inflation, muted performance, slowing urban demand. While income tax cuts, GST rates changes, and cooling inflation towards the end of the year, providing some relief, signs of recovery have begun to show. But the challenge is to keep the ship steady at the time of choppy waters on the global geopolitical and trade front as well. Now, while leadership changes in India were due to a mix of muted performance and planned transitions, the churn in the global FMCG landscape has been a lot more dramatic. Let's start with Nestle Global. Now, the company saw 3 CEOs change in less than 14 months. In August 2024, Mark Schneider was replaced with Laurent Freshy as Nestle CEO to rev up the company's performance. But Freshy was ousted less than a year later over an undisclosed personal relationship, and Philippe Navratil was then appointed CEO. Nestle's then chairman, Paul Bulke, too, first announced that he would retire in 2026, a year earlier than his scheduled retirement. But then he exited even earlier in September this year, and Pablo Ayala has taken over from the 1st of October. All against the backdrop of the company's worst growth in 2 decades, with volumes being flat or even declining and sales shrinking as well, and the boardroom losing patience quickly. Unilever also threw a curveball. CEO Heinz Schumacher was out in less than 2 years, and the company was looking to turn around, but the board wanted faster change, and they handed over the reins to CFO Fernando Fernandez, who has now taken over as the CEO. Diageo also has multiple faces that have occupied the corner office through 2025. In the middle of a multi-year cost-cutting reset, it saw CEO Deborah Crew step down. Nick Jangiani took over as interim chief, and now the firm is looking forward to welcoming Sir Dave Lewis as its new CEO in 2026, tasked with turning around the maker of Johnnie Walker, which has been plagued with declining sales and high debt. Even Coke and PepsiCo are both pivoting as they struggle to swallow weak beverage demand worldwide. Henry K. Brown, who worked at Coke in various leadership roles for 30 years, is now set to take over as the next CEO from March. Rival Pepsi is also in the throes of reorganization. It has elevated its North America CEO to a newly created EVP and vice chairman role, and it has appointed new CEOs, one for North America and one for Latin America Foods, and it soon also unveiled a new plan to accelerate sales and also improve margins. Now, in the global FMCG space, there's a clear pattern to the cause of this churn. Sluggish volumes, discretionary slowdown, rising competition, rising input costs, and geopolitical uncertainty. But most of it all, investor impatience. Boards and investors no longer want 5-year or 10-year plans. They want visible action, and they want it fast. 2025 has seen the FMCG world transform from slow, steady, and predictable to high-stakes, high-pressure battleground where even industry veterans can be shown the door if numbers don't impress. In today's FMCG boardrooms, the message is brutally simple: deliver growth or move aside.
Well, 2025 turning out to be a year of churn for the FMCG sector. Will 2026 beckon better days? With that, it is time for us to wrap up this edition of Rewind 2025. Here's wishing all of our viewers a very Merry Christmas and a very Happy New Year. Keep watching CNBC TV18. We promise to keep you updated on everything that matters to you. Stay with us. We're back after this break.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty end 2025 with 10% gains, underperforming Asian and global peers. PSU banks, metal and automobile are the top performers. IT, real estate and media stocks are the big laggards. Rupee ends the year just below the 90 mark against the dollar. The Indian currency depreciates 5% in 2025, making it the worst performer in Asia. A new lease of life for Vodafone Idea. Government freezes AGR dues worth more than 87,000 crore rupees for the next 5 years. Reschedules payments over a 10-year period starting FY32. A government panel will also reassess the dues and the decision will be binding on both parties. Telecom operators lock horns with Adani for not allowing them to set up network infrastructure at the newly opened Navi Mumbai airport. Telcos seek government intervention alleging denial of permission. Adani hits back, accusing telcos of acting like a cartel on pricing. Shares of steelmakers rally after government imposes a safeguard duty for 3 years, says a sudden surge in imports has affected domestic prices. Reserve Bank says that Indian commercial banks exhibited sound financial health in 2025 on the back of strong capital and liquidity buffers. Adds that stress test results affirm banks' resilience to withstand losses under adverse scenarios. The RBI report also highlights that strong capital buffers improving asset quality keep NBFCs robust. Bharat Forge will close FY26 with an order book of around 14,000 crore rupees as Baba Kalyani secures a second major government contract to supply guns designed and developed in India. That's an exclusive. Zomato, Swiggy and Zepto announced new incentives for deliveries on peak hours today. This after gig workers announced a strike on New Year's Eve, citing unsafe working conditions, declining wages, lack of social security among others. Ocean of mourners flood the streets of Dhaka on Khalida Zia's final journey. Bangladesh's first female prime minister and one of the nation's most influential leaders is laid to rest beside the grave of her husband, former President Ziaur Rahman. India's external affairs minister attends the funeral. After spending 60 years at the helm, legendary investor Warren Buffett retires as the CEO of Berkshire Hathaway today. Longtime Lieutenant Greg Abel will take the reins of the company with a record cash reserve of $380 billion. All right, let's start with the day's market action. The Wall Street snapped a 4-day ending streak, ending the year higher amid broad-based gains. Nifty rose nearly 1% and crossed the 26,100 mark for the year. Nifty and Sensex gained 10% each. However, underperformed its Asian peers and key global indices. PSU bank, metal and autos were the best performing indices, rising between 23 to 30%. Meanwhile, media, realty and IT fell the most amongst indices, slipping between 12 to 20%. 31 Nifty stocks gave positive returns with gains ranging from 1% to 72%. From equities to currencies, the rupee ended the year just shy of the 90 mark against the dollar. The Indian currency has depreciated 5% this year and is the worst performer in Asia. This is also the rupee's steepest annual fall in 3 years. From currencies to the commodities market, crude oil prices are on track to register its steepest annual fall since 2020. Prices have fallen more than 15% over the course of 2025. Fears that supply will outpace demand, higher tariffs, OPEC plus output hikes and sanctions on Russia, Iran and Venezuela all weighed on prices through the year. Silver prices remained volatile too, falling nearly 8% after gaining 10% in the last trading session. This as aggressive profit booking and thin year-end liquidity triggered heavy selling across commodity markets. Despite this, the white metals price is 139% higher than it was at the start of the year. Similarly, gold prices also softened just before the new year. However, the yellow metal has been on a bull run in 2025 with prices rising by 65% this year. All right, the top story we're tracking this evening, a new lease of life for Vodafone Idea. The Union Cabinet has frozen AGR dues worth more than 87,000 crore rupees for the next 5 years. The payments have been rescheduled to a 10-year period starting FY32. A government panel will also reassess the dues and the decision will be binding on both parties. Shares of the company declined 10% to drop below the 11 rupee mark, which was the price set for a follow-on public offer in April last year. Ashmit Kumar is here with the details. Ashmit.
Well, there are four key takeaways that we need to bear in mind as a part of this relief package that has been cleared by the cabinet. Number one, we understand is that there will be a freeze as far as the AGR dues is concerned. That freeze is as of 31st of December 2025. The amount in question is 87,695 crore rupees. That's the first leg. The second is that for the next 5 fiscal years, beginning FY27, stretching all the way till FY31, there will be a moratorium on payout of dues. So essentially, protecting Vodafone Idea to the extent that no AGR payments will be required to be made. That's the second leg. The third is that there will be a 10-year payment schedule that has been proposed that will begin from FY32, stretch all the way across to FY41. Now, that's the third leg. The fourth is perhaps, however, the most critical aspect of it, and this has been a long-standing demand of Vodafone Idea. Vodafone Idea has been talking about how this AGR amount that was finalized was erroneous. There was double counting of various entries, that there were arithmetic errors in computation of this finalized amount, and therefore Vodafone Idea for long had been seeking a reassessment, a recalculation of all these dues. That is a demand that has been agreed to by the cabinet. The cabinet saying that yes, going forward there will be a government-appointed committee that will be reassessing these AGR dues in question, and then will arrive at a final amount that will be payable by Vodafone Idea. So clearly, important relief package being announced, being proposed, being cleared by the cabinet. But having said that, there is also just a final caveat to bear in mind that there are smaller dues for FY18 and FY19. That is something for which the cabinet is clear that payment is likely to continue. But for all other dues, moratorium for the next 5 years, then a 10-year payment schedule, and of course the finalized dues will have to be cleared by a new government-appointed committee. Back to you.
Incumbent telecom companies have locked horns with Adani-run Navi Mumbai Airport for not allowing them to set up network infrastructure. Industry body COAI has sought the union government's intervention over alleged denial of permission and the airport authority imposing their exclusive in-building telecom arrangement on them. Adani Airport has hit back as well, saying that they won't give in to cartelization. Madiha Mujawar joins us now with more. Madiha, please take us through the entire tussle.
Well, passengers who have travelled from and to Navi Mumbai Airport have been complaining about network issues. Even I was there and even I faced network issues when I was reporting on day one of the commercial operations. We are unable to make calls or access internet inside the airport. That's because lack of telecom towers inside the airport premises. And at the heart of the dispute is who controls the telecom infrastructure inside the new airport and at what cost. Now, India's 3 private telecom operators, Airtel, Jio and Vodafone Idea, have written to the Department of Telecommunications accusing Navi Mumbai International Airport of denying them right-of-way permissions. Now, under India's right-of-way framework, airport operators are statutorily obligated to allow licensed telecom companies to deploy their own network infrastructure like optical fiber, erect towers or deploy other telecom infrastructure. But NMIL has installed its own in-building solutions and directed the telecom operators to utilize that network allegedly at exorbitant and commercially untenable charges. Now, operators say that NMIL is seeking approximately 92 lakh rupees per month per operator, aggregating to over 44 crore rupees per annum for 4 operators, including BSNL, to use the network installed by it. Now, here's the airport operator's version when we reached out to them. It said that it had made a conscious decision to install the in-building solution, or IBS as it is called, as a neutral host telecom network, because at many airports, the airport NMIL argues that critical zones like baggage belts, ATC buildings and utility areas get neglected by the telecom service providers, affecting airport efficiency as well as passengers. Now, it also points out that airports are highly sensitive security zones requiring frequent maintenance, which is best handled directly by the airport operator. Now, with security clearances for entry already available, NMIL says that it is best suited to take care of this infrastructure. The NMIL is also saying that it never denied right-of-way to any telecom service provider. The airport says that IBS charges are in line with industry standards and that the telecom operators are yet to formally revert to the airport operator. And importantly, NMIL says that government-owned BSNL is already in advanced testing stages on the IBS network installed by NMIL. So that's the dispute, and the telecom operators are urging the government to direct NMIL to give them right of way, look into what they call a monopolistic setup, and stop blaming telcos for poor network coverage at the airport.
All right, thank you, Madhiya, for that comprehensive update. Moving on, steel stocks ended the day higher after the government announced a safeguard duty on steel imports. Now, the government has imposed a 3-year import duty between 11 to 12% on certain steel products from the 21st of April. The temporary 200-day duty expired last month. The government has said that this duty is required since there has been a sudden and significant increase in steel imports. This increase is causing serious damage to the domestic industry. The government launched the market access support intervention under the export promotion mission. It will involve allocation of 4,500 crore rupees in 6 years for market access support. This includes a 500 crore rupee outlay for FY26. Abhimanyu Sharma has more. Abhimanyu.
The rollout of the export promotion mission has already begun, with the government already issuing the first guideline under a component of the export promotion mission, that is the market access initiative, in which the market access support of rupees 4,531 crores would be provided over a period of 6 years. The government aims to issue the remaining guidelines for the remaining components by the 31st of January to speed up the overall rollout of the export promotion mission, not just to help exporters tide over the current problems, but also to help them explore new markets for several products which the exporters are intending to export but are finding several difficulties as far as reaching out to foreign buyers and also resolving several other concerns is concerned. The government has also indicated that the export promotion mission per se is not in response to the US tariffs, since the US tariffs are an entirely different issue at hand. The Commerce Ministry has also indicated that tariff of over 50% cannot be countered, and the sub-schemes under the export promotion mission for interest subvention and collateral are also ready. They are going to be notified shortly as part of a continuing initiative and endeavor by the government to resolve problems being faced by exporters, particularly for labor-intensive products owing to the US tariffs and also due to a slowdown in several Western economies.
Right, thank you, Abhimanyu, for that. Defence stocks traded positively in trade after the government signed contracts worth over 4,600 crore rupees. Bharat Forge has emerged as the largest small arms contractor for indigenously designed and developed close quarters battle carbines. Speaking with CNBC TV18 exclusively, the company's CMD, Baba Kalyani, said that Bharat Forge will also explore international markets for carbines and is in talks with 2 to 3 large companies who want to shift production out of Europe into India.
And we have 60% of this contract because the L1 gets 60%, we were L1, so 60% of that quantity will come to us. We are quite ready and we are very hopeful that once we productionize this, which will happen in the next 4 or 5 months, we will also create capability to start looking at international markets for these products.
Swiggy, Zomato and Zepto have announced new incentives for deliveries during peak hours today. This has come after gig workers announced a strike on New Year's Eve, citing unsafe working conditions, declining wages, lack of social security, among others. Shilpa Ranipeta, who's been tracking all these developments very closely, is here with us with more details. Shilpa.
Well, you know, with the gig workers threatening a nationwide strike today on the 31st of December, food delivery platforms have now quietly started pushing back with higher peak hour payouts. Now, Swiggy, Zomato and other platforms also have been messaging delivery partners and updating it on their apps over the past 2 days, offering additional incentives through the evening and late night slots. And this is when, remember, order volumes are typically at their highest. Now, some of these messages seen by CNBC TV18 show delivery partners being offered an extra 30 rupees per order for deliveries between 4 to 6 p.m. today, about 100 to 105 for deliveries between 10 p.m. Between 6 p.m. to 10 p.m. and 80 rupees between 10 p.m. till midnight. Zomato, in fact, is also offering an additional 80 rupees between midnight to 4 a.m. deliveries as well. And it's not just food delivery platforms. Instamart, Blinkit, Zepto are also offering higher peak hour payouts and guaranteed earnings, which would be based on the number of orders that these delivery partners deliver. While Eternal has not commented on the strike or the payouts, Swiggy told CNBC TV18 in a statement that these enhanced incentives are part of its standard process and are offered to allow delivery partners to earn more during peak demand periods across the year. Now remember, nearly 1.7 lakh gig workers led by the Indian Federation of App-Based Transport Workers have threatened to go on strike today and during New Year's Eve. Now, they are protesting unsafe delivery targets, falling wages, arbitrary ID blocking, police harassment, and the denial of dignity and social security. And through the protest, they are demanding regulation under labor laws, fair and predictable wages, mandatory rest breaks, and the right to organize. And all of this even as they wait the implementation of the Social Security Bill. Now, brokerage Elara Securities, in a note earlier this year, estimated that a widespread strike could hit order volumes by up to 10 to 20% for these players, and that could translate into a 0.3 to 0.7% revenue impact in the third quarter. Remember, festival days typically see up to 60% higher orders. But Elara also flags that there could be limits to this disruption because New Year's Eve is among the highest earning days for these gig workers, and this sector is still highly unorganized, and so login decisions are often driven by individual incentives, and it's a decision that one person takes on his own, and that's in fact something that platforms are now leaning on. A strike that also happened on the 25th December saw just about 40,000 workers participated, and there was just limited impact in pockets of Gurugram and some southern markets. Remember, 40,000, but India has nearly 1.7 crore delivery workers. Now, we'll have to see during the peak hours later in the night today to get a sense of how many gig workers are actually participating in the strike and the ground level impact of the strike on these platforms and us consumers ordering from them. Back to you.
All right, thank you, Shilpa, for the heads up. On that note, we'll slip into a short break. Coming up next, after spending 60 years at the helm, legendary investor Warren Buffett retires as the CEO of Berkshire Hathaway today. Details when we return. Welcome back. It's the end of an era in Bangladesh's political history. The nation bid farewell to Khaleda Zia, its first female prime minister, a lady who never lost a parliamentary seat that she contested. An ocean of mourners flooded the streets of Dhaka to pay their final respects, bringing the city to a standstill. One of the two vanguards who dominated Bangladesh politics for close to 4 decades. Khaleda Zia died yesterday at the age of 80 after battling multiple health complications. India's External Affairs Minister S. Jaishankar attended the funeral and met Tariq Rahman, her son, and the acting chairman of the Bangladesh Nationalist Party, the BNP, government representatives from Pakistan, Bhutan, Nepal, and diplomats from over 30 nations were in attendance as well. Moving on, after spending 60 years at the helm, legendary investor Warren Buffett will retire as the CEO of Berkshire Hathaway today. Longtime Lieutenant Greg Abel will take the reins of the company with a record cash reserve of $380 billion. Hormaz Patakia is here with more on the highlights of Buffett's 60-year-long career.
Today being the last day of the year, of course, but it holds special significance for Warren Buffett as well and for Berkshire Hathaway. Today being his last day as the CEO to end a career that has spanned over 6 decades. And almost everybody now knows as to why Warren Buffett bet on Berkshire Hathaway, because it was trading below its working capital value at that time. But today, that investment has created a conglomerate that spans across insurance, infrastructure, railways, energy, consumer and industrial brands, and of course the much talked about investment portfolio. The price is what he paid, the value is what stands today 6 decades later. Today, to buy one Class A share of Berkshire Hathaway, you need to shell out $750,000. Yes, that's Buffett and his principle of a long-term compounding for you. A $1,000 investment 60 years ago would today be worth $45 million. That someone is definitely sitting in the shade today because someone planted a tree a long time ago. Now, Buffett leaves Berkshire Hathaway with a massive cash pile, literally massive, because it is $382 billion. That's more than the GDP of 152 countries on this planet. And just as all good things come to an end, Buffett's stint has ended. But the next question is, who is next? Who takes over? Meet Greg Abel, the 63-year-old Canadian who takes over the reins of this widespread conglomerate starting tomorrow. And Abel's presence is already being felt in Berkshire circles, because as recently as November this year, Berkshire disclosed a $4.5 billion stake in Google's parent Alphabet, sending Wall Street into speculation mode, as this could not have been Buffett's decision alone, considering his prior anti-tech stance. Now, he always has called Apple still his biggest bet, a consumer services company. But there is still a lot that Abel still has to conquer. First up, to win the trust of his investors and the shareholders. Although the board has wholly backed him, the shareholder trust would be paramount. Next up, hunt for bets to deploy Berkshire's cash pile. That Alphabet stake buy might just be the start of that as well. Now, a major reason why Buffett picked Abel was his trust that he will continue the culture at Berkshire. And unlike Buffett's showman like era or his aura, Abel prefers to stay away from the limelight and let his work talk. Now, he was also once hailed for this attitude by the late Charlie Munger. With Buffett at the helm of Berkshire, there was a sense of continuity, the thought that he'll be around forever, but that's not the case. Will Berkshire still be Buffett's Berkshire, or will Abel be able to turn in a new chapter in this story? Well, he stepped into the shoes that once looked impossible to fill. While they may not be impossible, they're certainly large ones, $1 trillion and more at large for sure.
Thank you, Hormaz, for that. With that, it's a wrap on this edition of Business 360. News and updates continue right here. Thank you for watching.
and welcome to this special edition of Startup Street. I'm Ritu Singh, and with me is my colleague Arundhati Ramanan. Now, Seed, an early-stage investment platform, IAN Group has announced the final close of its second VC fund, the IAN Alpha Fund, at $100 million. This fund is going to back innovative startups and MSMEs, particularly those leveraging breakthrough technologies like AI, space, semiconductors, biotech, and climate solutions, with a focus on India's national strategic priorities. Now, since its launch, the fund has already invested in more than a dozen startups, many led by first-generation founders from Tier 2 and 3 cities.
Absolutely, Ritu, and backed by a mix of government, institutional and global investors, the group said its Alpha Fund reflects strong confidence in IAN's two-decade track record of scaling high-potential ventures. IAN's portfolio of 250-plus companies today stands at a market valuation of almost $10 billion in sectors such as space tech, biotech, defense tech, AI, ML, SaaS, robotics, fintech, health tech, manufacturing tech, consumer tech, and a whole lot more. Joining us today to discuss what this fund means for India's deep tech decade are Padmaja Ruparel and Saurabh Srivastava, the co-founders of IAN Group.
Well, Saurabh, let me start with you and welcome both of you to the show. You know, the IAN Alpha Fund has reached a $100 million final close at a time when early-stage funding in India has slowed down a bit. Start by talking to us about how easy or hard it was to convince investors to commit, given the broader cautious environment overall.
Well, investors are cautious, but, you know, there is a lot happening today on the scene, which is also exciting investors. And at IAN, we actually did not have a lot of problems in interesting them, because one of the things is that we've been around for over 2 decades. So there's enough that they can see, both in terms of what we did earlier on angel investing in the angel fund, in our fund 1, and now, of course, Alpha Fund. So there were many things they could touch and feel, and we could show them what we had done. And actually also, as you mentioned, we made some investments already. So we could share with them both the investments we made and the kind of pipeline that we were seeing, which I should tell you is extremely exciting. So we were very fortunate that we got a whole lot of, I would say, marquee institutional investors, and of course, a lot of good HNIs and family offices to invest. So there has been a slowdown, but not for everybody.
Has been a little bit of a slowdown, but not for everybody. But Padmaja, let me bring you into the conversation, right? The release says that the fund will back founders solving real problems aligned to India's national strategic imperatives. If you could sort of, unpack what strategic imperatives means in practice and how they sort of influence sector selection.
So thank you for having me on the show. I think what the world is today is becoming very unipolar, increasingly. And as each country sort of starts building, we have to create self-dependence. And this is what the government is also sort of pushing for. So some of the strategic imperatives or real problems that India faces today is its own foundational technologies like semiconductor, biotech, where we are looking at genes, we're looking at pharma, whether it's defense tech startups. All of these are of national strategic imperatives. On the other hand, we do have real problems, not only for this country, but around the world, like water, sanitation, agri-tech. All of these need innovative solutions. So what we are trying to do at IAN through the Alpha Fund and otherwise is we are trying to really look at companies like Morphing Machines, which is in semiconductor, or if you're looking at Endure, which is defense tech startup, or FluxGen, which is helping on the waterfront. That's what we're trying to do as we build this fund and breed companies, breed innovation.
Got that, Padmaja? If you could give us a few more specifics. So far, the fund has already invested in about 12 startups. What does the pipeline look like, and what are the technologies or business models that are emerging as priorities for you as you look at making these investments?
That's a very good question. I think what we are trying to do is, first of all, create a very risk-mitigated portfolio, right, as we build this fund portfolio. Because what is also important is returns. So we have done a lot of investments on the defense tech, on semiconductor, etc. We're now looking at agri-tech, AI, some of the biotech companies which are already starting to commercialize and start building revenues. So while we still stick with the vision and the mission of solving real problems and national strategic imperatives, we are picking up companies with business models or stages in its life cycle where it has progressed a little bit more. This ensures that, while there is research and science and technology still getting developed or getting closer to commercialization, we also have companies that are now looking at revenues and next round fundraise. So it's a mix of both short-term and long gestation, but we've sort of focused more on saying how do we risk mitigate across sectors, across tier 2, tier 3, across different diverse solutions, both for India, and then if it works for India, it will work somewhere else in the world for sure.
Sure. And, Saurabh, so how do you evaluate your potential portfolio companies' innovation with commercial clarity, especially in high-risk sectors like semiconductors or space tech?
See, in many of the high-risk sectors, firstly, every investment you made on a founder who may not have ever done a company before carries a risk. But when you look at these deep tech areas, then one of the things we do is we look at companies that are already at what you would call a TRL4, which means there is some validation of the technology. So we know it's real. Now what we're looking at is, can they scale it? Can they get to manufacture? Can they find a market within India and outside? And so one of the things we do look at is, even in the technology companies, do they have a market in India? And that's one of the reasons when you look at whether it's semiconductors, whether it's space, whether it's cybersecurity, certainly in defense, not just drones, but also propulsion engines, many other areas. We know there's a huge market in India. They can scale to a large extent in India. That cuts down some of the risks in deep tech. And if they can scale in India, then many of them are really at the frontier level. They can go overseas. They can scale globally. So while it looks like deep tech is risky, it depends on how you approach it, how you analyze it, and it does not need to be any more risky than many of the other ventures that you do. And because of what has happened in this whole area in the last, I would say, 2 years, 3 years, where the government has pretty much recognized that we need the technology sovereignty is the same as national sovereignty. There's a lot of funding, investment, markets, encouragement, all of those things are coming in from different sides of government. So it helps us take some of the deep tech bets, both Indian market, global market. Sorry.
Yeah. That said, it is a tough call, and that's where your expertise does come in. These are new technologies we're talking about, and you're looking at the company and the market fit and the ability to scale. But what are the qualities you also look for, specific qualities in founders as well? Are you looking at repeat founders, for instance? Are you looking for specific qualities that are green flags?
Yes. In fact, if there are 10 things you look at in a startup, at least 5 are just the founders. It's the most important element. So you're looking at the founders. A, their passion, their commitment, their level of understanding and knowledge of the technology. Do the founders have a complete team? So they need the technology side, but do they have a business side as well? Do they have somebody who understands sales and marketing? If they have done a venture before, any one of them, that's a plus. But that doesn't always happen. That's okay. You're looking at what else have they done before. They may have worked in a company, they may have worked in a startup, in a CXO, whatever. You're looking at their level of understanding and competence in the area that they have chosen. You are looking at how deeply have they researched that area. Have they looked at competition? Have they looked at how they will get to market? So you're looking at overall, how solid is their thinking? Can they take this to scale? You're looking at founders who have to be exceptional, who really want to build at least $1 billion company and are willing to put in the time and the effort and bring in the people they need to complete the team. There are companies that have dozens of PhDs they've recruited. There are companies that actually have looked at bringing in founders that cover the competencies that they don't have. So these are founders that understand the issues and the risk. So these are the founders to back.
Sure. So one of the key things that you do look for is what the founder can bring to the company. But Padmaja, can you walk us through the typical check size range for the Alpha Fund? And also, how are you sort of structuring these checks across segments? For instance, are you sort of writing smaller exploratory bets in frontier tech and larger and more commercial sectors?
So it's a very good question, actually. So what we're looking at is to invest almost the first institutional round in the companies. So we come in with about 2 million, which is about 15 to 17 crores. And then if the company progresses well, we are open to actually top it up with another million, which is about 8 to 9 crores. So typically we would have invested 23 to 25 crores in the company. That's number one. Number two, I think what the way we are structuring these investments is to actually tranche them. So what happens is that the companies get money on the go, but they keep performing, and then the fund is also risk mitigated. More importantly, we are able to bring in the right co-investors, people who are funds or investors who understand the space better or who are deep-pocketed, so that the companies have a good cash runway. And finally, I think what we do look for in companies when we invest is how we can actually help the companies grow. We sit on the board, we take a board seat, we have some strategic rights, and that helps the company. We come in with a perspective that we can help the company to grow. The companies based on these startups which are based on science and tech, they do need a little help on the business side. And I think that's what we try and bring with our global both Indian and global networks. So it's really a kind of a partnership which is a coach and captain partnership, not very intrusive. So that's how we sort of structure our investments.
A coach and captain partnership, very well way to put it, Padmaja. But Saurabh, let me try and ask you this another way. Do policy priorities drive your investment decisions, or are you sticking purely to commercial logic, given the push from the government as well?
The policy priorities and commercial logic do intersect. So, 3 years ago, how many drone companies existed? Today, there are maybe 1,000. Right? Before the government changed policy, there were just a handful of space startups. We're just talking 3-4 years ago. Now there are a few hundred. So policy and the commercial side do go hand in hand because there is an enablement. Defense, for example, this program they have, which is called IDEX. It actually gives orders to companies. So in our case, we are looking at areas which will have a big market in India. There is a need. The government is also backing. I'm talking of areas like defense, for instance, okay, or space. All of these will have a market outside, but they'll be able to cut their teeth within India. When we invest, we are a fund which has to give returns to investors. So the commercial viability, the returns we can give are absolutely at the center of our decision. But what I was saying is that these are not two streams that don't actually connect. If they do not connect and there is no commercial viability, then it would be difficult for us to make an investment. But like Padmaja was saying, very often we are able to help companies actually get a market, get into networks, get into areas where they may not otherwise have managed, and make them a success. So many of the deep tech areas, we're playing that role, whether it's in space or semiconductor, drug discovery, cybersecurity, many of these areas.
Absolutely. Padmaja, Saurabh, just hang on. We need to take a very short break, but we'll continue to decode IIN's latest fund and find out what's in store for the startup ecosystem in 2026. Stay tuned for that. Welcome back. You're still with us on Startup Street, and still on the show with us is Padmaja Ruparel and Saurabh Srivastava, the co-founders of IIN Group. Saurabh, to pick up from where we left off, from an investor's return point of view for the Alpha Fund, what kind of returns are investors realistically expecting over the next 5 to 7 years, particularly for deep tech versus, shorter cycle ventures?
Well, investors typically, when they invest in a fund, are looking to get a certain rate of return. And that rate of return is generally better than 35% IRR. That's what they would like. And whatever we do, we need to make sure that that's the return that we give them. And that has not changed before, it's not changing now. What does happen when we do deep tech investments? Possible there may be more failures, but the successes will be huge and they will more than underwrite those failures. And you did ask me a question earlier on policy versus economics. See, one of the things that happens, take policy. The government has now created this 1 lakh crore Research, Development and Innovation Fund, which will only invest in deep tech companies in the private sector. So now we know, as IAN and all the other VC funds and all the investors know, that the government is also ready to write checks to deep tech companies. So the pool of capital, risk capital, available for deep tech has suddenly dramatically gone up. That reduces the risk for all deep tech investors because there is more capital available.
Sure.
For the next round to take them to scale, which was a big challenge earlier. And that's why you are seeing two things. A, people like us are doing very serious deep tech investing. And B, some of the best and the brightest brains in the country are actually swiveling from vanilla venture they may have done, actually going into deep tech. People are leaving very secure, very positions in companies that are doing exceedingly high level work. They are finding the gaps.
Yeah.
And they're moving out and creating ventures. So there's a lot of change that's happening.
Sure. Sure. Take your point, Saurabh. There's no dearth of capital. But what is the expected return for investors very quickly in a word or so?
Well, investors who invest in a VC fund, like I said, would expect that over the life of the period that you have their money, that you're going to give them a rate of return on their capital, which is in excess of 30-35%. So it's much better than being in public markets.
Got that.
And if you do well, then you can do more. And so they're also looking at getting 3 to 5 times their capital back, which they think would be good. If you return more than that, they're more than happy.
Okay, sure. That's something to write home about. But Padmaja, very quickly, we're running out of time. If you zoom out and look at subsectors within deep tech, what are the areas where India is catching up versus globally? And, are we building real solutions for export or just solving domestic problems with technology at the moment?
No, it's a very good question because India does have its own problems to solve. So I see where you're coming from. But I think India today has got talent, just to take off from what Mr. Srivastava was saying, very high quality global talent, which is building from India, for India and for the world. And if you look at sectors like semiconductor, you look at sectors like robotics, all of these are solving not only Indian problems, but they are solving global problems. These proposition solutions are actually being made for global markets, many of them. Secondly, I think if you look at sectors in pharma and biotech, they are catching up with the global standards, what's happening in the globe, but they are solving for India. So I think they're both foundational technology, which is getting built for India, as well as solving global problems. We do have some advantages, as you know. We have some price advantages, which we are being able to leverage. So these innovations, deep tech kind of solutions based on science and technology, married with better pricing, is really creating a very attractive proposition in the globe. So I think that these are the few sectors and subsectors where we are really building. For instance, space. There's a company we have called Dhruva Space. It is catering to ISRO and the Indian space market. But it recently had a customer where it launched satellites through SpaceX.
Sure.
So I think it's a mix, to be honest, both for India and the globe.
So it's a mix right now. We're running out of time. Padmaja, in 30 seconds, looking ahead to 2026, what broader investment themes or trends do you sort of expect to dominate India's early stage and deep tech landscape? And where should investors and entrepreneurs sort of be placing their bets?
I think, this year has been pretty seminal, 2025, right? The RDI fund has given one clear direction that there is deep tech, science and technology-based ventures, which is going to be a trend to follow. I think the second trend that I think is very interesting, that while there is investing happening, young startup companies are being able to unlock non-dilutive capital. And I think that's very important because unless you get that non-dilutive capital, companies will really founders will dilute quite dramatically. So if you look at SIDBI and if you look at PPP and all these, this is solving, sort of unlocking that, and it's a trend that we should see more. The third piece is, I think, as companies grow, the IPO market should also open up. So I think there's several swivels happening, and I think 26 will be interesting.
Okay. Sorry to interrupt you, Padmaja, but we've run out of time. Saurabh, in 10 seconds, as an investor, what excites you the most about 2026?
What excites me the most is that we are finally going to see in 2026, it's already started, Indian companies building leading edge, first in the world, best in the world, global tech companies. And they will be able to do it because their cost of getting up to a certain technology level, TRL4, is a fraction of companies in the US. The talent is as much here as anywhere else. If you look at many of the areas, a third of all the chip design talent is in India. So we have the people, we now have the ambition, and we also now have the capital. So 2026, to my mind, will change the narrative for Indian tech and Indian startups dramatically.
So it'll change the 2026
at an inflection point, because the world is at an inflection point where most technologies are going to change. AI is not the only game in town. Most things are going to change. And this is the right place for our flowering and our boom to happen. So
Absolutely.
we're seeing the perfect storm.
So we are at an inflection point, and it is a perfect storm. All right, Padmaja, Saurabh, thank you so much for joining us on the show and outlining India's deep tech ecosystem and what we can expect next year.
All right, with that, it's a wrap on this edition of Startup Street. Before we leave, here's wishing all of our viewers a very happy and prosperous New Year. From Arundhati and me, goodbye. Thanks for watching.
Hello and welcome to Rewind 2025. I'm Shireen Bhan. Tariffs and uncertainty over trade deals ensured that volatility was the only constant in global trade in 2025. And for India and Indian businesses, a source of significant heartburn. Abhimanyu Sharma reports that while the government fought to keep trade on an even keel and find new markets, a cheaper rupee has been one of the only comforts for exporters. And 2026 is likely to see much of the same unless the government effects a breakthrough in the India-US trade talks. Take a look.
2025 started with the prospect of India striking lucrative trade deals with many nations across the world, including the United States. The ongoing Russia-Ukraine war, the Israel-Gaza conflict, sanctions on Russia, along with geopolitical tensions in the Red Sea, pushed up freight costs for exporters. Despite uncertainties, India's total merchandise and services exports in FY25 hit an all-time high of $825.25 billion, a growth of 6.05% year-on-year from FY24's levels. But US President Donald Trump threw a spanner in the works, imposing tariffs on imports based on product and country of origin. In the second week of April, he announced global tariffs with a baseline of 10% across all imports and reciprocal tariffs on some countries, including a 26% tariff on India.
We get along with India very well, but India has, you have to understand, for many years it was a one-sided relationship. India was charging us tremendous tariffs, about the highest in the world. They were about the highest in the world. You know, everything they made, they'd send it in, pour it into our country. Therefore, it wouldn't be made here, which is a negative. But we would not send in anything because they were charging us 100% tariffs. And
a breather came soon after. Reciprocal tariffs were paused for a period of 90 days, even as talks for a bilateral trade agreement continued. Indian negotiators met with their American counterparts numerous times, even in person, and talk of a trade deal remained a low but steady hum. Then came the big jolt. On the 27th of August, President Trump blamed India for funding the Russian war on Ukraine by continuing to buy Russian oil. He hiked tariffs on India to 50%. India pushed back.
Somebody tells me tomorrow I can't be friends with the European Union. I won't accept that. Or somebody tells me tomorrow I can't work with Kenya. It's not acceptable to me. So I think we are all in it together. The decision whether to buy a particular product from a country is something that the entire world will have to take a call on.
As India and the US continued to engage with each other in a bid to arrive at a mutually agreeable and beneficial trade deal, India managed to conclude negotiations on some significant bilateral free trade agreements. It signed an FTA with the UK in July, though that is yet to come into effect. The government has also facilitated the opening up of a few new markets for Indian exporters, including Switzerland, Norway, Iceland and Liechtenstein, as the FTA with the European Free Trade Association came into effect in October, and the European Union approved imports from 102 fisheries establishments. In December, India and Oman completed negotiations for a comprehensive economic partnership agreement, under which Oman will provide India duty-free access to 98.08% of its tariff lines. This covers 99.38% of what India exports to Oman. More recently, India concluded negotiations for an FTA with New Zealand. While these came later, Indian exports still stood on firm, albeit fragile ground. In the first half of the FY26, India's exports rose 5.86%, led by a 9.34% rise in services exports and a 2.90% rise in merchandise exports. This was driven by electronic goods, engineering goods, drugs and pharmaceuticals, marine products, and rice, with Spain, Hong Kong, China, and the UAE proving to be strong markets. Though India's exports to the US also rose 13% year-on-year in the first half of the financial year, this included a lot of front-loading of exports as traders tried to beat the window before higher tariffs kicked in. But the brunt of higher US tariffs is being felt, especially in the export of labor-intensive areas like textiles and leather, which have a high dependence on the American market. And while talks continue, there is no definitive headway yet.
I've said many times that all agreements, all discussions have many diverse, many different angles. Many dots have to be connected, and we never negotiate deals with deadlines.
To mitigate the hit from US tariff disruptions, the government also looked for other supportive measures. The Export Credit Guarantee Corporation upgraded the country ratings of 24 nations in September, reducing insurance costs and overexposure to markets affected by tariffs, protectionist policies, or restrictive market access. The fall in the rupee's value against the dollar also gave exporters some cushion, as did a mammoth GST rate rationalization exercise that gave producers more traction in the domestic market. The recently announced export promotion mission, which aims to provide exporters with financial incentives in their quest for newer markets, is also designed to help.
भारत के किसान, भारत के मछुआरे, भारत के पशुपालक, उनसे जुड़ी किसी भी अहितकारी नीति के आगे मोदी दीवार बन के खड़ा है.
As 2026 dawns, talks for a trade deal with the US are still underway. Buzz of it being imminent crops up periodically, but as people say, nothing's certain till the dotted line is signed.
Right now, we are engaged with not only negotiating a bilateral trade agreement, which definitely with a country like United States will take a lot of time, because trade agreements are very wide-ranging agreements these days with a lot of issues, not only market access issues, which are negotiated under the umbrella. But at the same time, we are also engaged in a protracted negotiations on a framework trade deal, which will try to address the reciprocal tariff challenge that the Indian exporters today face. So these are two separate parallel negotiations going on.
India is also engaged in negotiations with the 27-member European Union, the Russia-led Eurasian Economic Union, the 5-member Brazil-led Mercosur bloc, Chile, Peru, and Maldives. Terms of reference have also been finalized for trade deals with Israel, Qatar, and the 6-member Gulf Cooperation Council. In addition, an FTA review is underway with the ASEAN bloc, and expanded FTAs are being considered with Australia and the UAE. None of these may materialize overnight. But as each of these fructify over the next 12 months, Indian exporters can expect some relief. The biggest relief, however, will come only when India and the US are able to agree on terms that both leaders find palatable. In New Delhi, this is Abhimanyu Sharma for CNBC TV18.
Well, will 2026 be the year that we see a breakthrough in the India-US talks that have been underway pretty much through 2025? That's the big question. Now, 2025 was also the year rare earths moved from the margins to the center of global power. Export curbs, supply shocks, manufacturing disruptions all turned these minerals into strategic assets and forced countries, including India, to rethink how to secure their supply chains. Shivani Bajaj puts a spotlight on the year that made rare earth magnets really rare.
If there's one lesson global markets learnt in 2025, it is this: the country that controls supply chains holds the power. Driving home this lesson were rare earth minerals, a small group of elements that quietly rewrote the rules of geopolitics, manufacturing, and energy security in 2025. The turning point came in April. China tightened exports licensing on rare earth elements. These elements are crucial for a host of manufacturing activities, from EVs to electronics to military equipments to renewable energy to a range of industrial processes. By October, those controls were expanded further to include magnets and even processing technology. But the impact was visible in April itself. Exports slowed, uncertainty crept into supply chains, and global manufacturing, from cars to clean energy, was suddenly left exposed. This wasn't about running out of minerals, it was about who controlled access to them. Now, that's because while rare earths may be a group of 17 critical elements and global production stood at around 196,000 tons in 2025, valued at around $12 to $15 billion, the industries these elements supported were collectively valued at a whopping $7 trillion globally. In number terms, one electric vehicle needs about 1 to 2 kgs of rare earth magnets. One offshore wind turbine can use anywhere between 600 to 2,000 kilograms, and a single fighter jet uses more than 400 kilograms across systems and sensors. So in effect, without rare earths, motors don't run, and modern technology stalls. In addition, there are very few alternatives to rare earths at scale. So China's move was a masterstroke of sorts, and it caught the world flat-footed because China mines around 70% of rare earths globally and controls 85 to 90% of refining and processing and produces over 90% of the world's permanent magnets. This means that even if rare earths are mined outside China, they often still depend on Chinese processing to be useful. All this makes the supply chains extremely fragile and ripe to be weaponized. Factory floors went into chaos. Global EV sales, for instance, took a hit. Magnet shortage led to cost pressures and production risks. In India, Maruti Suzuki cut its EV production target sharply to around 8,000 units from earlier 26,000 units. This disruption was real. For their use in defense manufacturing, rare earths were firmly classified as strategic minerals, and NATO countries started increasing their stockpiles. Adding to the chaos was the market-driven surge in prices of many of these elements. One striking example is the price of yttrium jumped more than 4,000% during the period of supply stress. And so started a global scramble for rare earths, with almost every country and government entering the race. The US and its allies committed billions of dollars to build non-China refining capacity. The European Union, under its Critical Raw Materials Act, set a target to process 40% of its needs domestically. And Japan pushed long-term supply contracts and recycling. As a result, over 300 million tons of rare earth resources have now been identified outside China. Over 146 projects are already under development to extract and make these elements ready for use. But there's also a reality that none of this will happen overnight, or even in a handful of years. India also found itself at a sticky wicket with Chinese weaponizing rare earths. We import nearly 100% of the rare earth magnets, despite being home to about 6% of the global reserves. India's manufacturing push, on which the government has based the big portion of its plans for Viksit Bharat, was suddenly vulnerable. The government responded with a 7,280 crore rupee scheme aimed at building domestic magnet capacity of around 6,000 tons per year. This was aimed at not only reducing its dependence on China for these elements, but also eventually providing the world with an alternative supplier. As 2026 begins, the global race for rare earths is going to get crazier and well more intense. Global demand for rare earth is expected to grow by around 700% by 2040, driven by energy transition, the global semiconductor push, and the drive for defense and space supremacy. With stakes so high, rare earth minerals are no longer just commodities. They're strategic assets, they're global bargaining chips, they're carrots and they're sticks. And in this evolving new world order, those that dominate supply chains can dictate terms. And everyone wants in on that security that it offers. Back to you.
Well, the race for rare earths dominating headlines in 2025. Will India's PLI scheme spur local manufacturing? That's the big question. Up next on Rewind 2025, how will the economy shape up in next year? An exclusive CNBC TV18 poll right after this short break. Stay tuned. You're watching Rewind 2025. We're recapping the year that was, and we're also looking ahead into what sectors will be the outliers for 2026. Let's talk about metals. Aluminum prices saw a sharp rise this year, driven by supply constraints as well as energy costs. China accounts for nearly 60% of global aluminum production, but the output growth in China was just over 2% this year, leaving many to predict a further rise in prices in the new year. So what does 2026 have in store for aluminum? Nigel is standing by with the answers. Nigel.
Well, that's right. Aluminium prices are ending 2025 close to the highs that we have seen this year. So the big question is, does aluminium have more steam left for the next few years? The answer could probably be yes, because there are two factors at play. One is demand is rising and supply is tight. Let's focus on demand first up. Aluminium demand is moving towards a structural story as electronic vehicles use a lot more aluminium than traditional petrol or diesel vehicles. Solar renewable energy projects, well, they are aluminium heavy, and global grid expansion as well as electrification are only accelerating. Put it all together, aluminium demand is estimated to grow at around 2.5% per annum for the next many years. The booster shot is supply growth isn't keeping up. The global aluminium inventories are sitting at multi-year lows. The LME aluminium stocks, well, they are down by roughly around 20% on a year-on-year basis for the past month. China, the world's biggest producer, is already running at around 97% capacity utilization. Production growth in 2025 has been just around 2.5%. And China's capacity is capped. So you'll ask, what about outside China? Well, things ain't easy out there as well. Aluminium smelters, well, they are competing with AI data centers for electricity. The US, Europe, and Africa, all of them are struggling to lock in longer-term power contracts, which means fresh supply of aluminium could probably be hard to come by. Just to highlight a few examples with regard to the power issues. Century Aluminium Smelter in Iceland, well, it faced a partial shutdown in late 2025. That's in late October 2025. While Mozal Aluminium Smelter in Mozambique, that's set to be placed on care and maintenance from March 2026 because the smelter was unable to secure an electricity supply agreement. NALCO joined us here on CNBC TV18 and they said that they expect aluminium to stay in deficit for the next 2 years. On the cost side, aluminium cost curve is hovering around $2,400 per ton for nearly 90% of the producers. Now, in a deficit market like this, prices usually stay well above this cost curve. Let's wind it down then with the valuations of the listed plays. Listed aluminium plays, that is. Hindalco, well, they benefit from higher LME prices through its Indian operations. Though the near term, well, they'll see cash flows which will get impacted because of Novelis's Oswego unit, which was impacted by a fire. NALCO, well, they have soft alumina prices for now, but they'll benefit from stronger aluminium prices. And Vedanta's aluminium business, well, it contributes most of their EBITDA and stands to gain because capacity additions are coming on stream and they are also working on lower coal as well as bauxite costs via sourcing most of their raw material from captive sources. Bottom line, with demand structurally rising, supply constrained, aluminium could remain firmer for longer. That's the hope at least.
Well, the aluminum rally likely to continue. Nigel, many thanks. As 2025 draws to a close, what's in store for the economy? Lata is here with the key indicators for what we should be watching out for and an exclusive CNBC TV18 poll on what economists are penciling in for the new year. Lata.
The RBI Governor Malhotra recently described India's economy as being in a Goldilocks scenario, where growth is coming in higher than the long-term trend and inflation is lower than the long-term average. For 2026, economists polled by CNBC TV18 expect this Goldilocks scenario to continue, albeit with lesser intensity than in 2025. Our poll shows the economy is expected to grow by 6.8% over 7.5% this year. But this is the average. 50% of the economists had forecast above 7% for next year, while 50% stood at just 6.5%. The 7% club see growth from rising consumption due to GST and income tax cuts and falling interest rates, and green shoots in capex in sectors like power and real estate. The 6.5% GDP club disagree with the private capex upcycle assumption. They see consumption as good, but not good enough to trigger massive capex. They also see growth slowing due to a weaker pace of government capex and still subdued private capex due to the global uncertainty. Respondents also see India's nominal GDP, that is output calculated at current prices without adjusting for price rise, at 9.7% next year, far better than the 8.3% this year. But here again, 50% see nominal GDP below 9.5%, which is, compared to previous decade of India's nominal GDP average at over 11%. Now, coming to CPI inflation. The poll sees it rise to 4% next year from the unusually low 1.9% this year. Here again, it's a divided house, with 50% expecting a continued benign 3.8% CPI, while the other half see CPI between 4 and 4.5%. All economists expect consumption to grow better than investment, with public capex slowing and private capex still diffident. The government is expected to reduce its fiscal deficit to 4.3% from 4.4%, in keeping with the long-term promise to lower deficit. But with the presentation of the 16th Finance Commission report, government may start targeting overall debt to GDP rather than fiscal deficit. There will be pressure to bring it down, that is debt to GDP down towards 80% from around 84% currently. However, of maximum interest is how much money will the centre and states plan to raise via bonds and state development loans. Our poll said this number would be at least 30 trillion rupees, up nearly 8.5% from this year's 27.7 trillion. Demand for government bonds may be much less next year than this asking amount. Hence, most people expect RBI to continue to buy bonds via OMOs or open market operations. Yet, the 10-year yield is seen slightly higher next year than this year. That is, the cost of capital is not falling. Now, the bigger talking point is India's external account. Like this year, the current account deficit will be modest next year as well at 1.06% of GDP. Now, current account refers to imports, exports, remittances, and monthly transfers by Indians living abroad to their families here. Now, here the deficit has lately fallen because of very good services exports, the GCC exports. The worry has been the capital account, with FPIs, that's foreign funds, shipping out $15 billion in 2024 and $17 billion in 2025. Making the overall balance of payments negative at $5 billion last year and likely $22 billion this year. India cannot continuously keep shipping out dollars from our reserves kitty. Our poll says next year the outflows trend will end and we will see an inflow of $7 to $8 billion. Again, this is the average. Many economists see a $20 billion inflow, but some others see continued outflows or a very measly $1 billion inflow. It is these continuous outflows by FPIs and foreign direct investment that pressured the Indian rupee in 2025, making it depreciate nearly 6% versus the dollar. Our poll says economists expect the rupee to end the current year at 90.4 and lose just a nominal 2% next year, that's FY27, to end at 92 rupees per dollar. Finally, here come the googlies. Most of the numbers won't hold if the trade deal is not signed with the US sometime in 2026. In any case, the numbers will need to be tweaked as early in February when the Ministry of Statistics will reveal a new GDP and a CPI series with a fresh base of 2022 and 2024. So all numbers will need to be recast.
Well, plenty of numbers to watch out for, starting, of course, with the big budget. And we still don't know whether the budget is going to be on the 1st, which happens to be a Sunday, or there's going to be a change. Latha, many thanks for joining us. That's it then on this edition of Rewind 2025 as we recapped the year that was for India. Here's wishing all our viewers a very Merry Christmas, a Happy New Year. Stay tuned to CNBC TV18. We will continue to bring you information that you can use in the new year. From all of us here for now, goodbye and thanks for watching. Hello and welcome to Rewind 2025. I'm Shireen Bhan. Now, this has been a productive year for the government. In all, 28 bills were introduced in Parliament, ranging from a new employment guarantee scheme for rural India to tweaking the rules for foreign direct investment in insurance to laws revising the duties applicable on tobacco. Sapna Das looks back at some of the key laws that were aimed at keeping the reform agenda going and reports that 2026 is likely to see this exercise being taken forward. Take a look.
2025's winter session of Parliament has probably been one of the most productive in recent history. Lok Sabha saw productivity at 111% and Rajya Sabha 121%. In just 19 days of the session, 5 new bills became law, while 1 more bill was referred to a parliamentary panel. Of these 6, at least 3 are reform-oriented, the Nuclear Energy Bill, the Bill to amend insurance laws, and the Securities Markets Code. The laws supporting the overhaul of the Goods and Services Tax were also passed in this session. And then there was a new Rural Employment Guarantee Scheme which caused quite a stir in the House. The bill goes beyond amending the 20-year-old UPA-era flagship Manrega of 2005. The new bill increases the guarantee of employment to rural households from 100 days to 125 days in a year. However, it shifts a portion of the cost onto state governments, 40% against the earlier 0%. Cosmetically, the government has changed the name of the scheme by dropping Mahatma Gandhi's name from it. None of this sat well with the opposition or experts.
हर योजना का नाम बदलने की जो सनक है ये समझ में नहीं आती है सर जब ये किया जाता है तो सरकार केंद्र को पैसे खर्चने पड़ते हैं बिना इस सदन की सलाह लिए इस तरह से जल्दी में विधायक को पास नहीं होना चाहिए सर ये विधेयक वापस लिया जाना चाहिए
The G bill, which says that 60% for most of the country, barring northeastern states and hill states and union territories, the new bill says that 40% of the money will have to come, even for labor component, from the states. Now, there is no reason that the states may want to do this. And in fact, in trying to bring the 60 and 40 together, most parts of the country, the sufferer will be the worker who during every time of economic distress, and those distressed workers who find themselves looking for alternative employment will be unable to get any kind of guarantee. As it is, it's been very difficult because of lack of allocation.
But the government stood firm.
पता नहीं क्यों राम जी नाम आ गया तो ये भड़क गए महात्मा गांधी स्वयं राम राज्य की स्थापना की बात करते थे और उनके अंतिम शब्द भी हे राम थे.
And the bill was pushed through with just 5 hours notice.
जो सदस्य जिसके पक्ष में आ गए, जो सदस्य विरोध में ना गए, मेरे विचार में निर्णय हाँ वालों के पक्षवा विधेयक पर विचार करने के प्रस्ताव को स्वीकृत किया.
The other big ticket change came in the foreign direct investment rules. This was driven by 2 bills. The Sabka Bima, Sabki Raksha Amendment of Insurance Laws Bill 2025 and the Sustainable Harnessing and Advancement of Nuclear Energy for Transforming India Bill 2025. The Shanti Bill allows up to 49% FDI in the nuclear energy sector. It also allows private players through joint ventures to build, own and operate nuclear plants while the government retains control over core functions. The amendments to the insurance law now permit 100% direct investment by insurance majors. Now realistically, while only 4 of the 74 players in the insurance space are at 74% FDI, the government views allowing 100% FDI as an enabler for global majors to set up shop without shopping for an Indian partner.
We have heard a lot of these FDI people who want to come into this country searching for a partner, joint venture partner. It's a mammoth effort. Now, by doing this, we are able to bring them to the country directly, of course, with all the Indian laws which are passed by this parliament.
Market regulator SEBI not only got a new chairman in Tuin Kanta Pandey in 2025, it also got in line for sharper legal teeth. The centre tabled the Securities Market Code Bill to strengthen investor protection, shore up the SEBI board, and improve overall regulatory governance. Some of the specifics include SEBI setting aside 25% of its annual surplus in a reserve fund, while the residual surplus is transferred to the centre. The code also mandates that SEBI investigations close within 180 days and that no investigation can be taken up against a default or contravention after expiry of 8 years except in specific circumstances. The bill is being right now examined by the Standing Committee on Finance. But the surprise this year came for India's growing workforce, including gig workers. The centre rolled out the 4 labour codes effective the 21st of November. Key features include mandatory issuance of appointment letters for all workers, making minimum wages a statutory right, cutting the period for eligibility for gratuity for fixed-term employees to 1 year, and double wages for overtime. The frenetic activity in the winter session has made 2025 a highly productive year for the government. But the government's reforms agenda is far from complete. 2026 will see it not only taking up pending bills that have been sent to select and standing committees, but pushing to implement the laws passed in 2025, like the new Rural Employment Guarantee Law. In New Delhi, Sapna Das.
And of course, 2026 will start with the budget session and the presentation of the budget, courtesy Finance Minister Nirmala Sitharaman. Well, the year 2025 marked a defining moment in India's fight against terrorism. After a horrific terror attack in Kashmir's Pahalgam, India responded with resolve, precision and restraint. On Rewind 2025, Santiagora reports how India made clear its zero-tolerance policy towards terrorism through one of its most decisive operations, Operation Sindoor.
On the 22nd of April, 4 men the Indian authorities later identified as Pakistan-backed terrorists killed 26 tourists in Kashmir's Pahalgam. The massacre shocked the nation. On the 7th of May, India retaliated with Operation Sindoor, a precise, restrained and non-escalatory strike on terror infrastructure in Pakistan and Pakistan-occupied Kashmir.
इस कार्रवाई में 9 टेररिस्ट कैंप्स को टारगेट किया गया और पूरी तरह से इसे बर्बाद किया गया.
The terror bases were identified as belonging to Lashkar-e-Taiba and Jaish-e-Mohammed. 5 of these were in Pak-occupied Kashmir and 4 were in Pakistan, including base camps located in Muridke and Bahawalpur. Among them was Markaz Taiba in Muridke, where intelligence said all the terrorists involved in the 26/11 Mumbai attacks were trained. The government says the exercise resulted in the death of around 100 terrorists. Despite India's restraint, Pakistan escalated the situation. It targeted civilian and military installations along India's border with drones and shelling. Amritsar, the Poonch sector, and border areas in Rajasthan were a few of the regions that came under attack. India struck back.
Following these relentless attacks on our air bases, on our forward positions, and on our civilian targets, this was time to convey some message to our adversaries. And therefore, a decision was taken to strike where it would hurt.
India's counter-offensive struck 11 Pakistani military establishments, including Noor Khan, Sargodha, Bulari and Skardu, destroying ammunition depots and crippling key air bases. The Indian government claims the strikes destroyed nearly 20% of the Pakistani Air Force's infrastructure. The Indian Navy also remained fully prepared. Less than 3 days later, on the 10th of May, Pakistan sought a ceasefire.
The offensive deployment and posturing of the Navy also included a series of successful weapon firings in April and forced the Pakistani Navy to remain close to its own coast. In fact, the threat of offensive action by the Indian Navy could be considered one of the important factors in Pakistan requesting for a ceasefire.
But reports of ceasefire violations by Pakistan's ground troops kept coming in. India made it clear that any further breach would invite fierce retaliation. Parallelly, India also took diplomatic steps to get Pakistan to cease and desist. The Indus Water Treaty was terminated, the Atari-Wagha border was shut, and bilateral trade was suspended. While the Director Generals of Military Operations of India and Pakistan spoke to each other on firming up the terms of the ceasefire, US President Donald Trump claimed he had stopped the war, something he has repeated multiple times since.
The Prime Minister of Pakistan called me. Thank you very much. He actually said, President Trump saved millions and millions of lives. And I got a call from Prime Minister Modi saying, we're done. I said, you're done with what? We're not going to go to war. I said, thank you very much. Let's make a deal.
This is a claim India has categorically denied multiple times. It also maintains that the ceasefire decision was a bilateral one driven solely by military and strategic considerations and that Pakistan called for it. India has also countered Pakistan's misinformation campaign, debunking false narratives in real time. For instance, Pakistan claimed victory in the standoff, saying it shot down 6 aircraft of the Indian Air Force. India has refuted both these claims. To reinforce its zero-tolerance policy towards terrorism, India sent 7 all-party delegations worldwide to convey a unified message against terrorism. The trading of fire may be in abeyance, but tensions are not. Pakistani airspace, which was close to Indian aircraft when Operation Sindoor was carried out, remains shut to this day. So too, Indian airspace to Pakistani aircraft. The Indus Water Treaty remains suspended despite Pakistan protesting the move in international fora.
Well, one of the most significant moments of 2025, Operation Sindoor. Up next on the show, real estate investment trusts are ready for takeoff after a landmark year. More on REITs in 2025 when we return. Well, 2025 was a pivotal year for the cement industry, which saw significant consolidation, but growth in demand could not keep pace with the expansion in capacity. Will 2026 bring good tidings for the cement industry? Nigel is here to find out. Nigel.
2026 could be a crucial year for the cement sector. The big question is whether the early green shoots in demand will strengthen or they'll fade away. Well, cement demand remained weak during October and November 2025, and growth during these 2 months was roughly around 6 to around 6.5% on a year-on-year basis. This compares with around 5.5 to around 6% growth that we saw in the first half of the fiscal. The slowdown was driven by 3 big factors. First, the sluggish government capital expenditure. Second, labour migration linked to the Bihar elections. And third, there were curbs on construction activity, particularly in the NCR region, due to the pollution-related restrictions. Birla Corp spoke to us here on CNBC TV18, and they said that while demand was sluggish in October and November, early signs of improvement have started to emerge in December. The street is hopeful that demand will see an uptick in the fourth quarter of this fiscal that could be supported by higher government spending. Well, there was some pricing discipline and prices remained resilient between April to August 2025. However, the average pan-India prices declined by around 2 to around 2.5% in October as well as November. That compares with the average pricing that we saw in the second quarter of the fiscal. The impact was sharper in the non-trade segment, with prices falling by roughly around 15 to around 20 rupees per bag across regions, while trade pricing was softer by close to around 5 rupees per bag. The question now is whether a meaningful price hike can only be absorbed post the quarter 4 FY26. Well, consolidation in the sector appears to be largely behind us. The top 5 players account for around 62% of the industry, up from around 51% in 2020, and the share could rise to around 65% by 2028. However, the challenge is that the recently acquired assets are getting ramped up, which could lead to additional supply. In fact, the supply risk continues as capacity additions are expected to grow at a CAGR of around 7.5% to around 8%, while demand growth could be in the vicinity of around 6.5% to around 7%. This suggests that utilization levels will stay sub 70% for a prolonged period. And as large players continue to chase market share, mid-cap regional players may face greater pressure on pricing as well as on profitability. According to DAM Capital, large cement players are better positioned due to their diversified regional presence, the ability to gain market share without significantly affecting their profitability, and capacity to sustain capex momentum. They expect competitive intensity to remain elevated, benefiting large players over the medium term. Well, let's wind this down with a valuation snapshot of all our listed players. So 2026 is shaping up to be yet another important year for cement stocks. Whether green shoots on the demand front they blossom or they wither away, that will depend on the pace of the government spending, pricing discipline, and how supply additions are absorbed.
Well, the outlook for India's cement sector, and let's now talk about India's real estate sector. India's real estate investment trust segment has gained visibility after its 5th listing in 2025 and a slew of reforms that were announced. Sonal is here to decode what is the next phase of growth for REITs in India. Sonal.
One of the notable trends in 2025 was the increased focus on REITs. This year, India saw its 5th REIT list on the stock exchanges, a small number globally, but a big milestone for a market that only began its REIT journey in 2014. Let's zoom out. The US launched REITs in 1960, Australia in 1971, Japan, Singapore and Hong Kong followed in the early 2000s. Today, while the US boasts 196 listed REITs and a market cap of $1.4 trillion, Japan has around 57. We have Singapore with 39 REITs. Australia has 32 REITs right now worth $126 billion and Hong Kong has 11. Where does India stand? India stands at 5 REITs with a market cap of about $18 billion. REITs are like mutual funds. You know, where the underlying is real estate, where they acquire, own, manage or finance income-generating real estate. In India, this real estate would be offices, malls, warehouses. 5 listed REITs in the country are Embassy Office Parks REIT, Mindspace Business Parks REIT, Brookfield India REIT, Nexus Select Trust REIT and Knowledge Trust REIT. Remember 2024? That's when the holding period for capital gains was cut from 36 months to 12 months, the first major nudge towards REITs. But in 2025, SEBI officially reclassified REITs as equities, aligning India with global practice. This will be applicable from Jan 2026. But why does that really matter? Because it has the potential to unlock institutional money. Mutual funds today have roughly 23,000 crore rupees in REITs, barely a drop in an 80 lakh crore industry. Funds can invest up to 10% of NAV in REITs, but the current allocation doesn't even touch 1%. Most exposure is still sitting inside debt and hybrid categories. Equity funds barely touch 2%. This reclassification is expected to reshape that in 2026 and beyond, improving liquidity and making REITs a mainstream asset class for Indian investors. In fact, there were tax sweeteners too for this asset class. Dividends and rental income from REITs remain exempt in the hands of investors, provided underlying SPVs pay corporate tax. And according to Anirok, if we talk about some more numbers for REITs, Indian REITs delivered distribution yields of 6 to 7%, comfortably above the global benchmark of 4 to 5%. Capital appreciation, because basically that is the rise in prices, stood at 3 to 5%, again higher than international peers. Although vacancy levels, they stayed elevated at 10 to 16%. On the ground, India continued to build. As of October 2025, over 23 million square feet of new Grade A office space was under construction, and global capability centers, or the GCCs, drove 28 to 29% of gross leasing, reinforcing India's position as a global office hub. The market is now projected to cross $30 billion in the coming years, and also a lot of other impact that we'll see because of the regulations. And 2025 also saw early traction in small and medium REITs, introduced last year, allowing fractional ownership of real estate between 50 and 500 crore rupees. CBRE estimates that this space could surpass $75 billion with nearly 500 million square feet of eligible commercial assets across offices, retail and logistics. So now, maybe the question will be, how fast will this market grow, and not if we will see more traction in REITs in India.
Well, 2025, a big year for REITs. But with that, it is time for us to wrap up this edition of Rewind. Of course, do stay tuned to CNBC TV18 as we bring you all the latest on what the new year holds for the capital markets and, of course, for a whole bunch of sectors. For now, from all of us here, thanks very much for watching. Here's wishing all our viewers a very happy new year.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the headlines that we're tracking this evening. Sensex and Nifty end 2025 with 10% gains, underperforming Asian and global peers. PSUs, banks, metals and automobiles are the top performers. IT, real estate and media stocks are the big laggards. Rupee ends the year just below the 90 mark against the dollar. The Indian currency depreciates 5% in 2025, making it the worst performer in Asia. A new lease of life for Vodafone Idea. Government freezes AGR dues worth more than 87,000 crore rupees for the next 5 years. Reschedules payments over a 10-year period starting FY32. A government panel will also reassess the dues and the decision will be binding on both parties. Telecom operators lock horns with Adani for not allowing them to set up network infrastructure at the newly opened Navi Mumbai airport. Telcos seek government intervention, alleging denial of permission. Adani hits back, accusing telcos of acting like a cartel on pricing. Reserve Bank says commercial banks exhibited sound financial health in 2025 on the back of strong capital and liquidity buffers, but issues a warning for NBFCs, with 8 companies potentially breaching the capital requirement norms, even in its baseline scenario. Shares of steelmakers rally after government imposes a safeguard duty for 3 years, says a sudden surge in imports has affected domestic prices. Bharat Forge will close FY26 with an order book of around 14,000 crore rupees, says Baba Kalyani. Secures a second major government contract to supply guns designed and developed in India. That's an exclusive. Zomato, Swiggy and Zepto announced new incentives for deliveries on peak hours today. This after gig workers announced a strike on New Year's Eve, citing unsafe working conditions, declining wages, lack of social security, among others. Ocean of mourners flood the streets of Dhaka on Khalida Zia's final journey. Bangladesh's first female prime minister and one of the nation's most influential leaders is laid to rest beside the grave of her husband, former President Zia-ur-Rahman. India's External Affairs Minister S. Jaishankar attends the funeral. After spending 60 years at the helm, legendary investor Warren Buffett retires as the CEO of Berkshire Hathaway today. Long-time Lieutenant Greg Abel will take on the reins of the company with a record cash reserve of $380 billion. Well, let's start the day with the market action that we saw. The Wall Street snapped a 4-day streak, ending the year higher amid broad-based gains. Nifty rose nearly 1% and crossed the 26,100 mark. For the year, Nifty and Sensex gained 10% each. However, underperformed their Asian peers and key global indices. PSU Bank, metals and autos were the top performers. Meanwhile, media, realty and IT stocks fell the most and were among the laggards. Manglam Malu joining us now with a wrap of the year's action that we saw on the Wall Street.
If you look at the Indian index in 2025, the Nifty was up 10.7%. Yes, it was up 10.7%, but compare that to Dow Jones, which is up 14%, NASDAQ up 22%, even China, which was up 18%. So a lot of money actually moved to China after its underperformance against India in 2025. It did well. Even if you look at the emerging markets index, it was up 30% as against the Nifty, which was up 10.7%. Kospi and Spain, both these indices gaining between 50 to 76%. In regard to that, the Indian markets look like they underperformed. And that's not all. The Asian markets, the Indian currency was the weakest performing currency in all of Asia. And if you adjust for the rupee weakness, the dollar-adjusted returns on the Nifty are a mere 5.5%, nearly half of what the reported 10.7% gain on the frontline index was. It was also the year of firsts. We had gold and silver see big rallies. In fact, the first time since near 1972 where the silver index was up over 160%, and rupee adjusted terms, gold and silver definitely were the stars of this year. It wasn't an equities market, it was a precious metals market. But in that as well, we saw record FPI outflows of $34 billion from the equity markets. There was record funds raised via IPOs, and a lot of that was offers for sale. $22 billion which is one of the highest that we've seen. And the discipline of the SIP investors continued. Nearly $3 billion every month on an average is what the SIP investors put in the Indian markets, and that kept us afloat and kept the index positive this year. And if you look at the sectoral indices as well, this year was the year of PSU banks, metals and autos. The underperformers were the IT index and the realty index. IT because of the global uncertainty and the flight to artificial intelligence or capital deployment towards that. If you look at, the broader markets, it wasn't the year where your portfolios felt better either. Nifty small cap index was down 6%. The mid cap at an index level was up 5%. But if you look at the BSE 500 stocks, the median return out there was a negative 5%. So more stocks actually declined than the number of stocks which rose in 2025. But the ones that rose from the frontline end, there were a few. Maruti, Eicher, both of them gave you over 50% returns. Shriram Finance was the star out there. And towards the end of the year, we got that MUFG infusion of capital coming in that company as well. Hindalco, Bajaj Finance were notable gainers. But among the notable losers, yes, there were the IT names as expected, Infosys, TCS, HCL Tech. But Trent, after seeing big gains in the last few years, this year was down in the dumps, nearly 41% for an index stock.
We're on to the commodities market now. Crude oil prices are on track to register their steepest annual fall since 2020. Prices have fallen more than 15% over the course of 2025. Fears that supply will outpace demand, higher tariffs, OPEC plus output hikes and sanctions on Russia, Iran and Venezuela have all weighed on prices through the year. Meanwhile, silver prices remain volatile, falling nearly 8% after gaining 10% in the last trading sessions. This as aggressive profit booking and thin year-end liquidity triggered heavy selling across commodity space. Despite this, the white metals price is 139% higher than what it was at the start of this year. Similarly, gold prices also softened just before the new year. However, the yellow metal has been on a bull run in 2025, with prices rising by as much as 65% through the year. Now, the top story this evening, a new lease of life for Vodafone Idea. The Union Cabinet has frozen AGR dues worth more than 87,000 crore rupees for the next 5 years and provided the company a 10-year time frame to pay the amount. Now, shares of Vodafone Idea declined by 10% to drop below the 11 rupee mark, which was the price set for a follow-on public offer in April. Now, AGR dues worth 87,695 crore rupees can be paid from FY32 to FY41. The 5-year freeze and this staggered payment schedule is aimed at helping the company tide over its current financial crisis. The government, meanwhile, owns 49% stake in Vodafone Idea after stepping in to avert the collapse of the company by converting some dues to shares. A government panel will now also reassess the dues, and the decision will be binding on both parties. The telecom department will constitute this panel, which will reassess the dues. Vodafone Idea is also saddled with a huge debt burden. This government decision comes as a relief to key lenders of the telecom company, which includes a clutch of private and PSU banks. However, the government has not announced a blanket waiver of AGR dues. Vodafone Idea will need to pay the dues for FY18 and FY19 over the next 5 years. All in all, respite for Vodafone Idea from AGR dues, giving the company some breathing space to get its house in order. Now, incumbent telecom companies have locked horns with Adani-run Navi Mumbai Airport for not allowing them to set up network infrastructure. Industry body COAI has sought the union government's intervention over alleged denial of permission and the airport authority imposing their exclusive in-building telecom arrangement on them. Adani Airports has hit back as well, saying that they won't give in to cartelization. Madhya Mujawar joining us now with more details. Madhya.
Passengers who have travelled from and to the Navi Mumbai airport have been complaining about network issues where they are unable to call or access internet. I also faced the same issue when I visited there on day one of operations. Now, that's because of lack of telecom towers inside the airport premises. And at the heart of the dispute is who controls telecom infrastructure inside the new airport and at what cost. Now, India's three private telecom operators, Airtel, Jio and Vodafone Idea, have written to the Department of Telecommunications accusing Navi Mumbai International Airport of denying them right-of-way permissions. Now, under India's right-of-way framework, airport operators are statutorily obligated to allow licensed telecom companies to deploy their own network infrastructure like optical fiber, erect towers, or deploy other telecommunication infrastructure. But NMIAL has installed its own in-building solutions and directed the telecom operators to utilize that allegedly at exorbitant and commercially untenable charges. Now, operators say that NMIAL is seeking approximately 92 lakh rupees per month per operator, aggregating to over 44 crore rupees per annum for 4 operators, including the BSNL network, to use the network installed by the NMIAL airport. Now, here's what the airport operator's version is. It says that it made a conscious decision to install the in-building solution, or IBS as they call it, as a neutral host telecom network because at many airports, critical zones like baggage belts, ATC buildings and utility areas get neglected by the telecom service providers, affecting airport efficiency. This is what the airport operator says. It also points out that airports are highly sensitive security zones requiring frequent maintenance, which is best handled directly by the airport operator, with security clearances from BCAS for the entry inside the airport already available with airport staff. NMIL said that it never denied right-of-way to any telecom service provider. The airport says that IBS charges are in line with industry standards and that telecom operators are yet to formally revert. And importantly, NMIL says that government-owned BSNL is already in advanced testing stages on this IBS network. So that's the dispute, and telecom operators are urging the government to direct NMIL to give them right-of-way, look into what they call a monopolistic setup by the airport operator, and they also want the telecom department to tell the airport operator to stop blaming telcos for poor network coverage at the airport.
Now, steel stocks ended the day higher after the government announced a safeguard duty on steel imports. The government has imposed a 3-year import duty between 11 to 12%